to a union. It just kind of highlights the thrust of labor and how much Elon Musk has tried to avoid any interaction whatsoever with that kind of organized movement.
Yeah, and I find this really interesting because if you think flashback a few months ago, we were all talking about the UAW strike, which really only impacted the American automakers to a large degree, the traditional GM and Fords of the world. And Tesla kind of skirted around the edges, all the electric vehicle workers, not part of a union in the United States. Generally, Tesla did not experience that distress. But here it is coming at them from another area of the world. Labor is, in general, in a very different position globally than they have been in the last several decades, given just a lack of workers, a lack of available labor. They have a degree of power, and they are certainly using it to the best of their ability.
I have to say, one of the hottest topics at Thanksgiving was who's going to suffer the biggest job losses as a result of artificial intelligence.
Okay.
And we all decided we should become plumbers and we should become, you know, just anything that is in the physical world, because that's what cannot be disrupted as much as some of these other white-collar jobs.
It requires services, hands-on service workers. And there's not a lot of displacement that can possibly happen.
Anyway, shifting gears a little bit to the market of currencies. Mark Chandler, Chief Market Strategist at Bannockburn, who doesn't have to weigh in on exactly which jobs are going to get disrupted by artificial intelligence. But we were just talking about Germany and the fact that they are kind of abandoning their net zero, their net neutral debt issuance yet again because they're trying to compete. How does this affect how you look at the developed market world at a time where inflation is a problem and spending is still necessary in terms of the politics?
I think you're right, Lisa, that the sell-off that we're seeing in U.S. Treasuries today, I think the 10-year yields of about 6 basis points, is really playing catch-up with what's happening in Europe. And I think you're right, too, that the focus is on Germany. A high court decision earlier this week said that, many people, I think that Germany is some kind of fiscal, example, fiscal austerity. But in fact, what they've done is they've put a lot of things off budget. And the high court ruled that what it's trying to do off budget is unconstitutional. This has blown about a 35 billion euro hole in the German budget, and so that's why they're extending that break. And this is really the tragedy. Remember earlier this year, the Greens, who had the whose decision it was within the German government, were forced to really swallow their pride, swallow their values, and extend the nuclear plants for a bit longer, given the energy crisis in Germany. And now we've got the Free Democrat finance minister, Linder, suggesting that he's had a compromise. He was the one who really advocated reinstating the debt break, and now he too has had to backtrack. And I think that this is a particularly European problem, and I suspect that U.S. yields might have stayed a bit lower if it wasn't for what's happening in Germany and Europe today and yesterday.
Can you talk to us a bit, Mark, about how this translates into currencies? It does seem that the entire global financial markets are in one big trade. The dollar rallies, S&P 500 sells off, yields are rising. And then the reverse has been happening since early October. How does this play out in currencies? And will we get to a point where we ultimately see some detachment in all of those markets emerge? What will create that point in time?
And I think you're right. I think there is like one big trade, if you will, going on. But I wouldn't begin it with the dollar or the stock market. I'd begin it with interest rates. And I think that, we saw the dollar strengthen from about the middle of July through early October, partly even into November. And it was partly on the idea that of this divergence. The U.S. looks so much better economically than Europe. The Eurozone likely to stagnate or worse in Q4. The Japanese economy, as you know, contracted in Q3. China's economy is struggling, so the dollar rallied. It's sort of like the driest towel on the rack, if you will. And I think that divergence is reversing itself now. We got convergence taking place with the U.S. economy poised to slow down dramatically here in Q4. And I think that has helped push interest rates lower. Remember, we were seeing the 2-year note in the U.S., and that's what I'd focus on for the currencies at the shorter end of the curve. The U.S. 2-year got above 520. and we're trading closer to 480, 485 or so now. And I think that this is just a reflection of the market anticipating the Fed cuts. And the Federal Reserve told us in September that they were still planning on cutting rates twice next year, even though inflation won't be at its target.
Can you give us a little bit of sense of what's happening with emerging market currencies as well? Because I do sense that there is some divergence there where there's one big block trading around the dollar, and with respect to developed markets, emerging markets seem to have some evident divergences. What's going on in emerging market currencies right now?
Yeah. Thanks. You know, it's hard to talk about the emerging markets as a homogenous block, as you know. I think that what's been attractive to a lot of people this year has been the Latin American currencies, typically high interest rates, commodity-backed. And I think that this has left, you know, when you look at the other zones, the Central Europe sort of dragged down by the euro and the weakness of the eurozone and European economies. Asia currencies, you've got a lot of challenges with China, but recently both South Korea and Taiwan has seen an increase in their exports, especially of technology, and this is seen to be a sign of maybe a better recovery. I think the Mexico story is really the outstanding one. You know, Mexico, despite an appreciating currency this year and last year, Mexico's exports remain strong. Carry is large. That is, they have an overnight interest rate of 11.25%. So you're still able to get a double the return that you can on the U.S. And they have strong central bank independence and a strong Supreme Court that sort of has given us guardrails to some of the more populist policies coming from the government. So I think you're right. When the Federal Reserve begins easing, and that might not be until the middle of next year or so, I think that helps put it like a floor underneath some of the emerging markets.
Mark Chandler of Bannockburn, thank you so much for being with us. We really appreciate it, and happy Thanksgiving. This has been one of the biggest questions, really, is sort of what's going to happen in China, what's going to happen in Asia to drive growth at a time where that had been the engine for so long. There was a story overnight talking about how China seems to be gearing up to support its property market much more substantially. Yep. I don't know how much people are going to buy this, but it seems like there's something a little bit more underneath this.
Yeah, and expectations are so low. I think that China's a potential big bright spot emerging in 2024 that nobody's talking about. So take whatever I say with a grain of salt. But nonetheless, I do think that much of market sentiment really over the last year has lined up around the idea that China's a giant disappointment. There will be no geopolitical resolve between the U.S. and China. China's a standalone nation now. And we got to the point of, I think, where this trade was extreme. And that opens up an opportunity for China, even if they don't do a lot, there is an opportunity for upside. But if they do come into the market and start supporting the property markets, start really trying to reinflate and stimulate growth, and also, importantly, try to repair some of their geopolitical relationships, in particular with the U.S., which we did see signs of that emerge last week, this could be a really big upside positive story that emerges in 2024, and no one's talking about it, but nobody's expecting it.
People were saying it's uninvestable.
Yep.
People were saying
absolutely.
This is not something that you can buy. I'm curious whether you think that companies bought the message that Xi Jinping was selling.
I don't know. It's too early to say yet. It's just too early to say. I think they're really reticent to do so.
All right. Well, we'll sort of track that. I really do wonder about that. Coming up, Shannon Siri Grein of Wells Fargo talking about what we are going to see in this retail season.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment case for this in the world.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
What we're seeing is half of consumers are actually saying they are going to spend more this year. I think what you are going to see is that consumers are much more focused on value than they've ever been before, and we're seeing that in shopping behavior this year.
That was Mark Rosen, CEO of JCPenney, taking a look at what to expect going forward for the holiday season. I was doing some research, and it looks like about a third of people surveyed, Gina, are going to use artificial intelligence and other generative AI to do their shopping for them.
You're kidding.
No, with like ChatGPT and things of that nature.
Wow.
They wanted to use artificial intelligence to surface good deals, brand recommendations, and gift alternatives. Basically, hey ChatGPT, what should I get?
Yeah.
My 13-year-old
I guess
child.
it makes sense. Do this for me. Make me more efficient. Help me out. It's interesting because I would have never thought to do this, but I suppose it's a kind of a natural evolution in the way that we shop online. We are getting sort of ChatGPT is right at the top of any search that you do now. So it kind of makes sense that you might take advantage of it. But wow.
Yeah, and I also
it's really hitting us quickly.
Yeah, well, and I think about probably the generational divide and people who are used to taking more shortcuts when it comes to thinking through things, which may add to productivity. Joining us to talk about not that, but the retail season ahead of us, Shannon Siri-Grind, economist at Wells Fargo. Thank you for being with us, Shannon. I want to start with your expectation for a 5% gain in sales for this holiday period, which is pretty good. Is it good enough?
Yeah, right. So the way we've been characterizing this holiday season is that it's going to be decent. So it's not going to be a blowout year like some of the years we've coming out of the pandemic, the last few or so, but above average. So the average annual gain over the past decade or so has been closer to 4%. So we think that momentum we've seen in the first half of the year is really going to carry us through here towards the end. But there is some worry growing among consumers amid still elevated prices, rising interest rates, things of that nature starting to weigh on consumption a bit. So a decent holiday season, 5%, again above that long-run average, but a step down from the rates we've seen over the past few years coming out of the pandemic.
Is it a good signal or a bad signal if people really come out to buy deals, if they're going to be looking for the biggest discount in order to buy?
Yeah, I mean, I definitely think we're going to see a consumer that's really deal hungry. So we did see a lot of retailers trying to pull forward holiday sales. So we saw sales activity starting in October of big box retailers online and in store. Even though today's Black Friday, obviously some of those sales have happened in the past few weeks. We're starting to pull forward where it's really Black Month rather than not just one day, right? The whole month has really become characterized by sales activity for the holidays. So I do think we're going to see consumers pushing for those deals, even as inflation slowing. We're still seeing that prices are well ahead of where they were ahead of the pandemic. So I think that's just adding to a consumer picture where they're dealing with higher prices, they're dealing with higher interest rates, they're also facing less liquidity, and a lot of these factors come together where a consumer is looking for more deals this holiday season in order to, purchase all those gifts. So I don't know if it's necessarily a good or a bad thing at this point, but I do think it's indicative of this consumer progression that we've seen where households just have less liquidity at their fingertips to rely on in order to spend this year.
Shannon, do you do any work to sort of disentangle what that 5% means in terms of net sales, volume sales, in other words, versus the total sales picture? This is something that's popped up in equity markets repeatedly over the last 6 weeks, is really how much are your net sales, you consumer company? Because the investor base really wants to see the volume come through, understanding that inflation is decelerating.
Right. So when we think about that 5% figure that we forecast, that is nominal. So when we adjust for inflation, that will be lower. But in terms of volume for sales, we still expect most of the sales activity to happen towards the end of the holiday spending period. So in December, volume is going to be higher than last year, but not as nearly as much as that 5% figure indicates, because that is not adjusted for inflation, as you mentioned there, Gina. So there is some effects there in terms of the volume measures as well, in terms of how retailers can assess this year versus years past.
And can you talk about sort of what drives your forecast? Because I think it's really interesting to see a 5% growth number in an environment where suddenly the consumer sort of outlook has turned quite grim over the last couple of months, with consumer sentiment turning over. Are you generally seeing that consumer sentiment is going to lead to a slower sales pace, or do you sort of dismiss that as a short-term impact?
Sure. So the sentiment and confidence measures, I do think, can be somewhat overlooked in the near term. The fact that sentiment and consumer confidence more generally have been very low, and consumers have continued to spend at a robust clip over the past 6 to 12 months, is indicative to me that they don't move one for one. Sentiment is very much more driven by inflation, so we actually might see a bounce in the next few months given lower gas prices. But when I think about the spending environment specifically, I mean, consumers are becoming a bit more vulnerable. So we do have momentum from the beginning of this year, helping feed a decent holiday sales season. But as liquidity dries up, as rates move higher, borrowing costs become more expensive, I think that's going to impact the consumer. And then when we think about the nuances with that 5% figure, I mean, there are a bunch of different retailers and categories to discuss, right? So hobby stores, electronics, things that saw a significant run-up throughout the pandemic are likely due for some payback this year. And then also those interest rate sensitive categories are probably not going to experience as much of a gain as well. So I think you do have some nuance under the hood of that above average gain that we're forecasting.
The picture that you're painting sounds a lot rosier than some of the discussions that we heard from the likes of Walmart's CEO and others, where they were talking about possible deflation and a market deceleration in the past 3 months from where they had been thinking earlier. So do you have this sense that maybe things are moving quickly and we might get the early signs of a more significant slowdown, or do you think that this was idiosyncratic to specific companies that deal with specific clients?
So I think it's a bit of both, where you are seeing a slowdown from the past few years. And I know this is a simple point, but I think it sometimes gets overlooked in the sense that we are coming off of some extremely high base effects coming out of the pandemic in terms of retail and holiday sales specifically. So the slowdown doesn't surprise me, and our overall forecast for next year is still rather weak. I think risk of recession is quite elevated. So when we go into next year, beyond the holiday season, I am growing more and more concerned about the consumer generally. But I do think that we can get through this holiday season with somewhat of a decent gain. I don't mean to come across overly optimistic. I think consumers are starting to struggle a bit more, but I think it will come out with just a decent holiday sales gain, just given that momentum we've seen. So I don't want to dismiss the pessimism or weakness that we're hearing in some of those equity reports, but I do think that it really depends on how we transition to next year in terms of the consumer picture more generally.
I'm old enough to remember when people would line up outside of stores and they would try to get the deals, and I remember when people would flood in and the shops were completely crowded. And over the past couple of years, shops haven't been that crowded on Black Friday, and there has been this feeling that people are using them as dressing rooms, frankly, to go order things online, or they will just stay at home and order online. How much has it, to Gina's point earlier, gotten spread out, where you're not necessarily going to see all of the consumer spending on Black Friday in the same kind of way, and you have to look more toward Cyber Monday and the Amazon sales as much as anything else?
I definitely think it's getting spread out. So I'm with you, where I remember people lining up outside of stores today, the Black Friday that was traditionally was. And I think those sales have been pulled forward throughout the month and then even into October. So retailers are smart, where the earlier that households spend on holiday sales, the more likely they're going to spend over the whole season. The October retail sales report did come in a bit weak, so I'm not sure how much sales was actually pulled forward into October, but obviously spending has been happening throughout the month of November. And as we get that data, it will be indicative of how it's going to happen over the course of the next month as well. A lot of the survey evidence does suggest that consumers are increasingly looking to spend more in December as well. I think that's really that deal-driven mindset is coming in. So I think, it's part of this game where retailers are trying to spread it out more so, and consumers are reacting to that when they see a deal, particularly as they become more vulnerable in terms of less liquidity out there. But I definitely think it's more of a spread out season than it has been historically.
Shannon Siri-Grine of Wells Fargo, thank you so much, and have a wonderful weekend. Gina, are you going to be shopping this weekend?
No.
I actually tried to get the boys to go shopping because they need clothes, and my younger son just said to me, absolutely not. It is so crowded. I don't want to be with crowds. I'm like, oh boy, what have I created?
I haven't gone out shopping in person over the Thanksgiving holiday weekend in years. It's just not something I generally do. We do a lot of family activities. We do a lot of searching online. I get lists together and that kind of thing, but there's not a lot of shopping that happens for me over holiday weekend.
What was the hottest topic last night at Thanksgiving?
Oh, good question. We talked a lot about generally what's happening with our kids in schools. So this is not, I can't say that we were talking about the financial markets. It just didn't come up.
You didn't talk about
even the political situation didn't come up. It was really more, and again, this is a neighborhood gathering, so it was more about kids in school and what are kids dealing with? How are we going to deal with our kids who are in middle school going into high school? Where are things headed? It was all about our children. We're just kind of kid obsessed.
And then the family one comes, and then things might change.
Yeah, family Thanksgiving might be a bit different.
Yeah, we talked a lot about generative AI. Coming up next, Macy's CEO Jeff Jeanette talking about the shopping outlook, or Caroline Hyde is going to be with him on the floor, looking at the crowds, or maybe not. Let's check it out. This is Bloomberg.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything. Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
higher for longer sort of narrative is still very much in play.
Inflation has been high, and at some point, that should weigh on activity. We probably do get some type of broader downturn in the economy.
I don't think there's a recession coming next year. It's just a gradual slowdown.
Highest conviction trade is no eases. Fed on hold till at least after the election.
It needs to be a pretty catastrophic crisis, I think, for them to be forced into really, really loosening policy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Here comes the retail therapy. Good morning. Welcome back. This is Bloomberg Surveillance on radio and television. Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Tom and John both enjoying their post-Thanksgiving day. With me, I am so pleased to say Gina Martin-Adams is joining to discuss and go through what we have learned this year and also to check out the holiday sales because that is the tradition. I'm just curious. We've not talked about the incredible rally in stocks, the amount of money that's just been flowing in. How much is retail therapy just buying equities in the U.S.?
I think it's very little retail therapy, frankly. I think most of it is just a reflection of where we were. Remember, we had a greater than 10% correction from July to October. We got deeply oversold. Sentiment was extremely low. We've got a nice little seasonal tailwind that tends to emerge in November and December. So I would attribute it more to short-term dynamics than any sort of long-term confident recovery rally that is the start of a major shift, at least yet. Who knows what could emerge with respect to the fourth quarter and trends, but I think it's more short-term than I would like to see.
Bank of America Global came out with this piece of research citing EPFR data showing that global stock funds saw $40 billion of inflows in the past 2 weeks. That was the most going back to February of 2022, so almost 2 years. And that even then, you take a look at what the inflows this year have been, it has been $1.2 trillion into cash funds and only $143 billion in equities. Cash is still such a big draw relative to stocks.
Yeah, and I mean, can you blame investors, though, when you've got the yield on the equity market, depending upon how you slice and dice it, is somewhere between 5 and 6%. If you're going to get 5 to 5.5% on your money market, why stocks? Why take the risk in stocks? So there's a rationality behind this. When you're getting paid to own cash, investors are generally going where they're going to get paid. And there's very little confidence that the equity market can produce some sort of much greater, but more robust earnings recovery to improve the valuations in the equity market.
The lack of confidence is apparent today where you're seeing basically not a lot of action. It's also probably because most people are home and tryptophan-induced slumbers. There has been a slight lift to the S&P, although the NASDAQ is slightly negative. S&P futures up about 0.1%. The euro gaining just a touch against the dollar after some better than expected European data, 109.14. 10-year yields coming off some of the earlier highs, but to me this is interesting, nudging upward, 4.46%, up about 6 basis points after it was clear that Germany is planning to keep spending and this sort of fiscal impulse. We were talking about this last hour, but to me, this actually is one of the biggest stories and the biggest question marks for this market.
Yeah, and I would totally agree. What happens in the bond market is incredibly important to what ultimately happens in all asset classes, all risky asset classes as well. And we saw this emerge over the course of the last 6 months in particular, but really over the last 2 years. The bond market is the leader, and all the rest of us are just kind of trailing along behind. So what happens with fiscal spending, what happens with government debt is incredibly important to determining the outlook for all asset classes right now.
All right, well, what we're looking at today, coming up in just moments, we're going to be hearing from Macy's CEO Jeff Gennette alongside our colleague, Bloomberg Television's Caroline Hyde. We will get to that in just a moment. 9:45 a.m., S&P Global US PMI data coming out. Particularly interested in the services sector. Do we see a fall off there? And markets do close early. Stock market closes at 1 p.m. Bond market closes at 2 p.m. Let's get to it. It is an important conversation on a day devoted to celebrating retail sales. Let's head over to Macy's in New York City's Herald Square, where Bloomberg's Caroline Hyde is joined by the company's CEO, Jeff Gennette. Caroline.
Lisa and Gina, it is a joy to be with you, with Jeff Gennette, of course, on a day where people queue, they run in, the celebration is upon us, your Super Bowl. What are they buying today for Black Friday?
So they're buying everything on their gift list, and they're buying, that's really generally in luxury. So fine jewelry, they're buying cashmere, they're buying outerwear for the entire family. Hostess gifts in our home store, but they're also home prep. We've got great deals, as we always do for Black Friday, going all the way through the holiday season. So we are ready. We've got all of our key items, loaded to bear. Here we are in Herald Square. It was a good opening. We had a great day online yesterday during Thanksgiving.
I mean, you said that on your earnings, which were, about a week ago.
Yes.
That this gets earlier and earlier.
It does.
Black Friday, the competition. How important are the next few days and the run-up to the holidays?
Oh, it's still very important. So, when you think about kind of Black Friday deals really started right after Halloween is when they started. But this is still a pilgrimage. You've got, America is traveling, and they are in homes, and they're coming into stores just like this one today. They're online. They've been online all the way through. So it's very, very important. So when we look at kind of Black Friday through Cyber Week, then we go into a lull. It's like 10 days where people kind of reset, and then those last 10 days become increasingly important. So it's one of the 3 stages right now that we are of the kind of the Christmas shopping is the one we're in right now, the first.
What, of course, your earnings showed so clearly is that it's about inventory management in many ways at the moment, and you've been managing to ace that. How are you ensuring you got the right thing at the right time for a consumer that basically we're all trying to understand right now?
So obviously the consumer's under pressure, but they still love gifts. And so we want to make sure that we've got all the right gifts and we've got all the right stock content in them. So I just walked this entire store to really understand where we are in all of the content across all of our categories, and we're in great shape. And that's really in tribute to the amount of work we've been putting in inventory control.
And when it comes to online versus in-store, in retail, this is how you've been shifting the company. In particular, people aren't perhaps having the footfall in malls. They're coming to one-off stores. They're going to smaller store experiences. But e-commerce has just been the focus. How are you managing to be at the right time in the right place for an omni-channel purchaser?
So really, the strength of Macy's and Bloomingdale's and Bluemercury is that we're omni-channel and we're omni-category. So what you have is you have customers that are shopping online. They want to come into a store and try it on, and they maybe are transacting on the couch later that night. So the opportunity to make it as convenient for the customer as possible, however and whenever they want to shop. So that's our beauty, and doing that with a national footprint, with a great website, is what we depend on.
And of course, why you've got such a great bird's eye perspective, because you do have Bloomingdale's for the higher end, more luxury purchaser, and then more income breadth when it comes to Macy's. What are we seeing in terms of the consumer? Are they going to be spending more? Are they going to be pulling back?
So you do have customers that are under pressure. And so when you think about the inflation is still high, it's abating from the change of the inflation rate from last year, but it's still higher than it was last year. And customers have got a limited budget. Some of it is they're spending it in experiences and then in our discretionary categories. So we want to make sure that we've got the right price points across that entire spectrum. But you still give gifts. And this is where Macy's and Bloomingdale's and Bluemercury shine. So when you have this gift, somebody on your gift list, we're going to have the right content for you at the right price point. And we spend from when Black Friday ends to where we are right now, we've been spending a year getting ready for that. And we do trial runs on Valentine's Day, Mother's Day, Father's Day to make sure we've got the right gifts. We're ready.
You're ready. People are worried, analysts might be worried, that you're kind of managing decline at the moment. What would you say to a comment like that?
Look, I think that if we were in a department store today, we would invent one. So the idea about having multi-categories, being able to do that in multi-channels, we now have been able to get new categories in as a result of Marketplace, which is now online at both Bloomingdale's and in Macy's. So I bet on department stores. And obviously, I've made my career doing this. And it is it's still very, very relevant. We're obviously looking at where traffic is moving from on-mall to off-mall. We're obviously testing that in both Bloomingdale's with the Bloomies format and with Macy's And so we're going to be ready for where the customer is evolving. And we've got very strong assets to be able to do that, both on mall and obviously online.
Evolving into a world where we're all using chatbots and artificial intelligence at front and center, are these the sort of areas of investment?
Yes, absolutely. Because when you think about AI and machine learning, think about when we have 40 million customers at Macy's, 4 million at Bloomingdale's, we know them very well. So to have all that data and be able to start to personalize content and values for those customers is where this is all going. How do you make your brand more relevant? And that is at a customer level. It's no longer broad-based promotion. It's the opportunity to be able to, I know Caroline, and based on what you buy, what you might be interested in, and to be able to serve that up in the way you want it served up is really the secret of success for an omnichannel retailer going forward.
You, of course, just mentioned throughout your career this is what you've been doing.
Yes.
For those who don't realize, you've worked at the Macy's brand for more than 40 years.
Yes.
And this is your last Black Friday.
Yes.
And, of course, CEO since 2017. You have been thought of as a turnaround focus, the polarist, the way in which you have thought about personalization, e-commerce. You weathered, of course, the COVID in and of itself. Do you feel that you've got this Macy's where you want it to be as you look towards this being your last Black Friday?
Yeah, look, when I reflect back on my career, and certainly in my time in CEO, I didn't accomplish everything that was on my list. But look, the focus on relevant content, on amazing values, and on customer experience is clearly the path forward. And I couldn't be more excited about my successor, who is more than ready to be able to do this. He knocked the cover off the ball with respect to Bloomingdale's and what he was able to do there, how he was able to kind of help turn around the strategy of Bluemercury. He's now going to do that for Macy's Inc. So he's got a good game plan, and he's going to make it better.
Jeff Gannett, we thank you so much for spending time with us on what is your last Black Friday, but still got a few more days in there. And of course, the job is here until February as the CEO and CEO-elect Tony Spring. But with that, we send it back to you in the studio.
Thank you so much. Bloomberg's Caroline Hyde and Macy's CEO Jeff Gannett on his last Black Friday on the floor talking about the importance of gifts. And Gina, that was something that he kept emphasizing. People still buy gifts, even if they are focusing more on experiences for themselves.
Right, exactly. Even if they're pulling back elsewhere, they're going to do what they can to buy those gifts and make the holidays a special time for their loved ones. And I think that that's a good point. The other thing that he brought up that I thought was really interesting is that shoppers are still going direct to luxury. They're still buying high-end. They're still looking at those high-end products as opposed to looking at sort of the extreme discounted products, which is a very big divergence, I think, relative to sort of the commentary that we've been having about how the consumer is focused on value, how the consumer is focused on, finding the best deal. Maybe they're finding the best deal, but they're also looking at those luxury items as a component of their gift strategy.
And there also are different shoppers, right? So that's why I was wondering whether the Walmart story was very different from the Macy's story, or for some of the other retailers that maybe are getting people who are looking for discounts. But to your point, in the highest priced things, it's not like they're looking for discounts for milk and bread.
Right, and it does reflect the big divergence that we have in experience at the various income levels. Americans at the higher income levels, even though they're also spending more on food and gas as a share of their overall budget, those are small movers compared to consumers at the lower and middle income levels, where higher food prices, higher cost of the Thanksgiving dinner, generally higher cost of gas at the pump, all of these things generally weigh on their sentiment significantly more.
Coming up, a gut check on whether this Thanksgiving dinner really was more expensive, at least than last year. We'll be talking about that. If you are just joining the program, we're looking at equities basically range bound. S&P futures up about 0.1%, a quiet morning ahead of the opening bell. Coming up at 8 a.m., we do have Michael Purvis of Talbot and Advisors, and we also have later in the show Justin Wolfers, the economist, who talks about how actually the price of a Thanksgiving dinner has gone down materially, but the difference is that that's year over year.
Exactly.
And this is sort of what people are focused on, right? And this sort of goes to the divide of why people feel so much worse than the overall economic data might suggest.
Big difference between what the financial markets think is important in inflation and what the everyday consumer thinks of inflation. And I think that we're seeing that play out real time in consumer inflation expectations. We could dig into that a little bit more, but generally Wall Street cares that inflation is rising at a slower and slower pace. This disinflationary kind of outlook is very important to asset prices. But is it enough to really change the consumer psychology? The details would tell you no. The consumer's still very worried about inflation. They're still very worried about price increases. They're still thinking about price as a component of their overall budget is much higher than it was several years ago. And so year over year, does that really matter to the consumer? I would venture to say no.
And I wonder how much this is also a housing story, more than many people would realize.
Absolutely.
Just because a lot of people are either locked into their homes or locked out of buying or forced into renting or forced into a smaller space. How much is that one of the biggest things underpinning some of the dissatisfaction?
Yeah.
We will discuss coming up. We also have Terry Haynes that's coming up next, Pangea Policy, to talk through what we can expect in the tear into year end for the political season, for the geopolitics in markets. Quiet morning, but really I focused on the bond yield space, given what we saw over in Europe. Yields just inching higher, not a lot of drama, but still a bigger move than in the past couple of weeks.
So we get to ride in an Uber with the Uber CEO.
Yeah, that'd be pretty cool.
Come along with me, Emily Chang, as I ask tech leaders of today what makes their businesses future ready for tomorrow.
You're an expert.
Some people might say that insurance is a boring business, but is that not the case?
No, I find it very interesting. I mean, you're not doing the same thing all the time. I liked it because it had a balance of doing different things at once.
This hostage exchange will provide about 4 days for them to ingest is what must be a massive amount of information from prisoner interrogations to laptops to shape future attacks in 4 or 5 days.
That was Norman Rule of CSIS speaking to us in the last couple of days as we prepared for the ceasefire that has taken place. It is a temporary ceasefire, a pause. The language is disputed as well as we do get some sort of brief reprieve as the hostages who have been held by Hamas are returned to Israel. Some prisoners are released back to the Palestinian people, and there is this question of how long it can last. Joining us now, Terry Haynes, founder of Pangea Policy, and I want to start with what's happening, what the U.S. negotiators are doing during this pause, during this cessation in fighting.
Well, they're grabbing as much information as they can, as your guest just said there a minute ago. They're trying to figure out as much as they can. All the rest. The other thing that's happening, frankly, is that the Israelis are resting and replenishing a little bit because what needs to be understood, I think, is that the ultimate war aim of Israel hasn't changed, which is the destruction of Hamas. And I think that if people think there's a serious deflection or difference in how Israel is going to try to prosecute this war going forward after the ceasefire is over, I think they're mistaken.
Do you think that there is this feeling that the pressure is getting too great on President Biden for him to take a role in anything other than trying to argue for some sort of prolonged cessation in fighting?
Well, I think the president is focusing on what he can focus on that's the likeliest to yield a result. That sounds a little prolix, but let me hone in on it. Biden can have influence on, and we've seen the influence on having a ceasefire. Biden's ability to influence Israel's war aims or how they prosecute them, I think is very limited, and I think it's going to remain limited. This is a two-edged sword for the president. They certainly want to celebrate the idea that they've gotten some of the hostages out, and to the extent they can deflect Israel's war aims, that allows people within the administration to try to prosecute their vision of what Middle East peace should look like. But I think we shouldn't overestimate the degree of influence the president has on the prime minister or the Israeli government. We should always keep in mind, from the Israelis' perspective, how deep and profound a shock the October 7th incursion was and is, and how that's going to influence what the Israeli government and the Israeli military do going forward.
Terry, presuming the truce does not lead to a ceasefire, which seems to be the general consensus view that we will not ultimately get a ceasefire and this war will continue, how do you see that impacting the U.S. presidential election come 2024?
Well, it tends to depress enthusiasm among Democratic regulars for Biden. There's a big split, and that enthusiasm is already not great, as everybody knows. But the degree to which the international situation continues to look parlous, the degree to which, from a sort of more market terms, geopolitical risk continues to look high, and I've said that I think it's the highest geopolitical risk in 50 years. That augurs against the president. That makes people a little bit less enthusiastic, more willing to take another look. Frankly, gives opposition on the Republican side, no matter who that is, the opportunity to say, look, we need something that's more coherent and more consistent and has particular goals in mind. That's how we protect America. That's how we project our power, all that sort of thing. So it's a very difficult time for Biden, I think.
And if you dig a little deeper into the Republican candidates and how they are distinguishing themselves, is this issue coming up as a distinguishing factor, or are they all sort of in the same general camp? And then how could it play out with respect to the Republican candidates?
Well, my view of this is, of the race, is that you're really down to three candidates now anyway. You're down to former President Trump, and you're down to Governor DeSantis and Ambassador Haley. They all prosecute the line I just gave you before with a fair amount of consistency. Mm-hmm. I mean, they all have their ways of their own mannerisms and how they talk about that, but the line is fairly consistent. The only person in the Republican field who really wanted to take a different sort of line is Ramaswamy, who's never really caught fire and is kind of flatlining right now. So what you've got on the Republican side is kind of a strong foreign policy that is very internationalist and very interventionist. Number one, and number two, very critical of Biden, of course. So they will all in their different ways. Trump is a former president. Haley is UN ambassador. Governor DeSantis tries to make up for his relative lack of foreign policy experience with talking about his service and his military service, and all those things inform the way they come at it, but frankly, it's pretty consistent across the board, and they're trying to draw the strongest contrast with Biden as possible. And then in the Middle East, for example, they would point directly to the Iranian policy of the past several years, which they'd all characterize as failed.
Terry, it strikes me that people are exhausted with even the idea of this presidential campaign because they're going to be dealing with two candidates that polls generally show people do not want to run on either side, and there is this feeling of something new, and nobody wants to talk about it. And there was a survey that I was looking at that showed that over 90% of respondents, and it was published in USA Today, said they don't want to talk about politics. They don't want to talk about Joe Biden. They don't want to talk about Donald Trump. They don't want to talk about the 2024 presidential election at Thanksgiving dinner at all during the holiday season. Does that tell you something about voter enthusiasm, about turnout, about what could potentially happen between now and a year from now?
Oh yeah, it's fundamentally, I think what it tells you is the kind of the where the electorate is, basically, number one, and number two, how unusual are people who will talk about nothing but politics incessantly. What I describe as purists on both sides have a disproportionate ability to impact, to influence how primary candidates are vetted and are chosen. But there is a great yawning middle that has, in my estimation, that has been looking for solutions, looking for the country moving forward, and is not getting that. It really very much feels it's not getting it. And frankly, they're exhausted between the politics and the pandemic of the last several years, and would like to get back to any semblance of normality. So, if there are candidates, whether on both parties or a third parties in the middle, and there's a great hungering for that too, I think, that can tap into that, the desire to kind of get back to normality and stop the screeching, there's going to be a big audience for that, I think, and a much bigger audience than people anticipate.
Terry Haynes of Pangea Policy, thank you so much. Gina, I was struck by some of the other aspects of this poll. About 30% of Gen Z participants said they'd be celebrating with friends to avoid family drama.
Okay.
Just throwing that out there. Theoretically, for some people, it might be of note. Gen Z, topics of conversation by the category of generation. Generation Z, weddings, general gossip, and basketball. Millennials, travel plans and family planning. And Gen X, pets and football.
I wonder why basketball is overtaking football for Gen Z versus Gen X. Number one concern, clearly,
of course,
has to be about the sports.
One.
But that's kind of fascinating, isn't it?
Well, yeah, and the
politics generally way low
Nobody
on
wants
the
to
priority list.
And honestly, part of the reason why it's just so polarizing, and like Terry was saying, they're the people who can only talk about politics, then they're the people who don't want to hear it,
right?
Because it has gotten so polarized and tribal in its discussion points that it just kind of feels exhausting, and like there isn't a meeting of the minds.
And inevitably leads to tension and really depletes the entire purpose of the holiday in general, which is to try to enjoy yourselves, enjoy your family, enjoy your friends.
Isn't that part of it? Is the tension?
Yeah.
What does Uncle Joe say this year?
Yeah, I guess we don't care anymore. We just want to have a good time.
We just want to talk about our pets. Coming up next hour, Anna Rathbard of CVIZ Investment Advisory Services joining us here on Bloomberg.
The acceptance of Purosang has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Purosang all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
2 hours to the open of a shortened trading day on Wall Street. Good morning. Welcome back. This is Bloomberg Surveillance. Gina Martin-Adams here alongside me on a quiet day, but some interesting things under the hood after a tremendous rally in equities, as well as in bonds, that seems to be put on pause. I wanted to take a look. Yes, you are seeing a little bit of a lift to S&P futures, just basically stasis across the board. But in the bond space, and this is really what I wanted to get from you, what do you think has driven this sort of shift upwards? Is it just thin trading, this inflection up in yields that have driven to the highest levels in 6 trading days?
Oh, I think it's inflation expectations. I think that University of Michigan inflation expectations number that came out earlier this week really sparked a bit of panic with respect to inflation becoming more of an embedded expectation in the consumer psychology. We'd seen so much improvement in the 1 year ahead inflation expectations on account of the Fed attempts to tighten policy that, you know, people might have gotten a little bit complacent with that, but there's no need for complacency, as was clear. When consumers are saying your 5 to 10 year ahead inflation expectations are at multi-year highs, there's a real risk that the consumer inflation psychology is more permanently shifting, and I think the bond market is sussing that out to some degree.
Just to just sort of reiterate what some of those numbers were that came out earlier this week, the 1 year ahead inflation expectation actually increased from 4.4% to 4.5%, which I thought was highly unusual given that gasoline prices, which usually track pretty closely, have come down so much. And the 5 to 10 year inflation forward expectations, 3.2%, in line with what it had been the previous read, but above where the expectations were. It points to maybe this is the cumulative effect, or maybe there are other costs that are driving people's understanding of things, like housing, that outweigh maybe some of the others, like gasoline, that typically were the drivers.
Yeah, and we're so obsessed with sort of those short-term movements, we kind of think about we forget to include the aspect of the longer-term psychological shift, which absolutely does include housing. If house prices simply fail to correct in this environment where interest rates are higher and really preventing supply from coming on the markets, what does that mean for the consumer, the vast majority of the consumer base that is thinking about buying a house? Their perceptions of the cost, the embedded cost of living, are incredibly high. And I don't think we're getting any reprieve on that. Also, we've talked a lot about the Israeli war with Hamas today, and I do think that in wartime, consumers think of war as an inflationary dynamic. They think of spending. We're talking a lot about fiscal expenditures right now. The consumer psychology around that is, ooh, this is inflationary, I've got to be on guard for inflation. So even though gas prices are falling, and that's normally our main driver, it's not the only driver, and we're starting to see some shift.
And actually, in the Fed meeting minutes, they hinted at the wartime psychology and how that could be inflationary. Under surveillance this morning, speaking of this, a 4-day truce is in effect between Hamas and Israel after weeks of delicate talks. Qatar, the U.S., and Egypt all brokering the deal. Hamas is expected to release 50 of the nearly 240 hostages it captured from Israel last month. Israel will release 150 jailed Palestinians and allow more aid into Gaza. This is the first major pause in fighting since the attack on Israel by Hamas on October 7th. The Israeli military vowing that the war is not over yet. It will continue once the truce ends in order to destroy Hamas. Our second story is Barclays cutting as many as 2,000 jobs. This, at least, is according to a report in an effort to reduce costs by $1.3 billion over the coming years. According to Reuters, top managers are reviewing the plan, which would shed about 2% of the bank's headcount. Barclays reported disappointing third-quarter earnings last month and lowered guidance again after already cutting its outlook in July. It raises a question, Gina, about how much cost-cutting there is within the financial sector. We've heard about this at Citigroup. We just saw another round of that. Is this the beginning of more to come?
I think so. Within financials, it's very interesting because we've seen this in bits and pieces really for the better part of 2 years. Back in the latter part of 2022, we saw mostly tech and communications companies cutting jobs, and that overwhelmed the story, but financials were cutting there too. So I think that this is an enduring trend where financials are really right-sizing and rationalizing their spending at large in an environment where the yield curve is inverted. They're not getting a lot of revenue opportunity through loan growth. They're having to really consider what their spending outlook looks like. But I feel like this is just a continuation, almost a death by 1,000 cuts in financials, as opposed to a renewed spike of any descriptions, particularly considering how small each of these cut programs announcements are, Citi's being a very small share of their overall bank, as well as Barclays now suggesting about 2% overall, and it won't come all in one chunk either. And I think that that's the bigger story here is financials is just kind of this overall weight. It's not adding any great job growth. It's also taking away job growth, but only in little bits and pieces.
Which is one of the reasons why maybe people haven't been that enthusiastic about it. Black Friday shopping underway, but in a shifting form. Macy's CEO Jeffrey Gannett telling investors recently and reiterating to Bloomberg moments ago that, quote, the competitive landscape has really shifted to Black Friday deals prior to Black Friday. Despite a consumer wary of higher prices and borrowing costs, the National Retail Federation expects holiday sales will increase 3 to 4% from last year. That's in line with pre-pandemic shopping, but at a slower pace than at least 2 years ago, which makes sense because how much stuff can people buy? I mean, really, at a certain point, again, this sort of goods versus services dynamic that we've been talking about for quite a while.
Yeah, and their goods spending has been so depressed. This is where I feel like we have no expectations that they're going to do a whole lot anyway. So any sort of improvement in goods spending, even if it's very modest, would largely, I think, beat expectations. The real risk, in my opinion, is not necessarily that consumers don't spend a ton for Black Friday. It's that consumers slow down their pace of travel. They slow down their pace of going to restaurants. They really pick away at some of the services spending, which has been extraordinarily resilient and somewhat stronger than goods spending over time.
So taking a look at the retailer, this is going to be very much front and focus for all of us and for Anna Rathbun, Chief Investment Officer at CBIZ Investment Advisory Solutions, joining us. Anna, thank you so much for being with us. I want to start there in terms of your expectations and how much we will be able to tell about consumer appetite from this holiday shopping season.
Good morning. Over the years, I have learned not to bet against the American consumer because American consumers like to spend. And we do have a tradition of spending. And so the holiday sales, I think that we're going to see some strength, maybe not the levels that we've seen post-pandemic, but certainly to rates that we were used to perhaps before the pandemic back in 2019, right? But the consumers aren't the same as 2019. We have seen weaknesses. Now, earlier you mentioned the inflation expectations being 4.5% 1 year. This actually, not only is there a psychological component to it, that actually drives spending patterns. So going back to the third quarter GDP, where spending really knocked it out of the park, it actually happened with the savings rate going down and credit card balances going to record highs. So if you think that the price is going to be much higher down the road, you're going to spend today. And that is the enigma of inflation. And that is something that the Fed, I believe, is still fighting on. But certainly, this is not a look of a healthy consumer. This is a look of a very creative consumer who's trying to buy today instead of paying more tomorrow. And certainly in the holiday season, looking for bargains and value over a long period of time starting in October.
Anna, can you talk to us a bit about how this may or may not impact your overall investment strategy, right? Because the consumer, I feel like, has been sort of this persistent, resilient source of support, albeit more for services spending than for goods spending over the course of the last couple of years. As the consumer approaches this holiday season, how do you think that ultimately plays out in risk assets or risk-averse assets?
Well, it certainly is not the best picture for risk assets because, look, if prices are coming down because of a lot of bargains, that is definitely margin pressure. So this, for a lot of retailers, it's going to be a volume gain versus a margin gain, right? So that's not a really great place to be. And that has to do with all of the weaknesses that we've talked about as an investment community regarding liquidity of the American consumers. So we're a little bit shy on the risk assets. I know some people have said with the Fed potentially pausing forever on this rate hike cycle that maybe we've hit bottom. That is not our view. And certainly for risk-averse assets, we just talked about rates picking up. At some point, we do believe there will be a rush to safe haven assets.
So let's talk about what that would be, what would sort of drive that. Because as you speak, if you're not betting against the consumer and they're buying what they can now, if you expect prices to be even higher later, that could actually fuel prices to be higher later, and it becomes a self-fulfilling cycle, which is exactly what the Fed has been talking about. You get that type of situation. What's the break point here? Why isn't that just going to continue with this positive momentum that some people have been surprised by repeatedly this year?
Well, the break point is that people run out of money. Right. And so what we're seeing slowly is a ticking up of some of the weaknesses there. Auto loans, credit card defaults, the delinquencies that are past 90 days are picking up, and to levels that we haven't seen since 2011. Third-party collection amounts are at their highest. So we are definitely seeing stresses there. Something's going to break in that arena. So the consumers, I don't think we can go at this pace. Another thing is credit card balances being over $1 trillion in the aggregate. The interest rate on that is no longer what it was last year. Last year, it was around 15%. This year, it's over 20%. So that's billions and billions of dollars that are going to be spent in paying interest rather than spending on the economy. So this is definitely not a scenario in which the American consumers can continue to spend the way they have been in 2023.
Anna Rathbun of CBIZ Investment Advisory Solutions, thank you so much for being with us. Have a wonderful Thanksgiving weekend. And honestly, Gina, this is sort of the conundrum. Everyone's been expecting the consumer to run out of cash. It hasn't.
Yeah.
And they keep on spending. And even now, some people are pointing to the fact that what if people are getting real incomes that are rising now because of disinflation? Won't that fuel their ability to do even more?
Right. And I think there's a lot of confusion, frankly, as to where we are in the cycle, because the consumer did react. They reacted pretty significantly in 2022. I don't know why no one really recognized it, but remember 2022, the summer of 2022, we were talking to Target and Walmart about major inventory problems because they had too much stuff. And the consumer was already pulling back when gas prices were exploding higher in the middle of 2022. So we did see retail sales correct somewhat in 2022. They just haven't corrected to the degree to which many had anticipated that they would, and have stabilized in 2023. And that's the real conundrum is, okay, so the consumer has already pulled back on their goods spending. They're not going to the retail stores as much as they had, but they're still spending on services. They're still going out there and they're still spending on those airlines. They're still spending on travel. They're still going to restaurants. That's where there is a potential for pullback here, in my opinion. And we haven't yet seen it with the degree to which the consumer can sustain that. The other thing that nobody's talking about is, okay, the consumer is maybe not running out of cash because they're getting paid for that cash suddenly.
Right.
So to the degree that they have some money in savings, they're actually making 5% a year on that money, not zero.
Yeah,
that is a kind of a feel-good factor, frankly.
This is something that we will pick up on in just a second. If you are just joining the program, the S&P up just marginally, up about 0.1% throughout the morning. NASDAQ off just a touch, but quiet, really quiet. You are seeing a bit of a lift to the euro versus the dollar as you do get better than expected data, 109.23. To that point, Gina, and this is something that people have been arguing for, is there on the margins, not necessarily the base case, but on the margins, isn't there a stimulative effect of earning money on your cash?
I think there is.
Right, so the counterintuitive of, when you lower rates, it's stimulative. Well, actually, when you gain money from your money, you can go out and spend that money.
Yep. Especially in an environment where less than half of overall wages and salaries is actually coming from jobs at this point in time. This is something nobody ever talks about. When you look at the overall bucket of disposable income, you get just a portion of that disposable income comes from wages and salaries. So we're somewhat dependent upon the job market, but not entirely dependent upon the job market. Consumers earning money on dividends, on their investments in homes, on their investments in cash, as well as just general retirees are a huge portion of this population that is not sensitive to what happens in the job market. They're more sensitive to how their investment strategy is playing out, and they're making money on their investments.
Can you say that one more time?
Half of disposable income has nothing to do with wages, nothing to do with wages and salaries.
But this is something that is not talked about a lot. Nope. It has pretty significant implications on the monetary impulse, as well as just how important the job market is. Coming up, we'll be talking about that. We'll also be talking about Black Friday, what they are seeing on the street. Joe Feldman of Telsey Advisories, he will be joining us coming up next.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Seen the unemployment rate starting to rise, and that could be an early sign that things are slowing down, and it could be quick, when things do slow down. But yeah, so far the data have just been incredibly resilient.
Veronica Clark, economist at Citigroup, talking about why rates could stay higher for longer, and just again, why betting against the American consumer has been a failing proposition repeatedly over the past couple of years. We have gotten some spies out there in the stores looking around. We saw Macy's on the floor. It looked like there were some people there. Joining us to give us his review of the scene from White Plains, Joe Feldman, Senior Research Analyst and Assistant Director of Research at Telsey Advisory Group. This is sort of the tradition. You wake up early, I assume, and you go out to see what's going on in the different stores. Can you just give us a rundown of what your first take is this year?
Yeah, so I did get up early, as you said, part of the tradition, and it was very quiet out there. I was in a Best Buy and a Target so far. Not too many stores are open yet. Best Buy, Target, Dick's Sporting Goods were all open around 6 a.m., and the traffic is light. They're all ready for the Black Friday day. They're well-stocked, the signage was great, a lot of employees in the store, just not a lot of people yet. And I think that's because you can get a lot of the goods and those prices earlier. I mean, you could have gotten it yesterday online. You could have gotten it the past week, really. At a lot of these stores, they started their Black Friday sales much earlier than we've seen in the past. And I think that's, just elongating the season and also less of a rush to get out first thing in the morning for that doorbuster.
Joe, I want to really key in on this idea that many of the retailers are not open yet, because my recollection is over the last couple of years, we were extending the opening hours among retail. We had a lot of retailers even opening a few years ago on Thanksgiving as opposed to waiting to open early on Black Friday. What's the change here? Is it really just the overall extension of the season and the advent of online retail as a really critical component of our shopping strategy? Or is there a labor component to this? Is there something to do with lack of labor, lack of available labor, and also some pushback from labor as to what they're willing to do?
I think that's a great point, because I do think that labor is a component here, where, the retailers have decided that, look, given the volumes that they've seen in the past couple of years, and maybe it's better to treat their employees better and, maybe not have everybody out at midnight on Black Friday, or even, at the end, 6 p.m. on Thanksgiving, like we saw several years ago. Where the traffic into the stores just wasn't enough to warrant A, spending on the labor, and B, giving labor a break and giving the store employees a chance to rest and enjoy the holiday with their families and then come in refreshed for the next day. I do think that by elongating the season, that helped alleviate some of that stress and puts less emphasis on just this Black Friday alone. I do think we're going to see a pretty decent day in the malls later and out in the stores, and for the whole weekend. But again, it's just a longer period that we're seeing.
Okay, so a decent day today, a decent weekend potentially. What does that mean for that longer period? What are you expecting for holiday sales? We had a pretty good conversation with Wells Fargo earlier this morning. They're looking at 5% retail sales growth, which frankly doesn't sound too bad given long-term average pace of sales growth this time of year is about 4. That sounds pretty decent, pretty optimistic. What are you at Telsey Group thinking?
Yeah, the 5% seems a little bit optimistic, but we've seen quite a few people with, estimates somewhere in that 3 to 5% area. At Telsey Advisory Group, our formal estimate is 3.5 to 4%. We did it two ways. We looked at it bottom up, just like looking at all the forecasts for the companies. We also looked at it top down, just looking at the macro data of all the U.S. government retail sales. 3.5%, 4%. We felt like, as you said, that 4% or so is kind of the long-term average, and it feels like this is going to be a bit more of a normal year like that.
So, Joe, I got to be honest, the main topic of discussion at my household for Thanksgiving was generative AI and how it's going to transform our world. I know it sounds like a scintillating holiday discussion, but I'm curious from your vantage point.
Lisa has a particularly nerdy house.
100%. It's okay. I embrace it, but I'm curious, how much that's changing the way people shop. I mean, given the fact that a third of people, respondents to the survey that I was reading, are using some generative AI to figure out how to shop. I mean, how is this shifting the way that some of these companies really try to cater to their customers?
So I think the retailers are starting to embrace it. It still feels very early for it, though. And the quality of the generative AI, the responses you get is somewhat mixed. But the retailers are working aggressively to try to help, do things more efficiently for their own organizations and also serve the customer better. If you think about the chatbots that you get when you go online, or, maybe if the large language model generative AI have more natural responses and better quality responses. I think that's coming. It's not quite here yet, but people are embracing it. And I think that the retailers are all trying to get there. But it's really, I think, a couple of years away before we're going to see a major impact from it.
Although, if you take it a step further, Joe, there was something else, just sort of in the catastrophic realm of talk, which is also, it makes dinners really exciting. I'm curious about, what this means for the employment picture. We're talking about labor, and it's actually very much connected to what you were just talking about with Gina. You don't have to pay a robot to work during the holidays. How much is there this feeling of, cash registers that are self-checkout, different programs that can do personal shopping for you? I mean, there's an evolution to this that can really cut back some of the base costs for these retailers. How much are we seeing that in the stores at this point?
At this point, I think it's still relatively low because of that particular technology, generative AI. But I do think that we have seen technology reduce costs for retailers, make them run more efficiently. We've seen, as you mentioned, automated self-checkout or assisted self-checkout now. You can have one person manning 5 or 6 registers at the same time. It's a lot more efficient, and then you can get people onto the floor to help the customers. You can stock the aisles better. So there's a lot that you can do. And then on the back end, just on the supply chain side, there's so much you can do. Now, retailers have been embracing AI and machine learning for years. The generative part is where it's new, and that's still yet to come. And, my understanding is a lot of the retailers, they're still staffing up. They still need the people to even be able to harness it, and the data, the software engineers to really write the code and to really embrace it. And, I do think there's an important element here where people are so crucial to the system, because it does create those jobs for people, maybe more skilled labor on the software engineering side. Also, within the store, you still want customer-facing people. You still want people to help the customer. And so I think it just changes the tasks for labor within the store rather than necessarily cut labor too thin.
Joe, can we talk a little bit about the broader competitive landscape for a retailer right now? Because I'm struck by this idea that consumers are still very focused on experiences, on spending on services, on going to restaurants. How are retailers thinking about not just their competition with their fellow retail, but their general competition for consumer dollars in an environment where consumers are clearly preferring to go and spend on services relative to goods?
Yeah, I think the retailers are doing two things. One is they're trying to create a more exciting environment and more of an experience itself within the store, or if you're shopping online, have a more efficient experience, a better, fun experience, one of discovery, treasure hunt to some extent at some stores. The other part is innovation. Whenever we see innovation in product, whether it's apparel, furnishings or electronics, the consumer tends to respond. And so, when we have had that innovation, the consumer responds. We're trying to push innovation a bit more from the retail side. But I do think the retailers have been very prudent in their outlook, understanding that services spending is still, recovering actually from where, to get back to even pre-pandemic levels. So we're not fully there yet. So I think the assumption is that you will see continued spending on services. The retailers are just trying to find a way to create exciting merchandise to get people to buy that at the same time. And that's also why I think we're going to see a decent holiday season, because the consumer has money. They're just spending in different pockets right now. And I think that selective or choiceful spending, as some have said, is really where you can see that shift. Now the time is, the holiday season, gift giving. I think that's where you're going to see that shift back. Maybe come first quarter, winter, people want to get away. Travel starts to happen again with school breaks in the February, March time period.
Joe Feldman, thank you so much for being with us. Happy holidays. Joe Feldman of Telsey Advisory Group, thank you for being with us. I got to say, Gina, I'm not the best person to really talk about the sort of buying of stuff, because I'd be completely ascetic if I could. But there's sort of the question of how many people are sort of locked into homes that are smaller than what they need. They can't leave, so they don't want to buy more stuff to fill it. I'm just saying, theoretically, that could be something going on.
No, I think that's really interesting. The other aspect is higher interest rates generally impact goods spending a lot more than they impact services spending. You get higher interest rates, you tend to finance a lot of these heavy durable goods purchases. You're less likely to do that when it costs you so much more.
Yeah, coming up, we're going to be speaking with Michael Purvis of Taubeck and Advisory Group as we parse out what exactly retailers are doing on this Black Friday.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, a significant challenge that we are confronting, and my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
from the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
The holiday rally is certainly very much in force.
It's an environment where equities, are expensive, and wages are growing, corporate profits are okay, but everything is priced in.
The economy overall is still doing well. Less and less calls for a recession during 2024.
I don't think this ends in a soft landing. It's either a harder landing or you're just stuck at too high inflation.
Certainly, I think we're going to be entering 2024 on a substantially weaker footing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
5 hours until the end of the trading day for stocks in the U.S. Not that any of us are counting. Welcome back. Good morning. This is Bloomberg Surveillance Live on Bloomberg Television and Radio. Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Tom and John enjoying a very well-deserved day off. I am thankful for them. I am also very thankful to Gina Martin-Adams, who is here beside me on this post-Thanksgiving day, parsing through all of the retail glory that is the tradition on Black Friday. What are you looking for? I mean, how important is it to really understand this from a specific day point of view versus just sort of taking stock of where the consumer is?
I think it's one day in an overall season. Frankly, right now I'm watching inflation expectations as the more important indicator because retail sales peaked all the way back in 2021. So we're looking at a consumer that's already done some adjusting to the higher interest rate environment. I think it's probably at this point a little bit more important to watch services spending. So how much they spend on travel to go see family, how much they spend at restaurants is also incredibly important. That said, obviously no one wants to see the consumer completely turn over here. So we need to see at least some degree of stability over the course of the fourth quarter at large. And Black Friday is clearly a key component of that.
What proportion do you think of U.S. workers in the financial sector are in the office today at work?
Oh gosh, it's got to be. What do you think? Maybe 10%?
Maybe. I would guess probably less than that.
Yeah,
a lot of people working from home, and otherwise, I mean, it just feels like there's just this sort of, put it on auto trade if you need to, and trigger if you call my cell if you need me.
Absolutely. And I think there's very few people trading at all, even from their basement. On a day like today, the volume is going to be limited. Volatility will likely be interesting, but not what it normally is on an average trading day.
You pointed out the University of Michigan sentiment survey and how it came out with inflation expectations that were higher than expected. And we've been talking a lot about the cumulative inflation, and yet I do wonder where it's coming from. I'm really looking forward coming up at 8:45 a.m. Eastern, talking with Justin Wolfers about how there are a lot of sectors where prices are actually going down, where things are cheaper, and yet it's not really factoring into the way that people feel.
Yeah, you've brought up on a number of occasions housing prices and the cost of housing, the cost of rent, the cost of housing is a key part of the consumer psychology with respect to inflation that doesn't typically get covered as a component of inflation. We all think about retail sales as sort of the primary proxy for what is the consumer doing, how is the consumer behaving, but that's really only a portion of the story. What are they doing with their houses? They're stuck in them. They're stuck in them at high prices. That's great for wealth, for those that own the houses. It's not great for the consumers who are thinking about getting into houses, and they see an endless price increase in their future.
Well, we are going to be speaking with Justin Wolfers, I'd correct myself, at 8:15 a.m., so just coming up. Right now, coming up in markets, you can see that quiet, that lack of engagement that we were talking about in a lack of action. The S&P futures basically going nowhere, up 0.05%, basically flat. We're looking at a bit of euro strength, although really, again, no drama. The real drama of today, and I would say if it is drama, would be the 10-year yield, 4.47% rounded up more than 6 basis points. We're talking about what's happening with the University of Michigan survey. We're also talking about Germany and the possibility of issuing more debt or allowing them to continue this issuance, not having to go back to net zero issuance or net zero addition to their debt pile. To me, that's interesting. It sort of speaks to this ongoing fiscal stimulus regardless of the inflationary backdrop.
Yeah, and ongoing fiscal stimulus is generally perceived as quite inflationary, right? So it's contributing to the inflationary psychology that fiscal governments are or fiscal spending is unable to pull back in the environment that we're in, even though we're technically in recovery. There has been no recession declared. The fiscal expenditure is still enormously high, and a lot of question marks as to how we're going to pay for that fiscal expenditure. Once you get started spending, how do you cut it back, and how do you pay for it? Because we fund it via debt.
Yeah, and this is a reason why it's been so difficult to come up with any kind of forward-looking projections, which is why we're going to bring on Michael Purvis, Talbot Advisors founder and CEO, to try to come up with some projections and a way to shape how to think is heading into the next year. I'm wondering with this holiday pause, if we are looking at a holiday rally that does have legs, but that leads to perhaps a reassessment come beginning of 2024.
Yeah, I mean, my working framework right now is that we will get a continuation of what we've seen and sort of the sprint to the year end. I think there's a lot of seasonal patterns at work. You know, if you go back, I went back to 1928 and you look at how if the market is up more than 10% coming into Q4, more often than not, the market is up nicely into year end. There was a couple of notable exceptions when that wasn't the case, 1929 and 1987. But putting those sort of very specific situations aside, you've got seasonals. But then, you know, coming into November, what did you really need to check the box for that bullish sprint? You needed stabilization in rates. You can check that box, at least for now. You needed a decent to pretty good earnings season, and you could check that box. There, and on top of that, you've got the dollar strength has now kind of rolled over here, and that's softened the financial conditions, which are getting pretty stressed in October. So, yeah, I think there's a lot of flows coming into the markets into year end. You know, do we get to 4,700? I think that's certainly on the table. 4,800 seems like a stretch, but you never know. You can have some crazy stuff happening in December. With all that said, if we do get those levels, I think you're going to get a pretty reasonable hangover in January and February, where I would be advocating legging into protection, you know, as the market climbs there. Because I think as we look forwards into 2024, I think one of the things is that I'm not particularly bearish on the markets or on the economy, but I think the expectation of soaring earnings growth and that upside surprise factor that we had this year is just not on the cards there. And I do think that there's some, you know, definite evidence of that nominal GDP is going to be lower, and that's going to probably mean some of the earnings expectations, particularly in cyclical value, are not going to be quite as good as many expect right now.
Okay, Michael, so we're talking about a potentially poor start to 2024. What will that mean for the rest of the year? Do you expect those negative estimate revisions to play out just in the first quarter, and then we normalize into the latter parts of 2024, or is this the beginning of something a little bit more nefarious?
No, I don't think it's the beginning of anything more nefarious. I think probably the downside case is more of a range-bound equity condition next year, where we're sort of up and down and sideways as we're going through multiple sort of regime adjustments there. And on the earnings side, you know, I'm not on that. You know, I don't see a real recession here. What I do see is a low velocity degradation in growth from what we have known over the course of this summer here, and that's going to reflect in some earnings, and of course, you know, the Magnificent Seven and you know the big tech earnings of less economic sensitivity, or classic economic sensitivity anyway. There, and I think that's a very important pillar of, you know, overall index earnings there, and I think that's going to probably be reasonably decent next year. So the question is I think bottoms up consensus for next year is compiled by Bloomberg is about 12% year-over-year earnings growth. I'm sort of coming out more like sort of a 5, 6, 7% earnings growth number, and I think the markets will have to sort of ultimately adjust to that. And then, of course, there's, you know, what PE do you want to pay for that type of growth into next year as we sort of, you know, get into a lower nominal world.
What's the pain trade, Michael? And I ask this because that's what seems to play out every single year, is that we come up with a consensus, and then whatever you can imagine the biggest pain trade happening, that's what happens. So what is it this year?
Oh, this year meaning the
heading
rest of
into
this
2024.
year?
Yeah, heading into 2024.
Okay. Well, you know, that's a good question. I think right now, I don't know if this is exactly a pain trade, but I think a lot of people have thought that oh my God, the Treasury sell-off on the back end is over. And And I don't think it is. I think there's a lot of evidence to suggest that term premium is going to be, it sort of shot up, in September and October, and it retraced all that. And I think a lot of that was a function of very aggressive trading and positioning, closing out trades. But I think the broader theme here is that, if you look at the Fed's calculation of term premium, the ACM term premium, it went negative from like 2018 on, and then, this year it sort of started really coming back into positive territory. And now it's back down to zero-ish. I think what's happening here is global central banks are retreating from ultra-dovish central policies here. I think that's structural. I think that's going to continue at pace. You were just talking about Germany increasing supply. I think there's a supply condition that's only going to exacerbate term premium. And I think, could we get to, a 10-year back to 5 and maybe even 5.25? I think absolutely is one of those cases. So I think the worst is over for the back end of the Treasury curve. I'm not on that page, and I think there could be, sort of another move higher in the back end of the Treasury curve.
Michael Purvis, thank you so much for being with us, and happy holidays, happy Thanksgiving, happy Black Friday. Michael Purvis of Talbot, and we appreciate that. Interesting that he is talking about that basically there's this pain trade of a stickier inflation and benchmark long-term yields that go up. And honestly, I've heard that from an increasing number of people with low conviction, right? Because we just don't know. But that would be pretty painful for both bonds as well as in stocks.
Yeah, the stocks, guaranteed, stocks are not going to like it if the 10-year Treasury goes back above 5%. That move from 4 to 5 was incredibly painful in equities. I know that we tend to dismiss it because we've had a nice little bounce on the other side of that, but it was very, very difficult and entirely responsible for the equity meltdown that we saw in the third quarter of this year. So anything above 5 would certainly shock the equity market, and not in a good way, particularly as we're weakening a little bit in terms of the earnings outlook. We see the same as Michael in that estimate revision probably has to move a touch lower into earlier next year. If you have negative estimate revision at the same time as yields are going higher, that's going to be painful and create a lot of volatility.
Which maybe is what some people were hedged for and are getting squeezed out of that as it doesn't come to pass. If you are just joining the program, we are seeing a market that is quiet, as you would expect. We are seeing bonds yields go a bit higher. Bond prices fall. You can either attribute that to what we saw over in Germany or what you saw with respect to the University of Michigan sentiment survey. S&P futures up about 0.1%, 45.71. But what you would bring up is a really interesting point, and I do wonder your vantage point here, Gina. One thing Tom talks about all the time is that inflation is actually really good for earnings.
Okay.
And that on a nominal level, you see more money coming in.
Yeah.
Doesn't matter whether it's on bigger volume sales or whatever. You're starting to see that around the margins with Deere, for example. Prices going down, and that was affecting their top line. How much is sticky inflation a bad thing for equities versus a good thing?
It is a sector and industry specific story because it depends upon where the inflation is coming from. In an environment where inflation was truly based upon supply constraints. Demand was holding up, but supply constraints were driving the inflation. Goods-centric industries that have to contend with inventory uncertainty are generally pressured most. In an environment where oil prices are surging higher, that again points to retailers as most likely to experience weakness in an environment where oil prices are surging. The inflation that we're having today is very different than the inflation that we were having a year and 2 years ago, in that inflation is potentially more embedded and potentially changing psychology, but not necessarily based upon supply chain constraints and weaknesses in the geopolitical environment. So I do think you have to be really careful about it. It's just not the same. Over the course of the equity market, we can't really paint it with one big brush. The fact that energy prices have come back a little bit is a big support to equities at large. But at the same time, you're seeing a lot of consumer companies suggest their net sales volumes are contracting or weakening here.
They are, however, traveling, and we will be speaking about that coming up later. But coming up now, Justin Wolfers, economics professor at the University of Michigan, breaking down the price of yesterday's Thanksgiving meal and kind of how this speaks into sentiment, where inflation matters most for people.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Could face bigger challenges next.
It was going to keep rate World Cup. This is a 3.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
The economy overall is still doing well. Less and less calls for a recession during 2024. As long as we have that, real rates will stay high because that's the counterbalance to the economy doing well. So highest conviction trade is no eases, Fed on hold till at least after the election.
A very counter-consensus call from Earl Davis of BMO Global Asset Management last week. We were taking a look at how that is something that people call the pain trade. Michael Purvis just speaking with that as well. We are seeing in markets a very quiet day, really early close to the U.S. trading day. A lot of people are not in the office. You are seeing basically no movement on the S&P, giving back some of the earlier gains. But again, no drama. The big drama to me is that 10-year yields are up almost 7 basis points, 4.47%. As people parse through whether you could see a stickier inflation, whether you are going to see more issuance globally in developed markets, and whether the Fed it might be done raising rates but aren't going to drop them anytime soon. We're also talking about what to make with your leftovers for Thanksgiving, including the money that you have left over after what we saw for Thanksgiving, Black Friday. Justin Wolfers, professor of economics at the University of Michigan, taking a look at Thanksgiving disinflation, saying, well, the cost of living is up and consumer perception is that everything is more expensive. The price of your holiday dinner actually fell from a year ago. The price of turkey down more than 5%, stuffing down almost 3%, cranberries down 18%. Pumpkin pie lovers, though, that price up almost 4%. I did make a pumpkin pie, and actually I did notice that. Justin joining us now. Justin, it's interesting that you put this out. It seems like, yes, it is interesting just on the face level of Thanksgiving, but there's a deeper message here about kind of where there is disinflation and how that isn't necessarily showing up in consumer sentiment. What's your take on that?
Lisa, I'm glad you saw the deeper message. Look, the deeper message was almost a form of performance art. I pretended to care about these individual prices. The reality is, if you want to track the cost of living, what you need to do is go and visit hundreds of supermarkets from dozens of cities and sample thousands of goods and have very sophisticated computers to put it all together. And thank goodness we have someone who does that for us called the BLS. And instead what we get every year, and basically every news cycle, is some interest group or one side of the political spectrum or another will pretend to obsess and pretend to care about things like the price of turkeys. And actually the graphic you just showed, I think, was a beautiful teaching point, because it's always the case that whether inflation's 2% or whether it's 4%, that there's a bunch of stuff going up a fair bit. And right there you've got like, oh, that pumpkin pie mix, and I noticed bread rolls are a little bit more expensive too. And you've got a bunch of stuff going down, like the price of fresh cranberries. Turkey prices are plummeting because, the bird flu's a bit behind us. And so trying to tell the story of the whole economy through graphics like this, and I'm not having a go at Bloomberg because you were honest about it, Lisa, but often the major cable networks are not, is an absurd way of trying to track the macro economy. Let's focus on the data instead.
Justin, you correctly note that also airline costs are going down. So the cost of services is intriguingly going down year over year, on top of the cost of goods going down. In that kind of environment where we are seeing generally prices at least rationalizing from a sky-high pace of inflation over the last couple of years, why are consumers telling us that they're expecting more inflation going forward?
Well, I think the simplest model of what's going through consumers' minds, they're not running sophisticated models of the form that you are or that your viewers might be. They're going to the store. And so generally, one of the best ways of predicting inflation is whatever's currently happening is going to continue to happen. And all the rest of the other stuff, what's going on with import prices or oil prices or the output gap, is just a slight modification of that. And consumers, of course, also are incredibly responsive to the most salient prices. The most salient prices obviously being gasoline, and I think beyond that, food. And so consumer inflation expectations tend to track those things a little bit too much. Now, the problem with this, of course, is what's not salient? Well, the cost of healthcare, the cost of education. But these things are a huge part of the consumer basket. The cost of housing as well. And so inflation expectations often, or perceptions, may not track reality particularly well at important points because we're a little bit too focused on what we see at the store and not what really matters.
So what do you think policymakers will focus on then, perceptions or reality?
Well, every policymaker I talk to gets told they should look at the darn data. Now, if you're talking about political policymakers, they've got two jobs. One is to figure out what's going on, and the other is to convince the electorate to re-elect them. Some of the genuinely silliest commentary we get on the economy, including and particularly on inflation, comes from congressional representatives, because they're always looking for the juiciest, least representative soundbite that helps their side the most. I worry that if you spend your whole time, all day, every day saying, for instance, Biden inflation has caused the price of dinner rolls to skyrocket, that you might eventually start to believe it. So I think those folks, I really do worry about their view on the economy. Now, I know Jay Powell and our friends at the Fed are a little more sophisticated. They're focusing on the real data. They've got folks poring over every line of those of the CPI, of the PCE, and so on. And I think they're telling pretty much the correct story, which is that inflation is moderating. There are good reasons to be optimistic it may moderate. One of the most notable things that has happened over the past year, really, is that Jay Powell has started to talk about inflation in terms of supply shocks. That's a real optimism that the bad times were due to supply and the supply shocks are behind us, which gives you a whole lot of reason to feel optimistic that the better times are ahead of us.
This sort of speaks to the whole immaculate disinflation idea, that it was just a supply shock right-siding itself, and that there was this transitory, it's sort of back to transitory without saying the T word, which they were pilloried for. How much are we now starting to see demand side pick up for that, especially with real wages actually turning positive in a more material way with how much inflation's coming in?
Well, what really matters for inflation is what's going on with nominal wages. What matters for your quality of life is, of course, real wages. And nominal wage growth has been, fairly moderate, not far off what would normally be consistent with 2% inflation, if you think about, inflation plus productivity. And I think now you've got to have inflation plus productivity plus a little bit of catch-up for real wages having not kept up for all of that time. So, I see every reason to feel optimistic. There's a deep question here. The big question you just asked, Lisa, is this about supply or is it about demand? But actually on the supply side, is it just a bad supply shock exiting the system? Or maybe are we actually on the cusp of a positive supply shock? Are we seeing productivity rise at levels we haven't seen before? Are we seeing the economy expand without generating inflation? And we are. That might be what's going on with the immaculate disinflation. And you might say, hey, what caused this positive supply shock? And I'm going to tell you, Lisa, I've never seen a 3-year period in my entire history as an economist in which I saw this many businesses reorganize what they did. We reorganized the economy at a really fundamental level, everything from work from home to supply chains to global shipping routes. And maybe, just maybe, that's pushed back the frontier of what's possible. And I'm optimistic that's possible, but I think perhaps more interestingly for your viewers, I'm definitely hearing a sense from Jay Powell and the Fed that they're starting to believe that maybe is what's happened.
Are you going to be shopping today, Justin?
Well, I've got a phone and I've got 2 thumbs and I've got a really big wish list, so sure.
Well, good luck with all of that. Justin Wolfers, come back again. We love having you on. Justin Wolfers of the University of Michigan, thank you and have a wonderful holiday. What he was saying there, Gina, fascinating to me. This idea that it is this sort of increase in productivity that people are kind of talking about on the margins, don't want to get too confident about, but that really this is the reason why we were talking about generative AI last night, how much that's the same game changer that the internet was, and how that's transforming things in real times in ways that we really can't quite fathom yet.
Yeah, and it's the next iteration after the pandemic really kicked off a whole adjustment in the business sector to a completely new reality, an adjustment in terms of their labor exposure, an adjustment in terms of their supply chains. And as he was talking, it really did strike me that when we're looking inside the profit stream for the S&P 500, we should be paying a lot more attention to productivity. Margins gave us the clue that we were going to see a pretty big dip in 2022, despite the fact that the economy seemed kind of fine, for lack of a more sophisticated word. So margins could be the really big story. If margins continue to improve, that's a reflection of those major shifts in business practices and productivity growth.
Yeah, I question how much people are more productive when they stay home. I'm just wondering. I don't know. I've seen a lot of studies in this, and it's controversial, and I don't know. I hear a lot of executives saying, come back to the office. Coming up, Anna Stupnitsky of Fidelity International as we parse through the holiday rally and what's to come after that.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment case for this in the world.
Some people might say that insurance is a boring business, but is that not the case?
No, I find it very interesting. I mean, you're not doing the same thing all the time. I liked it because it had a balance of doing different things at once.
hour to the start of trading day, we can see a bit of quiet across the board as people reset after a tremendous November rally. The biggest rally that we've had all year. We could look at the S&P up more than 8% so far just this month. I love the comment earlier this week. What a great year it's been for November, because that's sort of how it feels. Gina Martin Adams alongside me here today, but honestly, that's what it feels like. This was a tremendous rally that nobody was expecting.
Yeah, especially after things, the floor appeared to fall out for the S&P 500 as well as the Russell 2000. By the end of October, we were looking at really breaking through pretty critical resistant levels, but I guess you'd call this a classic technical oopsie, because all of a sudden we rallied right back up, proving those resistance levels to be new support. You know, I think this is fascinating just to see how rapidly things turned around.
And how much we could have been looking at a very different projection for what to expect next year had we not had November, because it could have been the year-end targets for next year, which some people have been projecting, of 4,600.
Right. It puts all these equity strategists in quite a difficult position. And I have the privilege of being able to relate to that, given that it was my former life, where suddenly the prices surged to your 2024 year-end price target within the last 2 months of the year, because you get this nice seasonal lift. It creates a really tough outlook for the beginning of the next year.
So what do you do with that?
Yeah. Well, I think that most of us have some degree of fundamental models, right? And, you know, you migrate with the data. And if the data is proving to the case for a renewed sense of optimism, then so be it. If it's merely a technical correction and people are sort of jumping on board, it's sentiment-based. And so you've got to balance the risks of sentiment versus what's truly happening with fundamentals.
Fundamentals really are driven also by consumer spending, which is the reason why Black Friday is taking on a particular importance this particular season. And earlier this morning, our own Caroline Hyde was speaking to Macy's CEO Jeff Gennett from their flagship store in New York City in Herald Square. She started by asking him about today's kickoff to the holiday shopping season.
We've got great deals, as we always do for Black Friday, going all the way through the holiday season. So we are ready. We've got all of our key items, you know, loaded to bear. Here we are in Herald Square. It was a good opening. We had a great day online yesterday during Thanksgiving.
I mean, you said that on your earnings, which were, about a week ago.
Yes.
That this gets earlier and earlier.
It does.
Black Friday, the competition. How important are the next few days and the run-up to the holidays?
Oh, it's still very important. So, you know, when you think about kind of Black Friday deals really started it right after Halloween is when they started. But this is still a pilgrimage. You've got, you know, America is traveling, and they are in homes, and they're coming into stores just like this one today. They're online. They've been online all the way through. So it's very, very important. So when we look at kind of Black Friday through Cyber Week, then we go into a lull. It's like 10 days where people kind of reset, and then those last 10 days become increasingly important. So it's one of the 3 stages right now that we are of the kind of the Christmas shopping is the one we're in right now, the first.
What, of course, your earnings showed so clearly is that it's about inventory management in many ways at the moment, and you've been managing to ace that. How are you ensuring you got the right thing in the right time for a consumer that basically we're all trying to understand right now?
So obviously the consumer's under pressure, but they still love gifts. And so we want to make sure that we've got all the right gifts and we've got all the right stock content in them. So I just walked this entire store to really understand where we are in all of the content across all of our categories, and we're in great shape. And that's really in tribute to the amount of work we've been putting in inventory control.
And when it comes to online versus in-store, in retail, this is how you've been shifting the company. In particular, people aren't perhaps having the footfall in malls. They're coming to one-off stores. They're going to smaller store experiences. But e-commerce has just been the focus. How are you managing to be at the right time in the right place for an omni-channel purchaser?
So really, the strength of Macy's and Bloomingdale's and Bluemercury is that we're omni-channel and we're omni-category. So what you have is you have customers that are shopping online. They want to come into a store and try it on, and they maybe are transacting on the couch later that night. So the opportunity to make it as convenient for the customer as possible, however and whenever they want to shop. So that's our beauty, and doing that with a national footprint, with a great website, is what we depend on.
And of course, why you've got such a great bird's eye perspective, because you do have Bloomingdale's for the higher end, more luxury purchaser, and then more income breadth when it comes to Macy's. What are we seeing in terms of the consumer? Are they going to be spending more? Are they going to be pulling back?
So you do have customers that are under pressure. And so when you think about the inflation is still high, it's abating from the change of the inflation rate from last year, but it's still higher than it was last year. And customers have got a limited budget. Some of it is they're spending it in experiences and then in our discretionary categories. So we want to make sure that we've got the right price points across that entire spectrum. But you still give gifts. And this is where Macy's and Bloomingdale's and Bluemercury shine. So when you have this gift, somebody on your gift list, we're going to have the right content for you at the right price point. And we spend from when Black Friday bands to where we are right now. We've been spending a year getting ready for that. And we do trial runs on Valentine's Day, Mother's Day, Father's Day to make sure we've got the right gifts. We're ready.
That was Bloomberg's Caroline Hyde with Macy's CEO Jeff Gannett saying it's all about the gifts, and whatever it is, we are prepared for those holidays, which raises a question of how people can be so pessimistic. I mean, on one hand, you've got a lot of the executives who are going to argue for their case that people are going to keep spending. On the flip side, we have seen delinquency has been rising, and this pullback around the margins, different kinds of outlooks that have been quite negative from the likes of Walmart. How do you put it together and come up with what we expect next year? Anna Stupnitska, global macroeconomist at Fidelity International, joining us now. And I want to start there because you're calling for a cyclical recession next year. What is that, especially in light of the fact that consumers are still spending and likely to continue doing so?
Hi, Lisa. Yes, cyclical recession is where growth slows down, but relatively modestly. So we do expect 2 or 3 quarters of negative growth, which is a recession, and then a steady recovery. So it's not a very deep recession, but nevertheless, a slowdown across the board. And this tightening that we have seen from the Fed is still working its way through the system. And we believe that the transmission mechanism is just delayed. And we are very close to the tipping point where we're starting to see more forceful transmission across the board, consumers and in the corporate sector in the US specifically. And that's why we think cyclical recession is the story for 24.
Anna, can you talk a little bit more about how that cyclical recession is comprised? And by that I mean, are you looking at, when you say across the board, are you looking at declines in consumption as well as fiscal investment, as well as business investment, as well as net exports? What is the composition of that deceleration? If it is indeed relatively light, where are the bigger risks versus the lesser risks?
Well, I think on the external side, it depends on the cycle, and a lot depends on China and emerging markets more generally and what demand does there. But domestically, we do expect a slowdown in consumer spending and some slowdown in investment. Also, support on the fiscal side is going to be much less than what we have seen this year. So yes, it's across the board, but where we think that the particular weakness might lie is in the corporate sector. As we know, the debt burden is very high, and those maturity walls are high in 24, yet high in 25, and that refinancing burden might lead to, or will lead to, that weakness across the board within corporates.
And would you see that to be an international trend? For instance, clearly developed markets have some weak times ahead when it comes to refinancing. But is this also the case within the emerging market landscape?
This is more for the developed markets, and in Europe, this refinancing, this maturity walls are much higher. Much steeper than in the US as we enter 24. And in fact, Europe is already approaching a recession. Germany is probably in recession, and the whole of the euro area is stagnating. And this is where we have seen, indeed, forceful transmission across the board. And the US will, to some extent, follow that sort of pattern, but later in 24. On the other hand, we think some emerging markets can still do relatively well in that environment, show that resilience. But as you know, a lot depends on the China cycle and how much policy support we'll see there.
Do you think the U.S. is still the sort of cleanest shirt in a dirty laundry bin, or whatever kind of analogy you want to put out there? Or do you think that it's going to shift away from the U.S.?
In terms of the growth,
opportunities,
drivers, where the opportunities. Yeah, I think again the global cycle has diverged to some extent. Has not been very in sync this year. As I said, Europe is already going into recession. The UK is probably there already. The US is probably still a few months away. And China is stabilizing. We're seeing that stabilization. And in fact, our base case for next year is what we call control stabilization. So just enough policy support to put the flow under the property market, just enough policy support to get consumption going there. And so that growth coming out from China, from emerging markets, can to some extent offset that slowdown, that recession that we're expecting in the developed world.
Anna Stupnitska of Fidelity International, thank you so much. Really appreciate you taking time, and have a wonderful weekend. We are looking at sort of these diverging fates of the different countries, to me, which I find fascinating, because some people were expecting Europe to actually outperform the U.S. to come out of this earlier. Now it seems like people aren't sure what to make of what. I mean, honestly, I'm not feeling any cohesion in the divergent story.
And remember, back in the days when we used to use the words global synchronization, synchronized recovery, synchronized recession, those are gone. Those words are over. We are in a completely different environment, especially because of what happened in 2022 when China shut down and the rest of the world started emerging. I think that's creating a lot of differentials in the cyclical story. There's also differentials for the more tech-exposed economies versus the less tech-exposed, the tech producers of the world generally benefiting from this AI and CapEx wave. And then you've got the commodity producers of the world, which has probably been the biggest undercovered story of 2022, 2023. Commodity producers had a bang-out growth year in 2022. They've had a real struggle in 2023, and that is a big fundamental shift when you look at underlying corporate earnings trends.
You, though, said something earlier that I thought was fascinating, which was that China might outperform in a more material way. And this might be the biggest surprise of 2024 because of just how underestimated it is. Where are the signs going to come from? Is this from consumer spending? Is this going to be from businesses reemerging and going back into China and getting faith that the policy is going to be consistent?
Yeah. So this is my pain trade. You asked someone else the pain trade. I think the pain trade of 2024 probably is upside out of China because expectations are so incredibly low. And it comes from a couple of different things starting to work together. The first really was signaled over the last week when finally President Biden and President Xi are actually talking. To have some talks emerge between the U.S. and China and positive potential talks for the first time really since 2018 is a huge potential benefit that we need to watch really carefully. So I think any sort of resolution of geopolitical tension will be really, really important. We still have to overcome the tech hurdle. There's a great desire on the part of both countries to be the tech leaders in the world. How will that resolve itself over time? But then thirdly, and you pointed this out earlier, the idea that China may come in and start to support its property sector en masse may actually produce some domestic sort of stimulus over the course of next year is something to watch as well to really reverse that psychology.
We seem to get a bit of that overnight. If you are just joining the program, we do see at least not a negative drag on the market ahead of the open, but really not much of anything. 45.68, everyone's still in bed. Tryptophan spurred naps that last longer than expected. 447.63 on the 10-year. This to me is what I'm watching. Yields up about 7 basis points, grinding higher throughout the morning. To me, that really is going to be the story, right? It's sort of how much are we going to see the glut of issuance that Germany, that the U.S., that the rest of the world is being forced to issue, including China. Right? They were deleveraging. They're basically going to have to reverse that in some capacity if they really want to stimulate in a more material way. How much does that create kind of a sticking point, a headwind that does lead to these higher yields lasting for a bit longer?
Yeah, and ultimately, how much does it delay or restrain the potential growth on the part of the corporate sector as well? Because you think about the second derivative impact of fiscal governments having to really think about how they fund their debt is, we might have tax increases across the board. Will we have a reversal in tax? Will we see tax increases, corporate tax increases? We're already seeing in the U.S. specifically tax expense accelerate for corporates. It's something that we talked about a lot this fall that I feel is getting overlooked. We're going to have to fund this somehow. How much of it is going to get funded out of the private sector is a really important question.
We're also going to be talking about coming up the inflation of points that you might earn at different companies. I'm serious. This is actually a big theme of mine, is basically use your points now because they're probably going to be worth a lot less later on. I'm just saying, I'm going to check that, gut check that with Brian Kelly, founder of The Points Guy. That's coming up next.
The reception, the acceptance of Puro has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Puro all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
We're seeing that more normalized travel pattern in the domestic market. I think what you're going to see internationally is increased capacity because that's where the demand was. So you'll see fares coming down, especially in the North Atlantic and the Caribbean, Mexico as well. Those are three of the biggest markets where we see declines.
That was Helene Becker, TD Cowen research analyst, focusing on the airline industry. Always wonderful to hear from her. We are going to speak more about the travel plans that everyone has, and it has been a very active travel season for this holiday, this Thanksgiving. I do want to first just go over a couple of stocks that are moving that are pretty interesting to me, including the maker of the Roomba device that will clean up after your Thanksgiving meal, and you could set it about your house to suck up all of the dust that all of your guests tracked in. Up 30%, not because people are going out to buy Roombas, but because Reuters is reporting that Amazon is set to win unconditional EU antitrust approval for its acquisition of this company, which raises this real question. So if John were here, he would say, I don't want that thing tracking all of my data and then transmitting it to Amazon, but it does raise questions about what exactly it's collecting as it goes around with all the dust.
Oh, this is a really good point, actually. But if he has an Alexa, he's already doing this. So,
he does have an Alexa, I know.
You know, it's hard to say whether or not, but you know, it is a little bit freaky. This is something that came up at my Thanksgiving dinner, is how much when you're speaking about an issue, all of a sudden you get emails about that issue on your telephone, and maybe we haven't even given permission for this to happen. Maybe we have, but this is just another aspect of the tech companies taking over our lives.
Oh, the concept of what you can do with that data is definitely going to be fascinating. The application of artificial intelligence, but really it's the hardware that's captured everyone's attention. I also want to take a look at NVIDIA. Shares down about 1.6% after rising a bajillion% so far this year. This comes after Reuters reporting that it told customers in China it's delaying the launch of a new artificial intelligence chip until the first quarter. To me, it's more interesting that it's down 0.6%. Basically, people just kind of shrugging. It's like, okay, I guess we can take profits for the moment into the holiday. Talking about taking profits, this is really an exciting conversation for me because I have been on a kick that if you don't spend your points now, you're going to lose them. And we've been point savers. Very much so when it comes to airlines, when it comes to hotels. You save them and you save them, you save them, and it feels good. But it doesn't really. Brian Kelly is here to explain why it's a terrible idea to do what I have done for so long. Founder of The Points Guy. Let's talk about points inflation. How real is it?
Well, Lisa, you're not a point saver, you're a points hoarder. And so many Americans are as well. You know, we get anxiety when it comes time to redeem them. It looks really nice to have a lot of points. But here, listen to me, everyone out there, use your points. You know, the airlines have officially become banks. You know, a lot of airlines are making more money selling their miles to credit card companies than they are by flying planes, which means there's more and more miles in the ecosystem, and the amount of miles it takes to travel is real. In fact, Southwest Airlines just announced in 2024, their points are going to be worth less when you redeem them. So key message, use your points now. Take that cold hard cash that you would have spent on the travel and put it towards other things.
I feel like I have to do some kind of, hi, my name is Lisa Abramowitz, and I'm a points hoarder. I would like to improve my standing in the world. Brian, how much are you seeing companies have to offer perks, have to offer something to really induce customers to come in, especially as you're starting to see discounts to airline prices and hotel prices, given people have traveled all they want, and now they're kind of pulling back a little bit?
Yeah, this is actually really good news for consumers, because I feel like for the last 3 years, every time I came on and did segments, it was bad news. Rising airfare. Airfare at one point was raising 20% month over month, and we thought like 6 or 7% inflation was bad. So travelers have been hit the hardest. Finally, we're seeing a reprieve in those fares. And the airlines getting hit the worst are the budget, domestic carriers, because there's still huge demand for international. International airfares, especially in business and first class, are through the roof. It's domestically where the airlines are having trouble. And we're seeing, $111 fares to Puerto Rico this winter, $69 to Miami. 2 years ago, you couldn't fathom $69 to go to Miami. It was, as one of the top places to go. So there are good deals out there for consumers right now.
Brian, can you talk a little bit beyond airlines? Where are you seeing the greatest points deflation, I guess, as these points give you no benefit over time to hoard? Is it beyond airlines? Is it also car points, points for car rentals, points for hotels? And are there differences between those sectors?
Yeah, so car rental programs are pretty much useless. There's been so much consolidation there. There's only one or two main players. With car rental companies, it's more about the perks and getting elite status. So if you've got an Amex Platinum card, you may get elite status with, National or Hertz. So that's really where I would say, booking directly with car rental companies, it's all about recognition, not waiting in that line. The points are pretty meaningless. Hotels are actually pretty valuable. I would say World of Hyatt just won Best Loyalty Program at the Points Guy Awards. Hyatt's a great program. They've been acquiring more hotels, and they are a transfer partner of Chase. So that's the program that I like using the most. You can easily get 2 or 3 cents per point in value. But Marriott and Hilton are also pretty good programs. But here's my key tip when it comes to loyalty. Don't be loyal to a hotel or an airline. Be loyal to a credit card. The credit card companies are where it's at, because you can accrue points in Amex, Chase, or Bilt, and then you transfer them to a number of different partners. And this allows you to not just bank with one airline or hotel. It gives you a lot of different options when it comes time to redeem.
What about the credit cards that aren't giving you points necessarily to spend on travel, but for instance, Amazon's credit card, which gives you, credits to spend back at Amazon, or other credit card companies that give you points to spend at retail? How should we be approaching those points systems?
Yeah, if you want cash back, I recommend just getting a straight up cash back card. The Citi Double Cash basically gives 2% back, no annual fee. That's the gold standard. So instead of getting with one retailer that might have some wonky earning, and the Amazon card is pretty good actually for those who shop a lot at Amazon, but instead of just banking with one retailer, get an overall cash back card that gives you flexibility, because if you get cold hard cash, you can use it if you want travel or on anything else versus with just one retailer.
It strikes me that why should any company, why should a Delta, United, American try to cater to their loyal clients if this really is the business model, if it's really just about them being an arm, a loyalty arm tied to a credit card company?
Well, think about it. You might only fly a couple times a year, but you're using your co-branded credit card every single day. And that's where I think Delta in their recent earnings said 1% of total GDP spend in America is on a Delta co-branded Amex card. So think about that. Even that infrequent traveler, Delta's earning money when you go to the grocery store, when you pay for, all your expenses in your life. So it's a brilliant business model to bring people in, to give them these points, and then encourage them to fly on the airline, letting them board early. So, I will just say, while there's been a devaluation in currencies, it costs more miles than ever before. You can also earn more miles, and the U.S. is very particular. You can get 100,000 point sign-up bonuses, earning 4x, 5x in certain categories. So not all is lost. You just got to play the game correctly and use the credit cards that reward. Well, I do love Emirates. Emirates first class on the A380 is an iconic experience. I took my parents on an around-the-world trip, and they've got a big onboard bar, and my dad and I were drinking, I think, $300 a glass.
Okay,
last
Brian is my new
stop.
hero.
We flew over the Himalayas, and it was like $200 out of pocket in taxes and fees. We were getting that first class experience cheaper than what people paid in coach, and that's why I love points.
Brian Kelly, founder of the Points Guy. We all aspire to be you. Brian, thank you so much for being with us, flying around the world with his parents, drinking $300 cocktails.
Amazing.
In Emirates Air. But to me, again, how much time, though, do you have to devote to knowing how to game out all the programs?
Yeah.
I don't have the patience.
Well, if it's your business, you're the points
I
guy.
know.
You got the time.
It's
you
pretty
get to
awesome.
give us all the advice. What a great business.
Thank you so much for being with us today.
Oh, my
really,
pleasure.
I am grateful to you. I give thanks for Gina Martin.
Oh my
Adams
gosh,
for
I
being
give
here
thanks
today.
to you as well. It's been a delight this morning.
What are
so
you going to
thank
be doing for the rest of the year? How are you going to be looking for things to evolve?
It's very interesting because we actually run our own sort of recession model. It says that the U.S. economy is very, very weak already. So I'm actually looking for signs that things potentially stabilize into 2024 and we recover already. And then this is partially a function of the fact that I'm an eternal optimist, partially a function of the fact that I am an equity strategist, and equities tend to move first. But I'm looking for signs of a bottom finally forming in the economy as a result of this decelerating inflation pressure. But we'll see. We'll see what happens.
I love it. Thank you so much. We really appreciate it. Coming up on Bloomberg Television at 1 p.m. Eastern, Stephen Yalof, President and CEO of Tanger Factory Outlet Center. On this Black Friday, interesting to see whether it's going to be a good news story for people to be looking for discounts or a sign of caution as we head into the remainder of 2023. As we do, it is a quiescent day, people taking a breather after a pretty tumultuous couple of weeks.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
From New York City for our audience worldwide, I'm Lisa Abramowitz in for Jonathan Farrow, taking a look at just a really quiet market post-Thanksgiving after a massive rally. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up, U.S. markets reopening after the Thanksgiving holiday. Stocks on track for a fourth consecutive week of gains, and retailers start sounding the alarm as Black Friday gets underway. We begin with the big issue, plenty for investors to be thankful for.
Investors have lots to be thankful for.
The rally we've seen in equities.
Equity rally.
A classic year-end rally.
The rally is certainly very much in force.
An economy that's looking pretty good globally, and risk sentiment that's picking up.
We're seeing this kind of soft landing celebration.
The market that is very enthused about a soft landing.
Inflation coming down.
Inflation which has come down.
Some of the heat cool in the labor market. The labor market showing some cracks, but simply normalizing.
The Federal Reserve is done.
The Fed on hold.
So far, the Fed's making this look as easy as pie.
The probability of a soft landing has gone up materially.
All the things are moving in the right direction. Markets moving in the right direction, but it doesn't mean we should take them for granted.
Joining us now to discuss Aberdeen's Luke Hickmore and George Concalves of MUFG. There is this question, and George, I want to start with you. Do you buy into this fact that this rally can continue for a foreseeable future?
Look, I think we've pulled forward a lot of the kind of year-end rally that everyone's been kind of hoping for. A pretty sharp move in November, altogether up 7 to 8% on the broader indices. We think we pulled a lot of those pulled forward, and it's probably time to take a break here.
Luke, do you agree?
I think unless we get any specific news, it's going to be really hard to fight a rally through to year end with very quiet markets.
That's what it feels like, is a very quiet day. And what we're also seeing, though, is still this push higher slightly in benchmark yields. There is a question of how far yields can keep going lower, given the fact that people are still spending and there is this optimism being expressed in stocks. George, do you think that there is an incoherence recently in the rally in both bonds and stocks that has kind of hit its tipping point?
Look, we got down sub 440, and now we're trying to climb back up here and get back to 450. As long as we're within 4.3 and 4.8, I think that's probably a good place for equities. But if we get under 4 to 4.25, then the bond market's signaling it's a slowdown. So I think it's fair game for now. But I think we have to be careful here.
Luke, do you get that same sort of sense that basically between 425 to maybe 475, there's sort of an easy feeling in stocks based on the fact that bonds are basically sending a Goldilocks signal?
Yeah, it feels that way, doesn't it? The reflexivity of the markets doing the Fed's job for them. I'd actually like to see the 10-year up at 5% because I think we need to get there at some point next year before rates start coming down again. We need to get back to a normal curve. But yeah, sure, the short term, we could easily be stuck in that range, and in quiet markets, that seems pretty sensible expectations.
Luke, why do you think that that's the way that a yield curve is going to normalize, with the long end, with yields going higher, rather than at the front end, yields coming in, especially given that so many people expect rate cuts next year?
And I think it's that very dynamic of those rate cuts. We need that 2s, 10s curve to go back positive. We need a normal curve. We need people to be paid for the risk to go further out in duration, which at the moment you're not. And if you look all the way back through to 1985, we've touched where base rates are in the 10-year before we've come back down the other end again. So I'd like to get there. I'd like to see that 5%. I can then finally get long the 10-year. But right now, it just feels a bit of travel before we get there.
George, do you have a similar sort of sense that there is another leg higher in long-term yields?
I mean, look, I think we've probably seen the highs here. Could we go back up to 5%? It's possible. I mean, we're gonna see the bond market through the auction process try to kind of extract yield and yield concessions over time, and there's plenty of supply to go forward. The tricky part is, if long-term rates do most of the lifting here, then that's going to be inconsistent with equities. Because look, if we go back up towards 5%, then it's going to start challenging kind of the risk narrative again.
it's all head spinning, and it's a quiet few days for Fed speak as Fed speakers all go and have a holiday where they recontemplate how they're going to frame out the year ahead. But not so much in Europe. ECB President Christine Lagarde signaling the end of rate hikes.
Given the amount that of ammunition that we have used, we can observe very attentively the components of our lives, like salaries, like profits, like fiscal, like geopolitical developments, and certainly the way in which our ammunition are impacting economic life, to decide how long we have to stay there and what decisions we need to make up or down.
Joining us now is Bloomberg's Alex Weber from Frankfurt for more. Alex, we've heard this sort of question mark, is the ECB done? Do you think that's the tone that markets are looking for right now in Europe, or do you think that they're really responding to other impulses like fiscal spending?
Well, from the ECB officials, we hear that it's very likely they are done raising interest rates. They haven't fully closed the door. We hear, for example, that if there is another energy price shock, that could warrant another interest rate hike. But largely, I think, barring a substantial surprise, there's not going to be any move higher. That's also what investors seem to be expecting. The question has really moved on to when will they cut. As President Lagarde pointed out in the clip we just heard, it's now about observing the incoming data. We had PMI numbers this week that showed the economy is still contracting. At least things don't seem to be getting worse, but the economy certainly isn't doing better than expected. Inflation pressures are still high. That's also why they're not sounding the all clear just yet. But they can afford to be in a sort of wait and see mode for the next couple of meetings, at least.
Which raises a question of what's in charge, the fiscal picture or the monetary policy picture, at least in the short term. Alex Weber in Frankfurt, thank you so much. Still with us, Luke Hickmore and George Concalves. And Luke, I'm curious from your vantage point how much you're looking at whether the ECB officials are going to raise rates further or whether they're going to cut, or how much it has to do with things like what we saw overnight with Germany coming out and again saying that they're not going to try to go back to a net no new issuance of debt because they want to keep in place some of the programs that grew up in the wake of the pandemic and even before.
I think Europe said ciao to further interest rate rises, Lisa. I think they're done. And Germany needs to do something. They've got structural problems. The infrastructure in Germany needs a lot of investment going forward. That can help to drive growth as well. But, you know, you've got to start loosening up some of those fiscal strings, and the borrowing powers that they've got are massive. I think if Germany did that, it could help Europe out. I think they're in a recession right now. I think we could see cuts quite early from the ECB, maybe as early as April or even May next year. Rather than actually waiting until possibly Q3 for the Fed. They need to start moving. We need to start seeing economic growth in Europe, shook it up a bit, and that's got to start from Germany.
George, do you agree with that you're going to see pretty significant rate cuts from the ECB?
Look, I think if the Fed's going to be cutting at some point, the ECB has to do it as well. So I do agree they're probably in a much more precarious situation, and Germany being like really the growth driver and lack of growing does require Germany to lead the charge there. And ECB is going to have to steepen out their curve too. I mean, curves are way too flat. Rates are just too punitive there in Europe.
George, do you think that people have gotten a little ahead of themselves when they talk about rate cuts in the U.S., especially given the fact that, today is Black Friday and all I hear is that people are out there shopping and that, yes, we might be going back to 2019 shopping levels, but that still is pretty sizable.
Look, I mean, it's all about the rate of change and the marginal consumption. It's not just the fact that everyone's shopping, that's going to continue even if we were to fall into a minor recession, right? So I think it's more about just kind of that nuance. Markets move fast. The data moves fast nowadays. As we discussed in the past, with this kind of nonlinear approach to economic analysis, I think we're at that point where things are going to start to speed up very quickly, especially once we get through the sleepy days of the holiday seasons into the start of next year. We're going to look up, and there's going to be a lot of bills to pay, and people's wages aren't keeping up. And I think it's going to really start to crimp down on consumption. And I think eventually that will warrant Fed cuts.
Luke, do you think that if the ECB does more aggressively cut rates next year, more aggressively than the U.S., do you think that will give a disproportionate boost to European assets?
It should do, and it should help weaken off the euro a little bit, helping exporters, etc. And yeah, I think European equities, if you look at them versus, say, the US as well, there's value there to be had versus chasing this kind of massive rally that we've seen in the US. So yeah, I do think it could help right across the board. And as I said, it needs to start, and maybe as early as April.
Wow. Luke Hickmore, George Goncalves, both of you are sticking with us. We want to take a look at what's moving on a relatively sleepy day ahead of the opening bell. Here with that is Simone Foxman. Simone.
Yeah, Lisa, the Thanksgiving hangover very apparent in pre-market trading, short trading day today. There is one name that is moving quite a bit, iRobot. This based on a Reuters report that Amazon will get EU antitrust approval for its acquisition of that company, the maker of the Roomba, citing unnamed sources. Shares there up over 30% in the pre-market. But our other movers, just not that exciting. Tesla shares falling slightly. They had been down as much as 1.2% after a report from a local Chinese car review website said Tesla's competitor, BYD, will offer steeper price cuts as it tries to boost year-end sales. BYD shares had also been down pretty significantly in Hong Kong trading. Finally, we're watching NVIDIA. This is its third consecutive day of losses if we see this number hold up in the red. Longest losing streak in about a month. This based on another Reuters report. A chip company told customers in China that it will delay the launch of its new AI chip for the country until the end of the first quarter. Again, citing unnamed sources, U.S. restrictions, grappling with on these semiconductors, advanced semiconductors. So we'll see how that plays out in today's trading.
Simone, thank you so much. Coming up, the first truce in the Israel-Hamas war.
The hope is that pressure will mount. A 4-day pause will turn into a 6, 7, 8, 10-day pause.
The latest developments out of the Middle East, that conversation coming up next.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Hamas also took hostages in order to constrain and delay an Israeli ground campaign. The hope is that pressure will mount. A 4-day pause will turn into a 6, 7, 8, 10-day pause. Pressure will mount for what Hamas really wants, which is an extended and prolonged ceasefire.
Peace in the Middle East, at least for a couple days. A 4-day ceasefire in Gaza taking effect, the first truce since the Israel-Hamas war erupted. Hamas expected to return 50 of the almost 240 hostages, while the Israelis will release 150 jailed Palestinians and allow more aid into Gaza. An Israeli military spokesman making it clear that the humanitarian pause is only temporary, saying, quote, "The war is not yet over." Joining us now is someone with incredible insight, Bobby Ghosh of Bloomberg Opinion. Thank you so much for being with us, Bobby. What is the latest in terms of, have people been released? Is there still uncertainty about whether this will actually take place as promised?
Well, given that we're dealing with Hamas, which is a terrorist group and not a traditional military force, you can only be absolutely certain when people start crossing the border and are in safe hands of the Israelis on the other side. So it's a little hard to tell. So far, the truce is held, and Israel has kept up its end of the bargain, or some of it, and Hamas is expected to release 10 or 12 hostages today, and they will continue to release a group of hostages for the next today and 3 more days hereafter. So we're all keeping our fingers crossed.
Do you have a sense, Bobby, of what the sentiment is among both Israelis and Palestinians, right? I mean, we hear a lot about the leaders. We hear about Hamas and we hear about Benjamin Netanyahu. But is there a shift within the populaces about what they want and how they would like to see it achieved?
Well, there is a gap between what the Israeli population seems to want and what Netanyahu is saying. It's easier to figure out what the Israelis think. It's a free country. There is opinion polling. It's harder to tell what's going on inside Gaza, not least because it's in a state of war right now and people are having their homes bombed out from over their heads, and so it's a little hard to know their deepest feelings. In Israel, Netanyahu is saying that this is only a pause, and once the pause is over, we go back to the war, and the war won't end until we have destroyed Hamas. And there are some officials in the Israeli government that are saying that if necessary, we will occupy Gaza after the fighting is done. Ordinary Israelis, the polling suggests, do want to see Hamas defeated, do want to make sure that the events of October 7th, the terrorist attack, are never repeated. But they're not comfortable with the idea of occupying Gaza, because that's been done before and didn't go well. And Israelis don't want that to happen. At least the majority of Israelis don't seem to want that. So there's a gap between what their expectations are and what their government is saying. But for the moment, I think Israelis will be just grateful to have those hostages released. Most of the 50 that will be released in this particular truce are Israeli nationals. And the Palestinians in Gaza will be relieved not to have bombs falling all over them for the next 4 days.
Bobby Ghosh, thank you so much for being with us, and we will continue to follow this story as it evolves and we actually get more information. Still with us, Luke Hickmore and George Goncalves, and this has been a big hangover that people have been talking about, how this weighs on people's sentiment. Luke, do you get the sense that it still is being counted in markets? Because frankly, it seems like it is a massive humanity story and one that is roiling politics and emotions and families, less so in markets.
Yeah, I think that's right. I mean, we should all be thankful for a humanitarian pause right here. But the lead up to this and then the attack and what's happened, everything since, we were all worried about this getting wider and wider and Iran getting pulled in directly and having a massive impact on oil. But as per normal, the markets live in one of the fastest news cycles we've ever seen. And we've moved past it in a pure pricing in the risks. However, you know, calm helps. The VIX is down a little bit today. This is all going to play into the narrative through to the end of the year with stronger markets, I think. And if we've had one pause, we can all hope there'll be more to come.
George, do you get the sense that that is something that is behind some of the optimism that we've seen in markets?
Look, I think that, and of course what's going on in oil, I mean, I'm sure there was a decent amount of risk premium there associated to the conflicts. But if, you know, oil were to, you have to look at oil almost in the same way as you look at the 10-year rate. Oil is somewhere between 70 and 80. I guess you can kind of say is a sweet spot of Goldilocks environment. But if oil continues to decline, that's going to be another issue for 2024. Like, do we really have strong growth if oil is so weak?
Yeah, well, that sort of raises this question. We heard this from the Fed in the minutes that, typically these kinds of geopolitical conflicts are inflationary. Is this time different considering that we do have a backdrop that is weaker and we don't really understand, George, exactly why? How do you understand that in terms of whether this could be inflationary or whether we're in a just different scenario with really truly weakening global growth?
Look, inflation expectations and overall inflation vols have been relatively low. If you kind of decompose actual rate movements, most of it is real rates, right? It has been the case really since the summer. So it's not really about the inflation concerns here or linked back to this conflict or oil per se. At times it's episodic and it'll move the markets, but it's really coming down to, can we keep real rates this high? And then that factors into the overall yield curve.
Luke, do you get the sense that there is something behind the oil price move lower that is concerning when it comes to growth in a material way that is really divorced from anything else that could be going on?
As per normal with oil, it's very difficult to split out all of the attribution of what causes any rise or fall. I think this one looks to be somewhat related to more supply coming online right at the point when some of the kind of concerns about geopolitics are easing off a little bit. So I think it may be more from the supply side pushing it down. Actually, I think on the inflation side, Lisa, it's been really interesting that the long-term break-evens have not got de-anchored from that long-term target the Fed's got of 2%. Yeah, a little bit higher, sure, but nothing like where we've seen inflation actually get to. So it may just be a lot of trust in the Fed has remained in this market, which is why we haven't seen things like oil and commodities get completely out of control.
Although, Luke, I got to be honest, I've been really confused about exactly what you're saying. Longer-term inflation expectations, a five-year forward break-even rates, for example, staying around that 2.27% range. And yet, if you take a look at the inflation expectations for the University of Michigan Sentiment Survey, they're increasing, and they're continually going beyond the expectation of 2%. There were 3.2% at the most recent read. How do you understand this divergence?
I think this is a Wall Street, Main Street problem. Wall Street trusts the Fed. Main Street maybe not even aware of exactly what the Fed's in there and doing for them. So I think it could just be a perception thing. It was really interesting, the UMISH going higher recently. But I think with oil coming down, gasoline prices coming down, maybe offset a little bit with a weaker dollar. But it's going to push down inflation more, and I think people's expectations will follow quite naturally from that.
George, what do you make of that? I mean, this is normally a survey that really does deal more directly with gasoline prices, and we're seeing gasoline prices fall. We're seeing food prices fall, not that significantly, but on the margins. How do you understand why people are seeing inflation going up and staying stickier for longer?
Look, it could be very well. I mean, look, for number one, I think the U.S. consumer is sometimes underrated, and in fact, actually, is pretty sophisticated at understanding what's going on. I mean, they have to pay at the pump, and they have to pay at the grocery store, so they feel the inflation pressures over time. And it could be the totality of inflation still kind of weighing on the consumer, and also, they had a decent amount of wage increase while inflation was going up. But now, if inflation is going down and wages are not keeping up, I mean, it could very well be that the consumer expects that their wages are going to fall off as well.
So what's your highest conviction bet heading into 2024, George?
I mean, look, I think our conviction is probably in mortgage spread product more so than anything else. I think the curve re-steepening. I think eventually the Fed does cut rates. And we do think that, credit spreads are way too tight.
What about you, Luke?
I am a credit fund manager. I love credit. Investment grade credit has got to be your asset of choice for next year. But there's going to be times to buy and times not to. And it's not quite at its cheapest. I think I agree with George that right now it looks a little tight. Equities look a little high. Yields look a little low. I would all like that to be the other way around. But I would be getting back into investment grade credit as my first choice.
Wonderful. Thank you both so much for being with us. Happy holidays. Happy Thanksgiving. Luke Hickmore, George Concalves. Have a wonderful weekend. Coming up, the morning calls, and later, retailers striking a cautious tone heading into the holidays. That conversation still ahead with UBS's Leslie Falconio. We're seeing a quiet day, the day after Thanksgiving. This is Bloomberg.
the reception, the acceptance of Purosangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Purosangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Now for our morning calls, a look at some of the analyst recommendations on Wall Street this morning. First up, Bank of America cutting its steer price target down to $399, expecting consumers to keep pulling back on big-ticket purchases. Next up, Citigroup raising its Salesforce price target up to $247, seeing an improving backdrop ahead of next week's earnings. And finally, Argus double downgrading Pioneer Natural to sell from buy. The analysts expecting ExxonMobil to be the only takeover candidate. Coming up, Black Friday underway with retailers sounding the alarm. That conversation coming up next with Leslie Falconio of UBS.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow, just moments away from the start of trading. And as the session grows older, you can see that it really is dragging down, turning slightly negative, but really range bound. And what you can see, though, outside of just the stock space, in bonds, you do see a bit of a sell-off with yields going higher, which I think is pretty interesting and dictating some of the action. You can see yields 4.47%, up 7 basis points. The euro just a touch higher versus the dollar, and crude lower by 1.3%, perhaps on better than expected data, as well as this concept that maybe we are truly seeing the first step towards some sort of resolution to the conflict in the Middle East. One stock to watch at the open is NVIDIA, falling for a third consecutive session after closing at a record Monday, extending declines on a Reuters report saying the company is delaying the launch of an advanced AI chip for China customers. Bloomberg's Isabel Lee joining us now with more. Isabel.
Hey, Lisa, so this is a significant development because this is one of the most powerful chips that NVIDIA is developing for China. So they're developing 3 chips, and Reuters was first to report this news. Reuters said that it can come until the first quarter of 2024. And recall that earlier this month, NVIDIA was saying that it will come as soon as this year. So this is a setback, and investors are not liking it. This postponement comes as the U.S. has restricted some exports of advanced semiconductors to China, and this means firms like NVIDIA will not be able to export some of their most in-demand chips to China, which is the world's largest semiconductor market. So definitely a blow to investors. And if this decline holds, this will be the third straight loss in the quarter for NVIDIA, and its biggest losing streak in about a month, Lisa.
Isabel, thank you so much. Turning now to the automakers, Tesla facing a second day of declines, under pressure due to ongoing strikes in Sweden and the potential for steeper price cuts at one of its competitors. Bloomberg's Jessica Menton has more. Jess.
Well, taking a look at Tesla, the 9th biggest weighting here in the S&P 500. But if you look at that stock, just mildly lower here ahead of the opening bell. So this did come as, especially when you're looking at pre-market trading already there, but then ahead after the opening bell here, you're looking at this competitor when it comes to BYD. It's Chinese electric car makers saying that the Dynasty series models and an ongoing strike here, when you are looking at what's happening, it's definitely also pressuring when you are looking at Tesla here. So last month, of course, when you are thinking about Tesla, of course, we did see those price cuts happen for its Model 3 as well as its Y, and obviously this push to meet its delivery goals there. But of course, when you're thinking about this, and especially what could potentially be good for Tesla car buyers when it is in this different price battle, may not always be potentially helpful here for shareholders. But again, if you look at that stock year to date, up actually 90% there. So still, when you are looking at those Chinese EV makers, actually, they were mildly lower in Hong Kong trading, but another stock to keep an eye on, especially in morning trading, Lisa.
Jess, thank you so much. We're also watching shares of iRobot, the maker of Roomba, soaring at the opening bell amid reports that Amazon is poised to win unconditional EU antitrust approval, clearing the way for its $1.4 billion acquisition of the company. Joining us for more is Bloomberg's Alex Semenova. If John were here, he would say, why do we want Roomba going around tracking all of the data in my home and transmitting it to Alexa and transmitting it to Amazon? Nonetheless, Alex, what do we got?
Exactly, Lisa. Well, investors are apparently really happy about it. Shares of iRobot were up as much as 44% before the open, now moving higher again as the stock market opens. This is after reports that Amazon is set to win unconditional approval from the EU for its acquisition of the company, which is, of course, the maker of household appliances like the popular Roomba vacuum. This deal was announced back in the summertime. Amazon said it would acquire the company for $1.4 billion to expand its portfolio of smart devices, which includes the Alexa voice assistant, various smart thermostats, security devices. But the EU had warned Amazon that this deal could reduce competition in the robot vacuum cleaner space and importantly reinforce Amazon's position as the dominant online marketplace in the US. The company has been under scrutiny along with other big tech names for their acquisition of smaller rivals. So this would be a big win for Amazon if approved. The initial agreement worked out to about $61 a share. That was revised down to $51.75 a share back in July after iRobot's net debt increase. You can see iRobot moving higher today, but of course, trading volume is light, so it is accentuating that upside move as well.
Alex,
Lisa.
thank you. Thank you so much for that. And finally, attention turning to consumers as Black Friday gets underway this coming after a number of retailers delivered disappointing earnings and tepid outlooks for the holiday season. Joining us for more is Bloomberg's Simone Foxman. Simone.
Yeah, Lisa, Black Friday just isn't isn't what it used to be, and that was the message from CEOs this quarter. Macy's CEO Jeff Gennett saying on his earnings call just a few days ago that Black Friday is really focused on the deals prior to Black Friday. Retailers have been promoting this day and this week since early November, and this strategy allows really budget-constrained consumers to kind of spread out their spending over time. Bloomberg Intelligence also says expect a day where people are just going to be putting less in their baskets. The biggest discounts, however, are going to be on toys, with discounts there up to 35%. These discounts, though, even though there's this real emphasis on this value-oriented consumer, are not expected to be as significant as last year. That said, we're going to see the likes of Lowe's offering enormous discounts on things like big appliances, as that spend has really been under pressure. Overall, the National Retail Foundation expects that we'll see holiday sales increase 3 to 4% this year. This is not as big as last year, but it is roughly in line with what we saw pre-pandemic. Again, shares of most retailers this morning in the green, led in part by Costco, but not much movement here today, Lisa.
Simone Foxman definitely wraps it up well. Thank you. UBS Wealth Management's Leslie Falconio unveiling her outlook for the consumer, writing, quote, "We expect consumer spending to slow into 2024 with the savings rate set to rise. Consumers will spend more selectively." Leslie, I am so pleased to say, joining us now with more. Leslie, how important is Black Friday? Are we overstating it at this point, given the fact that we also have Cyber Monday, the Friday before Black Friday, and every day leading up to it online and elsewhere?
I definitely think it's an overstatement now versus what it used to be. I mean, a lot of these shopping has been going on for the past, month now. It's not just about Friday. And, I do think it was mentioned before, we are expecting to see some slowing this year versus last. And, versus the 5% growth that we saw last year, we might see around 3 to 4% this year because people have other obstacles coming, such as student loan debt.
Well, this is a reason why some people are expecting some sort of slowdown or a gentle kind of Goldilocks softening in the consumer appetite that can lead to a disinflation. I do wonder, though, you said people are going to be spending more selectively. On what? We have seen services pick up to such a big degree. Are we starting to see that fall off and people go back to goods?
Well, listen, I don't think necessarily they'll go back to goods. I think people will start spending more selectively, particularly when you think about that student loan data. You might not pay as much for that concert ticket as you were, this past year. And I do think that consumers are going to start saving a little bit more as we go into 2024, particularly given our view is that, the Fed more than likely will not ease in the first half of the year. And we know that there's a lag for this higher for longer. And I do think that this headwind of higher borrowing costs and just impact to the consumer will steadily increase in 2024, and people will just start to be a little bit more selective of how they spend their money.
How concerned are you about what Walmart was talking about, that in the past 90 days, they've seen a significant drop-off in consumer appetite? Does that translate to other types of retailers, or is this more specific to exactly what Walmart is dealing with?
Well, Walmart's going to be more of the coupon clipping kind of. They've seen more of that. I mean, I think that when you look overall, as much as inflation has been going down, the actual price level is still fairly high. So I do think that, you're going to see some headwind going forward in terms of that kind of spending, and these kind of deals that you're going to get going forward will also increase. We've had a situation where the consumer has been incredibly resilient, and we think that that continues. I mean, household balance sheets we view as still very strong and will continue to be strong. We just do expect that, savings rate will probably move higher as some of the stimulus goes by the wayside. You do have some of the things such as this student debt, playing an obstacle in terms of how you spend your money, and we still have an inverted yield curve. So we do anticipate that the consumer might pull back a little bit. I mean, we still expect a soft landing, but again, savings is probably going to increase over the next year.
Okay, so there's a question around savings increasing and savings decreasing, right? So people have been saying, well, people are eating up their bucket of savings from the pandemic, and that's the reason why they're going to slow down your spending. You're taking the opposite tact and saying that actually they're going to be more prudent as they try to rebuild. Which is it, right? Because there's some people who sort of represent Americans as profligate spenders who are just, banking on their credit card and just carrying on with the spending.
Well, I think you're absolutely right. I mean, credit card debt, as you know, is like $1 trillion, and we've seen these credit card rates right, of 21%, which is incredibly high. And we are seeing a rise in delinquencies. I do think there'll be a level of prudence next year in terms of the consumer. Again, I mean, they're still very strong. They still have, strong balance sheets. But we do think that that saving aspect will probably be a little bit more in tune next year as we do see, growth kind of slow. And again, this impact of higher rates continuing, as we believe that they will, particularly during the first half of the year, start to impede the consumer a bit.
Do you buy all of these arguments, taking a look at Thanksgiving dinners and saying, well, actually, it's lower price on average than last year? Do you think that that really represents kind of how people are feeling and how they're going to experience disinflation?
I don't. I mean, because they're still, again, prices are still high. And I think that, listen, I think, as mentioned before, George mentioned this, when you look at some of these indicators about the delta and about the change, and that is incredibly important. But as an absolute level, these levels are still very high. And although I don't think it's going to change someone's spending habit because they're seeing a slight decline right now, because there's other obstacles that they're going to be facing, such as student loans.
Leslie, you'll be sticking with us, and we are looking forward to that. Coming up, OPEC pushing back, a critical meeting, clouding the outlook for production. That conversation coming up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I do think what we are going to find is that outside of a very few industries and sectors, governments are not going to be willing to subsidize indefinitely production that brings it home or brings it to allies. And so the benefits of international supply chains that we've seen over 40 years, from economies of scale, from specialization, from innovation and the like, those aren't going to go away. And so if you don't have an international supply chain, you will be beat out by competitors who do.
So I think what we're looking to do is to maintain a trade policy which is based on openness, which is based on sustainability, which is assertive, where we need to be assertive and defend our rights, but certainly not one which is going to be closing down unnecessarily our trade and investment relationships with the rest of the world.
Globalization, that open supply chain, global supply chain is really important for the life science industry, particularly pharmaceutical supply chain. You think about the stress the pharmaceutical supply chain has been under since COVID-19, the war in Ukraine, not to mention the geopolitical tensions, if you will. We don't have the luxury of saying we can temporarily stock out on our product, because these products, these medicines keep people alive.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
Right now, we see that the market is trading comfortably in, it's low volumes, but spreads have held up in the last few days, and we think physical buying is going on in the market. So The next question, though, is about that January number. So will the demand be there, and is OPEC happy for the U.S. to fill that excess demand? And we think the demands can be there, but will OPEC want to hold back with their own customers and allow them to buy American?
Nadia Martin-Wiggin of Spelland Capital weighing in on the energy markets. Oil sliding into its third day of declines on OPEC Plus, announcing a delay to their pivotal November meeting, which will now be held online. The group struggling to strike an agreement on African output quotas. For more, Alaric Nightingale joining us from London. Let's talk first about the OPEC Plus meeting. Do we have a greater sense of why it's been delayed and why it is remote, and what that signals for production?
Well, it's not completely clear why it's remote. The cause of the delay, we think, is there's a disagreement with how much they want the African countries, Angola and Nigeria, to pump. And they're just trying to kind of work out what they should do and what's a reasonable amount. And that's obviously pretty important for the group at large, and if they don't kind of find those agreements, then that's just going to cause things to drag on.
Alaric, thank you so much. We're getting some breaking news right now. We appreciate the insight, and we will follow up with you. We are getting U.S. PMIs. They're just crossing the terminal, and they are interesting that they come in below expectations on the manufacturing. So they come in at 49.4 in contraction territory, which is usually below 50 from the expectation of 49.9. And you could see that services actually comes in better than expected. So this is sort of the interesting point, is you still see expansion in the services sector, 50.8. So the overall still positive, still led by services, even with manufacturing disappointment. All of this kind of pointing to a real kind of turn beneath the demand. S&P futures just lower by about 0.1%. You could see that kind of drag on things. I imagine that you have a bit of a pop in yields on this, given the fact that people are looking at demand kind of continuing. You are seeing a bit higher 10-year yields, 4.47%, basically in line where they were before. The 2-year yield climbing up, bumping up, approaching that 5% level again, 4.94%. Bloomberg Simone Foxman joining us with more details. Simone, what are you seeing?
Yeah, as you were talking about, Lisa, the real strength here in that services sector number, we had expected that it would stay in expansionary territory, and we didn't really expect any major changes in either direction, but we can see just in the last few moments, NASDAQ, S&P 500, both turning into the red, whereas Dow Jones still holding up here. But the major moves, as we're seeing across the market, really concentrated in that bond space, with yields rising. Not too much happening today in anywhere in the stock market.
Simone, I love it. Every conversation, nothing's really happening, but we're going to tell you kind of what should be happening today on a day when pretty much no one is in the office. Simone, thank you so much. We really appreciate that. Leslie Falconio is back in the office, or at least back with us, probably not in the office on a day where not that much is happening. And just ripping up the script, as Tom would say. Are we seeing basically nobody in the office, everybody just basically punching in to make sure nothing is really exploding and then just moving on?
Yeah, it's fairly quiet. I mean, everyone knows that these kinds of days aren't actually the most liquid days, and we do have an early close. So I think that people are watching it, but normally on days like today, when the illiquidity is pretty, prominent, you don't want to trade on these kind of days anyway. So it's fairly quiet.
Which is what we're seeing for sure in the price action, as well as just in volumes. But I am wondering, we were just talking about the PMIs that came out, and it is interesting to show that is continuing, with services expanding more than expected and manufacturing contracting more than expected. Kind of goes to this feeling that we might see this trend continue for a longer period of time. Is that sort of being baked into your base case heading into next year?
Listen, I think that one of the biggest things right now that we are sort of pushing against is the fact that the market has, priced in an ease of the Fed of nearly 100 basis points in 2024. And although it's backed off a little bit from that March probability, which is now only about 15%, the probability of an ease in March was once 40% after that CPI number. That's really what we're pushing against. I mean, we don't think that the Fed has the ability to sort of wave the victory flag yet. And we do think that the Fed funds rate is going to stay higher for longer throughout the first half of the year, and most likely start easing in the third quarter. So that part of the market and what the market is pricing in currently, we think is a little bit too dovish, particularly in front of that December 13th meeting.
So do you get the sense that basically the Fed's going to be on hold for longer than people expect, but then that they're going to cut really rapidly? Or do you think that we have this sort of protracted higher rate environment that's going to become that much more challenging as time goes on?
You know, we're still in the soft landing camp, so we're not seeing that rapid cut yet. But listen, the fixed income market and the market as a whole, this is a show me market right now, right? So as much as the Fed can be vague in terms of wait and see, the fact of the matter is we have to wait and see for the data. But right now, our expectation that the higher for longer will more than likely stay for the first half of the year, because although we think, you know, growth will slow and the payroll will start to loosen, we're not looking for these consecutive negative payroll prints that will force an aggressive easing. So we do think that, you know, in the second half we'll start to ease, but we think it'll be measurable. We don't think it's going to be this catch up because they've waited too long, at least from the data from what we're seeing right now.
What do you take in terms of the signal from oil prices and how much they've come in? A lot of people saying this is very much a demand story. Do you kind of buy into that, or do you think that there's another thing going on?
Yeah, I mean, listen, this is going to be like the 5th consecutive week of decline. I think that the last time we saw this was in December of 21. Listen, our outlook is for oil to move higher into the end of the year and into next year. I mean, both on the demand side and from the supply side. So we don't think this is going to be something that lasts a long period of time. But again, you're right, this is the 5th consecutive week potentially that we'll see a decline.
I mean, do you think that this has to sort of reconcile itself either with oil prices turning higher or else the bond yield space coming in and going lower, bond prices going up, simply because it does suggest something broader?
Well, listen, I think that what we're seeing now in terms of, and you pointed this out earlier, I mean, you know, we have these break-even inflation expectations in the TIPS market that are already fairly low. However, as you talked about earlier, that five-year inflation expectation is still moving a bit higher. So I think that these lower oil prices are, in terms of the inflation going forward, could dampen a little bit. But for the longer term, we're not quite out of the woods yet in terms of thinking that could be a potential driver to inflation moving slightly higher. Also, as well, I mean, when things about the correlation of oil to things such as high yield market, the high yield market in terms of spread has continually compressed. So I think that, you know, going forward, at least, we do expect oil to go into at least the mid-90s by, you know, the end of the year into 24.
Leslie Falconio, thank you so much for being with us. Have a wonderful, wonderful holiday weekend. Let's take a look at some of the sector price action this morning. We have to find out what Simone Foxman is going to say is actually moving on a day when very little is moving, and I understand that. Simone, what do you got?
Well, I think the only sector that's really moving consistently in any direction is energy, where we're up over 1% in the broader sector. We are seeing some weakness in communication services, information technology, but I think, as has been the theme all morning, this is the Thanksgiving hangover. There's not too much going on in any direction, but we are seeing all 11 sectors up on the week. This is the 4th consecutive week of gains for the S&P 500. Bank of America was also out talking about some of the biggest inflows into stocks that it's seen in several weeks. So that important, whereas we see some enthusiasm come back as we head to the end of the year, Lisa.
Simone, thank you so much. Coming up, the market moving events that you need to be watching. That's next in our Trading Diary.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year. Most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
The Open. I'm Lisa Abramowitz in for Jonathan Farrow. Not a lot going on in these markets today. You can definitely see this sort of holiday spirit imbuing markets with a sogginess and a lack of action. Not so much when you take a look at the yield space. Yield's definitely higher as people take a look at possibly more fiscal spending over in Europe, as well as the prospect that maybe people are spending and that things aren't so bad. Time now for the trading diary. What you need to be watching through the rest of the week. After the weekend, it's Cyber Monday. More spending. Plus, we'll get new U.S. home sales. Fed speak picking back up with Governor Waller and President Goolsbee. Wednesday, Dollar Tree earnings. Fed President Loretta Mester speaking, and we get the beige book. Thursday, we get some personal income and spending numbers, and finally ISM manufacturing on Friday, which should be interesting, especially given what we just saw with respect to some of the PMI data coming out showing the manufacturing downturn. I want to take a look at yields, and I really do think that this is actually one of the biggest takeaways over the past 24 hours. The fact that Germany wants to extend its ability to spend without having to come up with some net new issuance of debt. They want to keep competing, and you can see that has set the tone throughout the day. 10-year yields now near session highs, 4.47% after better than expected data in the services sector, as well as what's going on with developed markets continuing to borrow, continuing to spend, even into what could be a tricky period, but with a lot of debt and a lot of inflation. This was Countdown to the Open. Thank you for watching on this Thanksgiving Day. Have a wonderful weekend.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We're like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to get the latest on Israel. The hostage swap is actually occurring literally as we speak, so we will check in with Bloomberg reporter Henry Mayer. He is based in Dubai. He'll have the latest reporting. And then the Macy's CEO is going to join us, the CEO, Jeff Gennett. He sat down with Caroline Hyde. We're going to have some of that for you because it is Black Friday. And I walked past Macy's today, and it looked like there was never a parade there yesterday, so they cleaned it up very nice. Coming up also, Julie Van Ullen, Chief Revenue Officer, Rakuten. She's going to join us to discuss shopping on Black Friday and all that e-commerce stuff. So a lot coming up here just in this first hour. We will bring it to you. But first, let's check in with Charlie Pell and kick this thing off.
Hi, thank you very much, Paul Sweeney. Right to the retailers. Macy's out of the gate, down by about 0.7%. Target on this Black Friday, little changed, up less than 0.1%. Best Buy up 0.9%. Kohl's lower now by 1.7%. So the Dow, the S&P, they're both higher. NASDAQ in the red. Bottom line here, light volume. We've got the S&P up 2 points right now at 45.58. That is a gain of less than 0.1%. Dow Jones Industrial Average up 97, up 0.3%. The NASDAQ Composite Index down 14, a decline now of just about 0.1%. 10-year yield 4.47%, with a 2-year that's now yielding 4.93%. Spot gold up almost $10 the ounce, back above 2,000 at 2,002. A gain now of 0.5%. West Texas Intermediate crude down 0.6%, 76.68 for a barrel of WTI. So what about the earnings outlook heading into the new year? Michael Purvis is the CEO and founder of Tallback and Capital Advisors, and he was a guest this morning on Surveillance.
The question is I think bottoms-up consensus for next year is compiled by Bloomberg. It's about 12% year-over-year earnings growth. I'm sort of coming out more like sort of a 5, 6, 7% earnings growth number, and I think the markets will have to sort of ultimately adjust to that.
And again, you can hear more of that conversation on the Surveillance podcast. You can download it wherever you get your podcasts. Again, recapping mixed markets right now. It is a holiday shortened session. S&P now up 2 points, gain there of 0.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
We appreciate that. Matt Miller, we have no idea. He's on this 6-month sabbatical.
Hey,
no, paternity leave. I
it's
take it
not
back.
a scam.
But I don't think his daughter has been I don't think she's been born.
I don't know if you have
haven't
any
gotten to
kids,
smoke
but it's not an exact
Oh,
science,
I know.
kiddo.
Oh, trust me, we know. Carol Miller joins us because we don't know
Miller?
where Matt is. Carol Masser, God, I do that all the time. Matt says, I've asked her a million times to marry me. She keeps saying no.
He's good
over
where
the
he
last 30
is.
years.
I'm good where I am.
So, Carol Masser, it's you and I, Carol, for the next
Yeah.
4 hours. We'll drive this conversation forward. There's a lot to talk about. A lot
Absolutely.
happening on the geopolitical front. A lot happening on the earnings front. On this, even though the markets are pretty calm today.
Yeah, absolutely. And we do kind of want to get a start with what's going on in the Middle East, because the latest, Hamas has released a group of hostages held in Gaza as part of a truce agreement. This is coming from Israeli media. It has taken weeks and lots of different players to get to this point. So let's get to it with our Bloomberg News reporter, Henry Mayer. He is covers the economy and government, and he joins us, I believe, from Dubai on Zoom. So, Henry, great to have you here. It's fast and furious after many weeks of negotiations, but give us an update on exactly where we are.
Well, right now, 13 Israeli hostages are already in Egypt. They were handed over to the Red Cross by Hamas just over an hour ago, and so the first phase is taking place. This is a 4-day ceasefire which has started today, and over those 4 days, the number of Israeli hostages that will be released is 50, and in return, 150 Palestinian prisoners will be let out of Israeli prisons. So it's quite a significant moment, I would say. Obviously, this is a small number comparing to the total number of hostages held in Gaza, 240. But for the families of people who were kidnapped, it holds out real hope.
So, Henry, this is obviously great news for all involved here. How did this come about? How did they select which prisoners to swap? How did we get to this point here?
Well, as you mentioned, it took weeks of very, very complicated negotiations. Hamas has a political office in Doha, in the capital of Qatar. So Qatar was very much at the forefront of the negotiations. But the U.S. also played a very important role, as did Egypt. Egypt is the country which is now, acting as the exchange point for these for this deal. So it actually almost happened a few weeks ago, but it broke down because Hamas was demanding that Israel supplied with fuel in return for releasing the hostages. I think the point is that this is not necessarily going to lead to an end to the war. I mean, far from it. Israel has said that it plans to continue with this military operation once the ceasefire is over, although it could be extended for more than 4 days to allow for other hostages to be released. But, nonetheless, I think the fact that diplomacy has succeeded does give one, the hope that perhaps they will manage to take further efforts to end the fighting.
Yeah, Henry, though, it feels like the first step in a step of many to figure out kind of what is the way forward ultimately in terms of some kind of long-lasting peace where decades that has not been possible between Israel and Hamas and certainly the Gaza Strip. Having said that, what happens to the Palestinians that are there in the Gaza Strip while the peace holds for at least 4 days, possibly longer? Are they continuing to leave the area? Because we've seen the pictures. There's not much for them to exist on in terms of what's left in Gaza.
I mean, they're not able to get out of Gaza. I think what they were able to do today was to get out without being, afraid of dying, essentially, because the bombardment has been absolutely incessant since October 7th. And, we must remember how this started. It started with an absolutely, barbarous attack by Hamas on Israel that killed 120 Israelis. And, I think that one has to remember obviously the roots of how this started, but the civilian cost in Gaza has been absolutely terrible. According to the authorities in Gaza, which are run by Hamas, the number of civilian deaths is close to 15,000. The humanitarian crisis is extremely serious. There's been a basic blockade of the Gaza Strip since Israel began its military operation. And I think what's happening now is the international pressure is growing on Israel to try and find a way out of this. And clearly this swap, it's the first chance for diplomacy. People are hoping that this is going to open a way forward.
So do we know what the next steps are for these hostages that are being released? Will they be reunited with family immediately? Will they be debriefed by Israeli officials? What do we know about the next, I guess, hours and days?
Right. I mean, first of all, the number of Israelis killed was 1,200, so I wanted to correct that. But yes, we know that the Israeli army has been making preparations. You know, they've posted images on their Twitter feed of preparations for the children with toys and drawing materials. 13 mothers and children are being let out today. It's obviously not much, but each number of hostages that comes out every single day, they're going to be flown to hospitals. There's going to be a medical assessment. Clearly, they spent several weeks in very, very difficult conditions underground, and they're going to need treatment.
Henry, just real quickly, too soon, though, to think about how they ultimately move forward and create some long-lasting peace? Because that is the big question, I feel like, on everybody's mind. This is a temporary peace truce, if you will, but it ain't over.
Well, that's absolutely right. And, ultimately, the U.S. is putting a lot of pressure on Israel. I think, the fact that the U.S. was very much instrumental in making this deal happen tells you that they are hoping that this will actually be the beginning of something bigger. At the same time, the Israelis have been saying again and again that they are not going to stop the offensive, that they will resume it. So I think we have to assume that that's the case, that they will actually restart military operations. However, if they want to see more hostages released, they're going to have to agree to further truces. And it's become a very, very big emotive issue in Israel, the issue of the hostages. Yep. I think that's only going to increase now. Right. When you see hostages come out, they will be giving interviews, and the whole focus is just going to increase.
All right, Henry, thank you so much for joining us. Really appreciate it. Henry Mayer, he is a reporter of Bloomberg News, giving us the latest on this hostage deal between the two sides in the Middle East. Henry is based in Dubai, and we appreciate getting some of his thoughts. Let's switch gears a little bit, get back to that Black Friday reporting here in the States. We want to bring you an interview with outgoing Macy's CEO Jeff Gennon. He sat down with our Caroline Hyde to discuss Black Friday sales and the outlook for retail. Let's go to part of that conversation right now.
They're buying everything on their gift list, and they're buying, that's really generally in luxury. So fine jewelry, they're buying cashmere, they're buying outerwear for the entire family. Hostess gifts in our home store, but they're also home prep. We've got great deals, as we always do for Black Friday, going all the way through the holiday season. So we are ready. We've got all of our key items, loaded to bear. Here we are in Herald Square. It was a good opening. We had a great day online yesterday during Thanksgiving.
I mean, you said that on your earnings, which were, about a week ago.
Yes.
That this gets earlier and earlier.
It does.
Black Friday, the competition. How important are the next few days and the run-up to the holidays?
Oh, it's still very important. So, when you think about kind of Black Friday deals really started right after Halloween is when they started. But this is still a pilgrimage. You've got, America is traveling, and they are in homes, and they're coming into stores just like this one today. They're online. They've been online all the way through. So it's very, very important. So when we look at kind of Black Friday through Cyber Week, then we go into a lull. It's like 10 days where people kind of reset, and then those last 10 days become increasingly important. So it's one of the 3 stages right now that we are of the kind of the Christmas shopping is the one we're in right now, the first.
What, of course, your earnings showed so clearly is that it's about inventory management in many ways at the moment, and you've been managing to ace that. How are you ensuring you got the right thing at the right time for a consumer that basically we're all trying to understand right now?
So obviously the consumer's under pressure, but they still love gifts. And so we want to make sure that we've got all the right gifts and we've got all the right stock content in them. So I just walked this entire store to really understand where we are in all of the content across all of our categories, and we're in great shape. And that's really in tribute to the amount of work we've been putting in inventory control.
And when it comes to online versus in-store, in retail, this is how you've been shifting the company. In particular, people aren't perhaps having the footfall in malls. They're coming to one-off stores. They're going to smaller store experiences. But e-commerce has just been the focus. How are you managing to be at the right time in the right place for an omni-channel purchaser.
So really, the strength of Macy's and Bloomingdale's and Bluemercury is that we're omni-channel and we're omni-category. So what you have is you have customers that are shopping online. They want to come into a store and try it on, and they maybe are transacting on the couch later that night. So the opportunity to make it as convenient for the customer as possible, however and whenever they want to shop. So that's our beauty, and doing that with a national footprint, with a great website, is what we depend on.
And of course, why you've got such a great bird's eye perspective, because you do have Bloomingdale's for the higher end, more luxury purchaser, and then more income breadth when it comes to Macy's. What are we seeing in terms of the consumer? Are they going to be spending more? Are they going to be pulling back?
So you do have customers that are under pressure. And so when you think about the inflation is still high, it's abating from the change of the inflation rate from last year, but it's still higher than it was last year. And customers have got a limited budget. Some of it is they're spending it in experiences and then in our discretionary categories. So we want to make sure that we've got the right price points across that entire spectrum. But you still give gifts. And this is where Macy's and Bloomingdale's and Bluemercury shine. So when you have this gift, somebody on your gift list, we're going to have the right content for you at the right price point. And we spend from when Black Friday ends to where we are right now, we've been spending a year getting ready for that. And we do trial runs on Valentine's Day, Mother's Day, Father's Day to make sure we've got the right gifts.
I think
we're ready.
You're ready. People are worried, analysts might be worried that you're kind of managing decline at the moment. What would you say to a comment like that?
Look, I think that if we weren't a department store today, we would invent one. So the idea about having multi-categories, being able to do that in multi-channels, we now have been able to get new categories in as a result of Marketplace, which is now online at both Bloomingdale's and in Macy's. So I bet on department stores. And obviously I made my career doing this. And it is it's still very, very relevant. We're obviously looking at where traffic is moving from on-mall to off-mall. We're obviously testing that in both Bloomingdale's with the Bloomies format and with Macy's with Macy's. And so we're going to be ready for where the customer is evolving. And we've got very strong assets to be able to do that, both on mall and obviously online.
Evolving into a world where we're all using chatbots and artificial intelligence at front and center, are these the sort of areas of investment?
Yes, absolutely. Because when you think about AI and machine learning, think about when we have 40 million customers at Macy's, 4 million at Bloomingdale's, we know them very well. So to have all that data and be able to start to personalize content and values for those customers is where this is all going. How do you make your brand more relevant? And that is at a customer level. It's no longer broad-based promotion. It's the opportunity to be able to, I know Caroline, and based on what you buy, what you might be interested in, and to be able to serve that up in the way you want it served up is really the secret of success for an omnichannel retailer going forward.
You, of course, just mentioned throughout your career this is what you've been doing.
Yes.
For those who don't realize, you've worked at the Macy's brand for more than 40 years.
Yes.
And this is your last Black Friday.
Yes.
And of course, CEO since 2017. You have been thought of as a turnaround focus, the polarist, the way in which you have thought about personalization to e-commerce. You weathered, of course, the COVID in and of itself. Do you feel that you've got this Macy's where you want it to be as you look towards this being your last Black Friday?
Yeah, look, when I reflect back on my career, and certainly in my time in CEO, I didn't accomplish everything that was on my list. But look, the focus on relevant content, on amazing values, and on customer experience is clearly the path forward. And I couldn't be more excited about my successor, who is more than ready to be able to do this. He knocked the cover off the ball with respect to Bloomingdale's and what he was able to do there, how he was able to kind of help turn around the strategy of Bluemercury. He's now going to do that for Macy's Inc. So he's got a good game plan, and he's going to make it better.
All right, that, of course, is Jeff Gannett. He is Macy's CEO, outgoing CEO, talking there with Bloomberg's Caroline Hyde, talking Black Friday. I mean, Macy's is going through its own kind of disruption changes, if you will. Their recent third quarter, Paul, the reason they beat, some of it had to do with inventory management, so key to the retailers.
Yeah, it really is. I'm just looking at the stock here. It's down 30% year to date, and it's got a market cap of $4 billion. But I just kind of, in that discussion, Macy's owns Bloomingdale's, and those are some major retail department store brands.
Kind of high-end,
yes,
more
kind of
moderate end.
Yep, exactly. And you just wonder kind of where we are. But we were talking to Dana Telsley in the 9 o'clock hour from Telsley, and she's just the guru on retail. She says Black Friday's still a thing. She says retail sales, for the holiday season should be up around 3 or 4%. Not great, but okay. So that's kind of where we are.
It's interesting. Same thing. Our Bloomberg intelligence team we've been talking to in the afternoon, and I'm like, is Black Friday really still that important? Right. It used to be when literally on the financial balance sheets for retailers, they went into the black because of the holiday shopping season. They were saying, yep, still important, even for the likes of someone like a Walmart.
Yeah, absolutely. So we'll pay attention to that, and I'm going to walk through Macy's on my way back to Penn Station today, and I'll give you some first-hand reporting. This is Bloomberg. All right, let's get some company news right now, Steve Rappaport.
Well, shares of NVIDIA opened lower following a Reuters report. The company told customers in China that it's delaying the launch of a new chip until the first quarter. Bloomberg's Joan Doniger has more.
The H2O chip is one of 3 planned by NVIDIA to comply with new U.S. export rules. An analysis of the chips shows they're capable of handling most of NVIDIA's newest features for AI work, but had some of their computing power measures scaled back for compliance. NVIDIA is one of Wall Street's best performers this year, with the stock up 233% as of Wednesday's close. Steve?
Thanks, Joan. Shares of NVIDIA are down more than 1%. iRobot stock soars 30% on reports that Amazon is on the cusp of winning approval from EU regulators to acquire the household appliance company. The European Commission warned Amazon in July the deal could reduce competition in the robot vacuum marketplace. And attention shoppers, you heard earlier, it's Black Friday and there are plenty of deals up for grabs today. Part of a holiday weekend packed with savings. Not sure what to buy? Catherine Cullen with the National Retail Federation tells us some of the most popular gift ideas.
Consumers are looking to gift cards, clothing and accessories, as well as books and other media. We're seeing personal care and beauty growing as a gifting category.
Catherine Cullen with the National Retail Federation says an estimated 182 million people plan to shop in-store and online from Thanksgiving Day through Cyber Monday. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:21 on Wall Street. We do check markets all day long here at Bloomberg. We have the S&P 500 index little changed right now at 45.57, up less than 0.1%. Has been fluctuating. The benchmark heading toward its 4th straight week of gains, and stocks will finish trading at 1 p.m. New York time in observance of Thanksgiving. Recommended close for the Treasury cash market will be 2 o'clock Wall Street time. The Dow up 109 points now, higher by 0.3%. NASDAQ down 28, decline there of 0.2%. 10-year yield 4.47%, with the 2-year right now 4.94%. Gold up 0.4% at $2,000.46 the ounce, while West Texas Intermediate crude down 0.7%, $76.55 a barrel. After a week of turmoil, expectations for the delayed OPEC Plus meeting have shifted. Saudi Arabia and Russia, leaders of the OPEC Plus coalition, are still largely expected to extend output curves of just over 1 million barrels a day through the first quarter to shore up prices, according to a Bloomberg survey of analysts. ExxonMobil shares, right now they're up 0.8%, BP up 1.9%, and among other oil majors, Chevron up by 0.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Carol Masser, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. We're doing a streaming thing, too. That's the internet, folks. Go over to youtube.com and search Bloomberg Radio. And guess what? Thanks to Tom Keene, we're now also in your dashboard with Apple CarPlay, Android Auto. It gives you access to every Bloomberg podcast, live audio feeds from Bloomberg Radio, print stories from Bloomberg News in audio form, and the latest headlines at the click of a button with Bloomberg News Now. How do you get it? Well, for John Tucker, this is good news. It's free with the latest version of the Bloomberg Business app. That's a Bloomberg Business app. Get it on your iPhone in the Apple App Store or on Google Play. Just download the app, connect your phone to your car, and get started. And it's all presented by a sponsor, Interactive Brokers. So how about that? I'm just noticing here, Carol, in this studio, we have experienced people. I'm not going to say old, but we have experienced broadcasters. Where are the kids today?
Where are the kids? What do you mean? Because they're not here?
We've got Charlie Pellet, Denise Pellegrini, Paul Sweeney.
Are you
Carl
complaining
Bassett.
that people aren't here again?
I'm just saying, why are the experienced
Did you look at the control
people
room?
here?
There's a bunch of kids in the control room.
Yeah, the kids in the control room. All right. Very good. They're in charge. All right. Let's get a sense here of kind of how this is playing out in terms of retail sales, holiday shopping. I tell you, my train was pretty full today with people. They were not coming into work. I think they were coming in to shop.
Agreed.
But let's check in with Julie Van Ullen. She's the Chief Revenue Officer at Rakuten. Julie, thanks so much for joining us here on Zoom here. You guys see kind of retail sales at the store level, and you kind of aggregated it up to kind of some big macro call here. How do you think the holiday shopping season is going to unwind this year? Because there's some stress on the consumer out there.
Yeah, well, I got to tell you guys, I am so excited with what I woke up to see today from a trend standpoint on our site. What we're seeing is that this is, I think the technical term has to be just a thoroughly bonkers year in terms of retailers and brands competing for consumer dollars in the form of promotions on their own sites and then layering on cash back and other incentives. And on the consumer front, already this morning, we're seeing a significant increase in shopping trips year over year.
Hey, Julie, just remind the world what Rakuten does and how you guys, because you've got a bunch of stores, you log on, right, consumers, and they can get deals. Those stores pay you, right, for sending them shoppers. Just remind us how big your network is in terms of members.
Yeah, we have 17 million shoppers shopping on the Rakuten site with about 4,000 partner stores. So those retailers and brands join Rakuten to attract the shoppers that are excited and rewarded to shop through Rakuten's platform to get cash back on the stores that they love so much.
So one of the things I wonder when I'm talking retail is, what do you compare what you're seeing today with? Is it going back to 2019 pre-pandemic, or is it from the peak kind of coming off the pandemic? Give us some perspective so that we get a real idea of how healthy the consumer is, or whether or not retailers are feeling some pain because they're offering higher incentives than they were before.
It's a great question, and I think it comes down to it being a very different year this year than it has been for the last two, because from a consumer standpoint, coming out of COVID, there were a lot of people who saved up dollars, right? So for the last couple of years, there was a pull forward of the holiday shopping season where consumers were shopping starting in October for gifting, and retailers met them where they were, and there was a spread of the amount of offers that were in market and discounts throughout the year. This year is a very different year because retailers knew that consumers had been patiently waiting given the different economic conditions coming into this year. So it's very, very consolidated around Black Friday, Cyber Monday, and essentially really the next 5 days. So Yeah, I mean, it's just a very different look and feel this year. That said, I think brands are always cognizant about profitability. And so while we know that we need to compete for the consumer dollars, especially in a year like this year, so everyone's going to be super promotional right now, the smart brands think about how to pivot and change that up a little bit as we get into December.
Hey, Julie, is there any kind of go-to category here or gift that is going to drive this year? Is there something along the electronics front? What are people buying?
You're buying platform Uggs, aren't you? Buying
Of
platform
course,
Uggs?
you're darn right.
That's the new thing. Sorry, go ahead, Julie.
Who doesn't love an UGG? That's what I want. Yeah, so I mean, right now we have over 800 brands on our site offering 12% cash back on top of the amazing deals they're already offering. And I can tell you from categories that we're already seeing growth coming out of, department stores is one, health and beauty, big marketplaces. So think like Walmart and Target. And I think what you can tie that to is that the consumer isn't just looking for discretionary gifting spend. It's also how to get the best deals on essentials. Footwear to the Uggs is up. And then core retailers in the luxury space, even versus yesterday, up pretty significantly, which shows you what we, I think, already knew, which was that consumers are waiting to make those big discretionary buys for when they know the discounts and the incentives will be highest. And then probably most interestingly, the unconventional category of travel is up high, which again, high price point, consumers waiting for those deals.
It feels like we're all waiting for discounts more now.
Yeah.
Again, Paul.
I think we've been trained that way.
Yeah, but it felt like the retailer companies were in the driver's seat, Julie, for a while, and it feels like it's been reversing because it feels like consumers are more and more pinched. We had a great story about even those making like $100,000 that they're kind of trading down and being a lot more cautious when it comes to shopping. And I feel like so many retailers have come out, right? Mm-hmm. Walmart among them, but even, I feel like some higher end have run into some trouble here. So it does feel like increasingly all consumers are feeling a bit pinched.
Certainly. I mean, core inflation, student loan debt repayments, there's something affects everybody, right? And it just drives concerns. This year was definitely a year that we knew that consumers were holding on to their dollars. It's definitely different than the last couple of years. But that said, it's not sustainable for retailers and brands to be this promotional all year. That's why we have the partners that we do, because things like cashback can be a great incentive for brands to help create rewards for shoppers to even pay full price as we exit this highly promotional period.
Hey, Julie, after my 5 hours of radio today, I will walk to Penn Station, and I'll walk down Fifth Avenue, I'll walk down Madison Avenue, and I pass by a lot of luxury brand stores. How's luxury these days?
Luxury is a really interesting category. And like I said, we see that up today. But I think once you dig a little bit deeper into the luxury shopper, the core luxury high-end shoppers are not the ones that are driving growth right now from what we see. It's not to say that they won't come back and spend, but a lot of those super high-end handbags are a little bit more expensive this year than they used to be. And I think what you see is a more aspirational shopper looking at buying, making these purchases that are an investment for them. So a younger, more aspirational shopper, which really creates an interesting pathway for these brands to welcome new and exciting shoppers to their brands, buying the high-end goods, but they're also carving off parts of their businesses like beauty to be more discount driven, to be more promotional in terms of price points in order to usher the new shoppers their way.
So, Julie, too early to kind of come out and say, all right, this is going to be the winner for this holiday shopping season? Because it sounds like from what you say, we're going to get a good feel of consumer shopping in the next week or so, and then it might trail off a little bit. So 30 seconds, who do you think is going to be the winner?
Everyone's going to be the winner if they know how to pivot. I think that's at the end of the day, we're going to see a tremendous amount of shopping happening over the next couple of days. But then what happens after that? Are there inventory gluts that need to be offloaded through incentives? Do we need to incentivize folks to get in store through buy online, pick up in store? It's all about reaction.
All right, Julie, thank you so much for joining us. Julie Van Ullen, she's a Chief Revenue Officer, Rakuten. That's a cool platform that just aggregates a bunch of retailers you can buy online, and they give you a good sense of what's moving these days.
It does, right? And just the idea for deals. Didn't mean to cut you off, Julie. I just meant, yes, I like being able to order ahead and just either come to my car or just pick it up in the store.
That's what the kids call omni-channel in the retail space.
Are you calling me a kid?
Exactly. With our news in New York City, here's Denise Pellegrini.
Hey there, Paul. We do have word that Hamas has released some hostages held since the October 7 terror attack on Israel. The initial report was 13. NBC, though, reporting as many as 25 have been released. Now, this might be happening in waves. Right now, it looks like those initial 13, they are with Israeli security in Egypt after being released in exchange for Palestinian prisoners held in Israel. We're expecting more exchanges during this 4-day truce between Israel and Hamas, but Bloomberg reporter Henry Mayer, well, he says the hostage releases may not end up being a big win for Israeli Prime Minister Benjamin Netanyahu's efforts to destroy Hamas.
Some of these people are going to be giving interviews. They're going to, the public awareness of the hostages and the kind of conditions in which they are living in Gaza is going to be accentuated. And I think that is going to be something that will weigh very heavily on the Israeli government, probably not sufficient to get them to stop the conflict at this stage, but I think we are getting closer to that point.
That's right, and Mayor with us there on the Bloomberg Daybreak podcast. In Ireland, dozens arrested after a night of violence and looting, protesters clashing with police after 3 children and a woman were stabbed near a school. Bloomberg's Dublin Bureau Chief Jennifer Duggan picks up the story from there.
According to police, by like 5 o'clock yesterday evening, some protesters had started to gather and had attempted to breach the crime scene cordon that the police had put up. And then from there, more people joined and it turned into violent rioting.
And Duggan also says the suspect was injured, apparently, by police. And were you focusing on chewing yesterday or holding your phone under the table and doing some online shopping? Because Adobe Analytics now says consumers spent more than $5.5 billion online on Thanksgiving Day. That's 5.5% more than a year ago. I'm Denise Pellegrini, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the S&P fluctuating, little changed right now. It is on track for its fourth straight week of gains. Stocks will finish trading at 1 p.m. New York time in observance of the Thanksgiving holiday, and the recommended close for the Treasury cash market is 2 p.m. Right now we've got the 10-year yielding 4.48%, with a 2-year that's yielding 4.94%. Equities are trading mixed, little change. That is the key takeaway right now. Light volume. S&P 500 index up barely, up by 1 point. The Dow up 105, up 0.3%. NASDAQ, the composite index, down 25, a decline there of 0.2%. Spot gold right now at $19.98 the ounce, up $6, higher by 0.3%. While West Texas Intermediate crude is down 0.4%, 76.82 for a barrel of WTI. Next week, investors will be getting data on home sales, personal income and spending, and the PCE deflator, which is the Fed's preferred inflation gauge. Justin Wolfers is a professor of public policy at the University of Michigan, and on Surveillance this morning, he talked about the Fed's progress in fighting inflation.
One of the most notable things that has happened over the past year, really, is that Jay Powell has started to talk about inflation in terms of supply shocks. That's a real optimism that the bad times were due to supply, and the supply shocks are behind us, which gives you a whole lot of reason to feel optimistic that the better times are ahead of us.
And you can hear more of the conversation with Justin Wolfers on the Surveillance podcast. You can download it wherever you get your podcasts. Again, recapping the 10-year, 4.48%. S&P right now up by 0.5 point. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie. Thank you so much. Charlie Pellet there. You are listening to Bloomberg Markets. Carol Masser along with Paul Sweeney. I'm in here for Matthew Miller on this post-Thanksgiving Friday. You into books? Secondhand books?
I am a little bit. I mean, we have these little give and take book places all around, which are pretty fun.
Well, it's a pretty big market.
It's way bigger than I thought.
Words Rated, they're an international research data and analytics group. In 2022, they said the market for secondhand books was a net value of $24 billion, expected to reach more than $45 billion, Paul, at the end of 2013. North America, their market share is almost 30%.
I thought we just read stuff on our tablets and phones.
I don't. I like a book.
You don't? Yep.
All right, well, let's see what Ken Goldstein has to say about this. He's got a front seat at all of it. He's chairman and CEO at Thrift Books Global. They're the world's largest independent online seller of used books and an author himself. He joins us right now on this Friday. So, Ken, talk to us about this market, what you are seeing in terms of demand and growth, and who's doing all the buying.
Well, good morning, and thank you so much for having me on the show here on Black Friday, which is, as you know, the Super Bowl of retail.
Is it a big day for you guys? Is it a big day for you guys as well?
It is. Black Friday, Cyber Monday. I just looked at the Thanksgiving numbers; those were very strong. It's been a great couple of years for us. Starting with COVID, we stayed open all the way through, and were able to provide people with books, in their homes when the stores were closed. And it's just continued to grow since then. Our customers have stayed with us. Our repeat customers are terrific, and this category has an awful lot of momentum.
So, Ken, I didn't know this was a category, much less has a market value of $24 billion. I can't even find a bookstore anywhere to get new books. Well, what's going on with this? Where did these kind of used books? I didn't know there was a market. Explain to me kind of how this has evolved and over time.
Sure. Well, let's not write off bookstores too soon. We all love to go to bookstores.
Yes.
I've been on book tour a couple of times. I love reading in bookstores, but online is where it's at. Certainly, for younger generations. And there's just a lot of focus now on what we call e-commerce and putting goods back to work that were previously used. We work very, very closely with a lot of charities, with Salvation Army, with Goodwill, St. Vincent de Paul. We work with libraries across the country to help them, prune their shelves and get new books on their shelves. And all those books come back to us, and we look at them carefully with a very sophisticated algorithm. Pick the ones that we think that we can market. price them accordingly. And once you become a customer of Thrift Books, it's very, very rare that you won't come back and shop with us again.
I gotta say too, and I'm noticing a resurgence in bookstores too. I feel like we went through kind of a fall off, and we used to be on kind of a mission to find them for our daughter, who again didn't like electronic reading. We bought her all those things, and she's like, "Nope, I want a book. I want to hold it." You guys have seen double-digit growth over the last 20 years. Sold some 250 million books. You sell them on your own site, Amazon, and eBay. What's the most productive way of selling? Is it through your own site, or is it through those others?
Well, of course. I mean, when I joined the company 11, 12 years ago, we were primarily at that time a marketplace seller, and I got together with my partners and put together a plan to really create this Thrift Books brand, migrate those customers to thriftbooks.com, create our loyalty program, Reading Rewards, and it's been a very, very successful strategy. Obviously, if you can not have someone between you and your customer, that's where you want to be. You want to build that deep customer relationship. You want to reward them for their purchases. You want to handle their customer service issues. I spent my whole life, in brands and building brands, and this has just been an enormously fun and rewarding brand to build because the customers love what we're doing so much. They love keeping books out of landfill. They love reading. They love sharing their ideas about reading. And it's just great to see something that otherwise, like I said, would go in a landfill going into somebody's hands.
Are the margins good? Give me an idea. Like, as Paul said, I think I just take it for granted. I go to garage sales or something, or a church sale or something, and that's where you see a lot of used books. In my neighborhood, people put books on their stoops, when they're done reading, and that's just kind of how we pick them up. Do that for kids, too, in the parks, It's really kind of sweet. What's the margins on a business like this? I'm not quite sure. Acquisition costs probably can be low. I don't know. Give us an idea.
Well, you have to remember that we have to buy an awful lot of books to find the ones that you actually want. And that's sort of the big difference between the yard sale or the used bookstore that you would normally go to. When you come to us, you're looking for something, and we have it. We have a very, very large inventory. We keep 10 million books under roof at any time. We have access to another 5 million books behind that. Yeah. And so if we don't have it, nobody has it. And if we don't have it, you put it on your wish list. Say it's a frontless book that just came out, New York Times bestseller. Of course, we can sell it to you new, but we don't have a used copy yet. Come back to me in 4 or 5 weeks. We probably do have it. And if you've got it on your wish list, we'll send you a message. We'll send you an instant message, let you know that it's there, and you'll buy it pretty quickly at a very, very good price. Right. Remember, all of these books are a very big discount to retail. So that's another part of it being attractive. But the difference is, as I said, is building that inventory, building that data science, understanding the analytics, connecting the customer with what they actually want, and then having discovered that, make recommendations to you on other books that you might find interesting because of the books that you actually came looking for.
Sounds like AI, Paul, plays a role in all of this.
Of course, everywhere, it seems like. So, Ken, right here at our Bloomberg Interactive, Bloomberg headquarters here in Midtown Manhattan, we have a great bookstore right around the corner, Argosy Bookstores, and it's always got good foot traffic there. So I think you guys are onto something there. What are people buying today? When they come to you, what are some of the types of, or the genres that they buy? They buy fiction, how-to books. What's the genre?
Yeah, it depends on the time of year. Obviously, we have we call 3 Christmases. Christmas, which we're in right now. We have back to school in the winter, back to school in the fall. Those are all big seasons for us. So obviously, during back to school, people are looking for all the normal English 101, Economics 101, not necessarily textbooks, but the books that fill it out. Right now, this romanticy category is crazy with authors like Sarah Maas and Rebecca Yarros. You see Iron Flame, you can't keep it in. We had a limited edition. We sold it out in seconds. That whole category has really been fueled by TikTok, and the book talk category on TikTok has really, really ignited that. So we're seeing a lot of movement there. Obviously, Stephen King, anything that he comes out with, Holly, that's going to move. We're seeing a lot of celebrity bios. The Barbara Streisand book's doing well. The Henry Winkler book's doing well. Britney Spears' book is doing well.
I'm amazed that you already have the Barbara Streisand book as like a secondhand book. It just came out.
We actually got, I don't know how we got it. It came in. I actually had it on my wish list and put it on, and a new one came out, and it got a used one, but it moved very, very quickly. But come back in 4 weeks. We'll have more.
Romanticy. That's what you've been searching on, right?
Of course, exactly.
Romanticy.
All right, Ken, thank you so much for joining us. Really appreciate getting a few minutes of your time. Ken Goldstein, he's the CEO and chairman of Thrift Books. I do have the Barbara Streisand thing on my shelf, but it's a big book. Yeah. It's huge. I mean, granted, she had a amazing life. So I'm sure she can fill up the pages, no problem. S&P 500, absolutely unched on the day. This is Bloomberg. Let's get some company news right now. Steve Rappaport.
Paul, it's go time for bargain hunters. Black Friday is here with plenty of deals for the taking. And despite inflation and higher cost of living expenses, the National Retail Federation predicts an increase in holiday season spending. Catherine Cullen is the NRF's Vice President for Industry and Consumer Insights.
Even with things going on in the broader economy, even with concerns that they may be facing in other areas of their lives, they are being buoyed by strong wage growth, as well as by the fact that for many consumers, these holidays and special events are even more important right now.
Catherine Cullen with the National Retail Federation. According to Adobe Analytics, consumers spent $5.6 billion on Thanksgiving Day online. Nissan makes a big commitment for going green in the UK. Bloomberg's Tom Busby reports.
Steve, Nissan plans to significantly ramp up EV production with a $2.5 billion investment at its site in Sunderland. The Japanese automaker will set up another battery factory and produce electric versions of the popular Qashqai and Juke models at Britain's largest car-making hub. Nissan will put up most of the money, with the rest coming from partners for the cell and power grid. This latest move by Nissan follows recent announcements by Jaguar's owner Tata Motors and BMW to increase EV investment in England.
Steve? Bloomberg's Tom Busby reporting. JetBlue and Spirit will make the case for their merger before a federal judge on Monday in Boston. The Justice Department sued to block the $3.8 billion deal, arguing it would stifle competition and drive up fares. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, not surprisingly, a quiet day out there in the markets. S&P 500 really unchanged on the day. The Dow's up about 0.3%. The Nasdaq's down 0.3%. So
It's a meh day.
Yeah, exactly. It's just a Friday. It's a Black Friday. We're looking at the yields up slightly. The 10-year Treasury is up about 7 basis points, 4.47%. WTI crude oil steady here, just under $77 a barrel. And I'm going to call out Bitcoin for Tom Keene. That's up 2.7%, 38,270. How about that for Bitcoin on the crypto side? Right now, with our news in New York City, here's Denise Pellegrini.
All right, thank you, Paul. And of course, we're watching this hostage situation. Hamas has released some hostages held since October 7. They are with Israeli security now in Egypt. And judging by where they are right now, it does look like they're expected to cross into Israel shortly, maybe in just about 20 minutes. They were released in exchange for Palestinian prisoners held in Israel. And we are expecting more exchanges like this during this 4-day truce between Israel and Hamas. But Terry Haynes, founder of Pangea Policy, says don't get your hopes up that this means that the fighting between Israel and Hamas is over.
Israelis are resting and replenishing a little bit because what needs to be understood, I think, is that the ultimate war aim of Israel hasn't changed, which is the destruction of Hamas. And I think that if people think there's a serious deflection or difference in how Israel is going to try to prosecute this war going forward after the ceasefire is over, I think they're mistaken.
And Haynes there of Pangea Policy on the Bloomberg Surveillance podcast. There's another perspective to Wednesday's fiery car crash at a U.S.-Canadian border checkpoint in Niagara Falls. Bloomberg's Michael Barr is tracking that story.
The mayor of Niagara Falls says investigators believe that the $300,000 Bentley that crashed may have suffered mechanical failure. The car exploded in a fireball, killing the wealthy New York couple inside at the Rainbow Bridge. The FBI said they found no explosive material and no terrorism nexus. According to the Buffalo News, police are now calling it a traffic investigation. Authorities now believe that likely either the driver suffered a medical incident or the car malfunctioned. In New York, Michael Barr, Bloomberg Radio.
All right, thank you, Michael. And Paul and Carol, were you focusing on chewing yesterday and getting your blood sugar up, or were you holding your phone?
I was inhaling food, to be honest, but go ahead.
You weren't busted for holding your phone under the table and looking for some bargains, huh?
No.
Well, somebody else then, because consumers spent more than $5.6 billion online yesterday. That's according to Adobe Analytics. Electronics were big. Of course, the better your electronics, the more you can do that stuff under the table.
Yeah, I was kind of like blown away that even Macy's wasn't open yesterday, where it used to be how much earlier and earlier and earlier stores were opening on Thanksgiving. I'm like, just give everybody a day at least, right?
And no video of doorbusters today.
Yeah, that's true.
Those are gone.
I think they are. I think that's what, I don't know, it's not as big a thing as it used to be, I guess, but people are still spending.
Yeah, they still are spending. Yeah. Anyway,
Right.
no, I was eating and drinking my wine.
Yes, exactly. All right, Denise, thank you so much, Denise Pellegrini, with our world and national news here. All right, here's a story that kind of gets your attention. Mideast wealth funds draw greater U.S. security over China ties. Middle Eastern wealth funds are facing greater scrutiny on U.S. deals from the Biden administration, part of a broader pushback on entities perceived to have close ties with Beijing. That's according to people with direct knowledge of the matter. And there's a lot of money in those wealth funds, and it's going not just in the U.S., but also being invested in China.
Yeah, the value of acquisitions and investments by Gulf funds into the Asian countries, so we're talking about China specifically, has climbed to about $2.3 billion in 2023 from about $100 million last year. So talk about quite a ramp up. It just, the concern from the United States is when CFIUS, the Committee on Foreign Investment in the U.S., gets involved, they're concerned about anything that could pose a national security. So the concern is these deals that are being done, the money going in terms of these wealth funds, if it has China ties, then what access does China have to technology infrastructure that might be a risk, a security risk, national security risk to the United States? I always feel like, Paul, it's all complicated. I need a whiteboard to kind of understand, but it gets increasingly more difficult.
And it just feels like it's just another step in this technology Cold War, if you will, between China and the West, and of course funds coming out of the Middle East. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, Munis in Focus. There's a rumor that Matt Miller may call and just participate on Munis in Focus. He loves the municipal bond business so much, but Joe Mysak's going to join us here in studio. That's how committed he is to the municipal bond market. Plus, Nancy Dowd, private wealth advisor at Ameriprise Financial and CEO of Opus Advice First, is going to join us and get her thoughts on these markets. Our C-suite conversation today, Belinda Oakley, CEO at Sodexo Live, joins to discuss jobs in hospitality at the NFL and college stadiums.
Because people are doing
business.
stuff, right?
Sure,
they want to experience
everybody's out
stuff.
and doing stuff. Absolutely.
Yeah,
so
totally.
that is a growth part of the business. All right, but let's start things off this hour with Charlie Pellet.
Thank you very much, Paul and Carol. Here's what's going on. Little change. That's perhaps the key takeaway right now, with the S&P up 1.4557, a gain of less than 0.1%. Just about unchanged on the daylight volume. We have got the Dow up 117, higher by 0.3%. NASDAQ in the red, down 27 now, drop there of 0.2%. However, Russell 2000 up now by 0.7%. Small cap shares are rallying. We are looking at an early close today for the U.S. stock market. Stocks will wrap up at 1 p.m. Wall Street time. 10-year yield now 4.47%. 2-year 4.94%. Spot gold up $5.50 the ounce to $19.97. Was trading briefly above $2,000 an ounce, while West Texas Intermediate crude oil is down 0.2%, $76.94 a barrel. Retail very much in focus. This weekend, consumers will be out shopping. They are today. Investors will be tracking retail sales data for a glimpse into the health of the consumer economy. Poonam Goyal is senior retail analyst at Bloomberg Intelligence, and she says, while there could be some good deals for shoppers, retailers aren't exactly desperate right now.
The one difference this year versus last year is retailers actually have less inventory heading into the holiday season, meaning they're leaner. So they don't have to discount to the extent of 80% off or 90% off. They can pick and choose where they have excess inventory, where they know that they're not going to be able to sell full price and it might get marked down anyways later on in the holiday season. We're going to see them be strategic to preserve that margin.
And you can hear more of that conversation on the Bloomberg Daybreak podcast, which you can download wherever you get your podcasts. Macy's shares down 1.3%. Target shares up 0.2%. Best Buy up 1.5%. And Kohl's down now by 2%. Again, recapping, little changed on the S&P right now, up by 0.5 point. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate it. Carol Master, Paul Sweeney live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube, so head over to youtube.com and search Bloomberg Radio. Just looking at the WEI function, Carol, just kind of get a sense of volume here. So for the Dow and the S&P 500, we're about 40% below the trailing 30-day average in volume.
What volume, right? It's
Yes.
just so quiet.
But, NASDAQ, we're only down 5% versus the last 30 days. So people are a little bit active on the NASDAQ space here. So
I always feel like whenever there's a little bit of anything, we find investors, if they don't want to buy more broadly in terms of the equity market, they find some opportunities when it comes to the NASDAQ.
Interesting here. So let's see what's happening underneath the hood here. Maybe some individual names here on this Quiet Friday trading. Jess Metton rejoins us here in our Bloomberg Interactive Broker Studio. Jess, what are you looking at?
Well, AVAT is another function that I like to use to measure volume. So if you use that for the S&P 500 and use it up against the last 30 days, volume down about 46% there. So looking at that. And then if you want to look at more individual movers, since it is Black Friday, I'm looking at XRT. So that's the ETF that tracks retail stocks in the S&P 500. It's up about 0.3%. But if you look this past month, it's actually up 8%. And then to put in context, just year to date, it's only up about 5%. So clearly when you look at that versus the broader S&P 500 being up around 19%, clearly you're looking at retail underperforming at the broader market. So when you are looking at the XRT, so these are stocks, not surprisingly, Macy's, Foot Locker, different companies like that, also Target. So you are seeing that. And then individual names, though, if you look at Walmart, ticker symbol WMT. Now that is, if you are looking today, not moving too much though, but it has climbed about 10% year to date when you are looking at Walmart stock. And then also looking over at Amazon today, ticker symbol AMZN though, another stock that's in focus. I mean, of course, this one up 70% year to date when you are looking at Amazon though. So clearly when it comes to some of these retail names though, actually though, when you look at Amazon, it's down about 0.6% today, and then Walmart's only up about 0.5%. So not too much movement so far on those retail names, though. You are.
So just go back to Amazon real quick.
Yeah.
Jeff Bezos, just for the kids out there taking note here, second richest person on the planet,
Rich
according
Go.
to Rich Go on the Bloomberg terminal, $170 billion, still, almost $50 billion behind Elon Musk, but he's up $64 billion year to date. Good for him. So those that are
not doing bad.
Yes.
So go buy a retailer, Jeff. Oh, wait, you've got one already.
Right. If you want to put in context for the week, since this is Friday, obviously the stock market closing early at 1 p.m. in New York today, but those major averages are headed for a fourth straight winning week. So you're looking at the Dow, S&P 500 up around 1% each, also the NASDAQ 100. So it would be the longest weekly winning streak for the S&P 500, actually since June, and the Dow hasn't posted a weekly run this long since April. So putting into some size and scope there for the weekly data.
Yeah, I think it's interesting with the retail group. I think about Walmart. When it reported, I think it dropped something like 8% because of its concerns and words of caution when it comes to the consumer. And this is, retailer, the world's largest, tells you so much about really a broad swath, if you will, of the U.S. consumer.
And especially not even just the world's largest retailer, but the largest grocer too.
Yep.
When you think about the percentage of sales.
Too.
Yes. And also Target used to be housed in the discretionary sector in the S&P 500, but then got moved over into staples earlier this spring because of the GICS changes. So now that's actually considered a staple, but a lot of that also had to do with some of the percentage for its grocery business too that it moved over to staples. So I think sometimes people kind of forget about it. And sometimes it's a little hard to gauge when you're looking at which way to measure retail because they're straddled across a few different sectors there. So if you look at just discretionary or staples, it doesn't tell you the whole picture. And then of course, Amazon being in discretionary too, that can sometimes, if you look at the equal weight, is sometimes a little bit better. So then it doesn't get skewed by Amazon's performance.
I'm just checking out our live blog, and it just says in-person Black Friday shopping appears relatively muted this year.
Okay.
It's kind of interesting. Online shopping up. But again, they were I feel like I'm looking at my phone, it's exploding with online offers.
Yes.
But it has been for the last, I feel like at least 2 weeks.
Yeah, starting that a lot earlier instead of just doing the
What
typical
percentage
Black
of your
Friday.
shopping will be online versus in-store?
Probably 90% of
Right.
it. Oh, yeah. Especially my daughter, she'll just be like, okay, here's the link. Even my husband will be like, here's the link. It's just, that's the way it is.
It is.
It's like amazing. What about for you?
Yeah, totally. I mean, I can't remember the last time I was in a store, but I will walk through them again on my way to Penn Station today. I'll walk through Macy's.
Get a
'Cause
feel
it's
of
right
it.
anyway. Just get a feel.
Yeah. What about you, Jess? How do you shop?
I feel like most of it is online, and because I compare different things, different price points, and I'm like, all right,
I'll be in a store and then I'll search and I'll be like, okay, so what can I? All right, is there a better offer somewhere?
Yeah, so I think it has to be something in particular for me to go in.
All right, I just wait for the links. If I don't get the links from people, they ain't getting anything.
So
is it really how you do
the
it?
Sweetie
totally.
clan?
Yeah.
Is that what
Yeah.
you do to
Otherwise
your
you get-
kids?
I'll just come in with a bunch of cash and start handing it out on Christmas morning.
Wow.
underneath the
Can I
tree.
be your kid?
Exactly. That's how it works.
Papa Sweeney.
Exactly. All right, very good. Jess Manton, thank you so much for joining us. We
Want to go
appreciate it.
shopping for munis?
Let's do that. It is, it's a Friday ritual in Bloomberg Markets, and again, it was the highlight of Matt Miller when he was here working, as opposed to what he's doing now. He loved municipal bonds. He wouldn't know a municipal bond if he tripped over it. The reason we talk about munis is because we love Joe Misek and the fact that we get paid for it. Focus on Munis is brought to you by Build America Mutual. Build America Mutual insures U.S. municipal bonds that finance essential American infrastructure and provides guaranteed income to improve any portfolio. Be part of Building America. Invest in BAM Insured. bonds.
So Emerald Lagasse of you.
I know.
Bam!
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 Oh,
Where's Matt? Like, it goes really loud, right?
Exactly. Yeah.
I always used to have to, like, take my headphones off when I'm, like, working.
Exactly. He came from the full wind-up.
It's the best commercial read on Bloomberg. Joe, municipal bonds here. You know, actually, let's start. Watch how we're going to tie this in.
Okay.
The Dream Mall
Exactly.
was in the news
I
today.
thought, I knew you'd
So
want to
glad you
go
went
this
there.
way.
Okay,
The
where
Dream
are
Mall.
those bonds trading? Are they not at zero yet?
No.
Because when this thing was issued, I told
Right.
you they're going to zero.
Yeah, you did. In default, and today you had this incident there. I think the people have been allowed back into the mall. But, I just thought of that. I thought of you. I said, wow, Paul's going to say something about
Yeah, let me just hit this red headline crossing the tape. The Red Cross confirms safe release of 24 hostages from Gaza. So we'll have more reporting on that, but just want to get that across to you. So, Joe, as we come into kind of year-end here, what's the feeling? What's the municipal bond market? Another challenging year, I'll put it that way. What's the state of the muni bond market as we come into year-end?
You're exactly right. This has been a very challenging year, but we are really winding up with a bang. No. It looks like this November is going to beat last November in terms of performance, well over 4%, I think 4.68.
Is that because last November was so bad, or?
Well, yeah, things had gotten so bad, prices had, eroded, but we are seeing new sales pick up, We're seeing, performance improve. We saw yields over the last few weeks drop like 63 basis points on average, which in the muni market is insane. So things are really going gangbusters. And I want to say, the high yield muni market is back. I noticed today an issue in Connecticut, from Waterbury, Oxford, Connecticut, for a fixed base operator. And I said, well, there it is. The high yield muni market is back. So things are really.
What does that mean? I'm not a big muni person, but I understand the importance of it. And
fixed base operators?
Yeah.
Okay. They service private jets and private planes at airports.
Okay.
And they're selling, I think it is $43 million for a new FBO operation at the Waterbury Oxford Airport. And I said, wow. And, last week we saw an issue, a high yield issue, for a firm that manufactures mycelium.
You what?
Mycelium.
It is a fungi factory.
All right, this is going off the rails.
To produce synthetic leather, believe it or not.
All right. Go ahead.
No,
South Carolina.
No, it's really interesting because the fashion industry has been so bad for the environment.
Bingo.
So they have been trying to figure out different ways.
Exactly.
And that includes in the leather world.
Right.
Because we know raising cattle is not good.
This is what mycelium is.
Yeah.
It's like, people call it the mushroom. It's like, oh yeah, the mushroom factory.
Just call it a leather amoeba,
right.
and we'd all be much clearer about it.
It is a fungi that is a, how do they always refer to it, like a precursor to mushrooms?
Yeah.
And they have it in big trays and turn it into leather, or I say a leather substitute. And fashion is really into this year. Yeah. So, that was I think $80 million deal last week. So things are really winding up with a bang in munis. And I know you're going to ask, we saw inflows into municipal bond mutual funds this week. Small, like $290 million, I think.
Did they get lost on their way to money markets or somewhere else?
No, people all of a sudden they're saying, well, munis. And this is, one of the reasons we've seen the collapse in yields because people are rushing back in.
All right. Again, understand this is a really important market. The yield curve, we talked so much about the U.S. Treasury yield curve, but there's the muni yield curve as well, right?
Muni yield curve was insane almost all this year. We have an inverted yield curve, and the market overall is telling us, hey, the Fed is done, raising interest rates because we're seeing yields come down. But the inverted shape of the muni curve is still saying, hey, come back in December for further clarifications.
Why are so many investors coming into New York City tax-exempt bonds? Don't they know we have like a $7 billion budget deficit?
You've got the New York City high tax, So you have this
great tax
base of investors that is always interested in New York City munis. As for that $7 billion deficit, yes, interesting story by Martin. You know, the thing with New York City is you still have the Municipal Assistance Corporation, you have the state, you know, ready to jump in with oversight at the first sign of real difficulty. So, you know, people are a little bit inured to any kind of difficulty in New York City because they know the state's going to step in. It's a you know, a caring parent, if you will. Now, that can't be said for all the states. You know, the state governments in certain states aren't going to step in, but in New York, it's been done before.
Can you talk about the ESG world, which I feel like
Wild,
has had a reckoning?
crazy.
But tell
Oklahoma.
us about what's going on in Oklahoma, because this is kind of an interesting twist in what's been a pushback by states against all these kind of woke investors.
Well, you know, this is an Oklahoma pensioner, former state employee, filing a lawsuit basically saying, stop playing political games because you want to make a point, make this quixotic point about ESG and Wall Street. Instead, you got to use those big firms. Guess what? So it's very interesting. And
these are states that are pushing back against BlackRock, JP Morgan, and others, right? Or saying, stop with wanting to do things like sustainability.
And now investors are saying, hey, stop. You stop. You know, you stop. You stop. So
grow up, everybody.
It's grow up, everybody.
I mean, if I'm city, can I do business, municipal bond business in Texas these days? I mean, where are we in Texas? Because they were kind of on the forefront of that.
You know, there's a handful, and I know the Texas politicians are still very suspect, and I have to say that the underwriting pool there is growing smaller and smaller.
Exactly.
That cannot be good for a state that is selling a lot of muni debt because more people have moved there.
Yep.
Yeah.
Real quick, 30 seconds. What's the calendar look like going into year end?
You know, I just took a look and I saw 400 issues on the calendar. I think it's 383, 400.
Is that a lot?
And that's a lot. It's building up again. So we'll probably have a pretty busy 2 weeks, but you know, Wall Street takes, you know, another week off and between Christmas and New Year's. So we have a very compressed schedule.
I'm just going to say, great story on what's going on with Texas and municipal bond market by Amanda Albright and Danielle Moran. Just talking about Ken Paxson specifically and his hold on a lot of investment firms and doing business in that state.
It's crazy.
Hey, Joe, guess what?
No,
It's crazy.
that's it.
How can Matt Miller not love you? Matt, are you listening?
Exactly.
Joe Misek, he's a Bloomberg treasure.
Absolutely. Joe Misek, he's the editor of Bloomberg Roof, covers all things municipal markets, and that's what we do on Fridays. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
All shares of NVIDIA are down more than 1% after the chipmaker reportedly told customers in China it will delay the rollout of a new chip until next quarter. The latest on that from Bloomberg's Kriti Gupta.
The U.S. government, in an effort to bring some of the chip production in-house, has banned the export of certain chips to China. So to tackle that, NVIDIA basically said, you know, we're going to design a new type of chip that helps kind of get around some of those regulations and specifically alleviates the concerns that the government has while still catering to the Chinese market. That new strategy is now expected to take longer.
Bloomberg's Kriti Gupta. Barclays is working on plans to reduce costs by as much as $1.3 billion over several years. Reuters reports the plan could involve slashing as many as 2,000 jobs. And shoppers aren't the only ones getting their Black Friday game on. Bloomberg's Michael Barr has more.
Steve, consumers will shop till they drop on the couch for some football. The NFL is hosting its first Black Friday game, with the New York Jets taking on their division rival Miami Dolphins this afternoon. The game streamed exclusively on Amazon Prime Video. Also offers a play-by-play shopping experience. Viewers will see special deals pop up on their smart devices. Many of them will be available through a QR code. The NFL will close out its first ever Black Friday game with Garth Brooks performing an exclusive concert in partnership with Amazon Music.
That's
Steve?
Bloomberg's Michael Barr reporting. Kickoff for the inaugural Black Friday game is 3 p.m. Wall Street time. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg, and we begin with a developing story headline from the Bloomberg Professional Service. The Red Cross is confirming the safe release of 24 hostages from Gaza. Stay with Bloomberg for the very latest. Again, repeating the headline, the Red Cross is confirming the safe release of 24 hostages from Gaza. The Dow, the S&P, NASDAQ trading mixed right now. A little change. That is the key takeaway for the S&P 500 index. We'll call it unchanged. We have got the Dow Jones Industrial Average right now up by 109 points. That is a gain of 0.3%. NASDAQ, though, in the red, trading lower. We've got the NASDAQ Composite Index down 28, down by 0.3%. Cannot ignore small caps today. Russell 2000 rallying by 0.7%. We are looking at an early close today, 1 o'clock Wall Street time, and the recommended close for the Treasury cash market, 2 p.m. 10-year yield right now, 4.48% with a 2-year, 4.95%. Spot gold up $6.50 the ounce, just below 2,000 at $19.99, higher by 0.4%. West Texas Intermediate crude down 0.4%, 76.79 per barrel of WTI. iRobot shares are surging as Reuters reports that Amazon is set to win unconditional EU antitrust approval for its acquisition of the household appliance company iRobot, up now by 35.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Powell, thank you so much. We appreciate it. Carol Massler, Paul Sweeney live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube as well. So I'm looking at the S&P, Carol, and if I'm a fund manager, and that's my bogey, the SPX is up like 18% year to date. The equally weighted S&P, however, is only up about 4%. So if I haven't been long those Magnificent Seven, I got a problem going into the last month of the year.
Yeah, your investors are calling up and have some questions. You know, but you look at the S&P 500, we're not even quite back to where we were in, the summer of, I don't know, I'm just looking back. We went down for so much kind of late last year. We've been kind of bouncing around.
Yeah, exactly. So I don't know if I need to chase performance here in this last month. I don't know. Let's talk to a professional who does this stuff for a living, Nancy Dowd. private wealth advisor at Ameriprise Financial, joins us. Nancy, what are you telling your clients here? I bet you're probably getting some phone calls, as Carol's suggesting, like, hey, the S&P is up 18%. How come I'm not up 18%? What do you tell them?
Well, it all has to do with when your entry point was, obviously. I mean, that's kind of the bottom line. But, you know, in looking at the final weeks of 2023, it's obvious that the broader stock market has absorbed more than its fair share of punches this year. You know, we've had a regional banking crisis, we've had lingering inflation, we've had higher interest rates, and, you know, this looming recession, which hasn't occurred yet, or maybe it will still happen. And then, of course, the new geopolitical threats with the tensions between China and the U.S. as well as Israel. So we've certainly had our fair share of threats to send stocks, you know, going up and down all year. But apparently stocks are still standing and maybe a little more bruised, but, you know, ready to come back as a winner. And I think we're going to end the year with a bang, it looks like. You know, it really has to do with when the entry point is, and investing largely comes down to time and discipline. The longer an investor can keep their money invested in stocks, maintain a well-diversified and disciplined approach, and importantly, you know, avoid the timing mistakes, then you're going to be better off.
I mean, I like to talk fundamentals in terms of valuation. So I don't know whether, you know, you look at the market overall or you start looking at individual, you know, stocks and sectors to kind of get an idea of whether it's overvalued or undervalued. I mean, if I look at the S&P, Nancy, we're kind of back where we were, in this summer, right? The S&P, you know, a little bit of a sell-off, to say the least, and then we've bounced back. So I'm trying to understand what's a fair price for this market right now.
Well, it appears that the U.S. stocks in general are probably overbought at this point, following a period where they were oversold. So that's kind of what I was talking about. You know, how you feel about the market usually depends on time period that you're measuring. So over shorter periods of time, it's common for an investor to move through feelings of like euphoria and despair almost at the same time, you know, but depending on what's going on in a given week or in a given day, equity prices will change dramatically. And the Magnificent Seven, as they're called, you know, by the media, have certainly pretty much led the market. But, you know, having said that, there is a little bit more breadth now that we're seeing. Mm-hmm. So the one point that's very clear is that history keeps repeating itself, and it has definitely demonstrated that there is very little that stocks can't absorb with enough time. So when you're looking back just midsummer or even last year, that's just not enough time. So nothing has been thrown off at the market, you know, over the last handful of years that it hasn't been able to weather ultimately over time.
So unlike Carol, who was overweight, the Magnificent Seven, I was not. So what sector should I be looking for? Should I be trying to chase some of those tech names, or should I look for some other sectors?
Well, just by using the word chase, you're already in the wrong. So you see what I'm saying? Like,
yep.
You need to have a disciplined approach to this, a great financial advisor, of course, and build a portfolio that is suitable for your time frame and what I call stomach lining, and that's fancy terminology for your appetite for risk. And you just got to stay the course, believe in your strategy.
Well, you are a great financial advisor because you are one of 100 individuals named to Barron's list of 2023 top independent financial advisors. And that's because of your strategy, your calls. Having said that, I keep thinking, while we talk so much about the big caps and the Magnificent Seven, I'm looking at a Russell that is still off 10% from late summer. Well, the large caps have fully recovered, it seems. That's not so for small caps. Is that where you're finding opportunities? Is that where you commit new money at this point?
Absolutely. And I did mention this at a previous Bloomberg appearance that, you know, we always look for opportunity in the sectors that have taken the biggest beating, and that's certainly small cap stocks. And now the mid cap arena is a little less threatening right now. So if you're brave, mid caps look really good. But if you're super brave, small caps look fabulous because they've been taking such a big beating. And with a recovery, looking ahead in 2024, hopefully that's what's going to happen. With a few caveats, that's where I see a big opportunity.
Hey, Nancy, I look at the 2-year Treasury. Boy, I can get almost 5% for just giving my money to Uncle Sam for a couple of years. Is that a bad trade?
Well, again, if your time frame is just 2 years, that is absolutely.
I could get hit by a bus tomorrow, Nancy. 2 years is big.
We can all get hit by a bus, but if that's not what you want to think, you want to have a short-term, a midterm, and a longer-term goal. Long-term money absolutely stops. There's no two ways to think about that.
Does that mean you don't think any kind of serious recession next year?
I think recession is still on the table.
Okay.
It's very difficult to say what's really going to happen. Like I said, 2023, we've had a few punches, but the good news is that results are better than expected. Inflation did fall, employment remained resilient, and we did not have that recession. Now, whether we're still going to have that soft landing or not, time will tell. January will be a very big indicator. Now, we also have some new geopolitical risks that could really change things. The war in Israel could be a big problem because it directly affects companies with energy prices and supply chains. So these are some of the things that we have to think about. And then also the other thing looming over us is corporate earnings will be affected when companies have to refinance. Short-term debt or even medium-term debt is obviously going to expire at some point here in the next year or two. And when it's refinanced at a much higher rate, that will cut into profits as well.
Nancy, how important are dividends to you and to kind of the ideas you give your clients?
Well, dividends are great for keeping everybody's stomach lining at bay, I guess is the best way I could say it. And this is why I've been such an advocate of value stocks over the course of 2023, because although the NAV or the market value of each holding will fluctuate, you're still getting that income, which offsets all of that volatility that everybody gets all apprehensive about. You don't want to feel like a roller coaster ride. You want to at least have some level of stability in the portfolio on a regular basis.
Hey, just got about 30 seconds left here. You like utilities, healthcare, financials. Utilities and healthcare said to me some caution. Just real quickly, is that your thinking here?
Well, throughout the course of 2023, that has been the case because those are good dividend-paying stocks. But, the outlook for 2024 may be changing at this point. I'm a bit more opportunistic for smaller cap stocks and information technology and consumer staples. Watching energy prices, of course. So energy stocks are probably likely going to do well, especially with all the multiple wars and potential wars going on.
Yeah.
And then, interestingly enough, I've been all about U.S. equities. Now I'm beginning to look at valuations. Your U.S. equity valuations are.
All right, Nancy, I think we're just going to have to leave there just because of time. Appreciate getting some of your time. Nancy Dowd, Private Wealth Advisor at Ameriprise Financial, with our news in New York City. Here's.
All right, thank you. We have a group of 24 hostages from Gaza being released by Hamas. That is in exchange for 39 Palestinian prisoners. And Bloomberg's Henry Mayer says it took weeks of negotiations and a temporary truce to get to this point.
It took weeks of very, very complicated negotiations. Hamas has a political office in Doha, in the capital of Qatar. So Qatar was very much at the forefront of the negotiations. But the U.S. also played a very important role, as did Egypt. Egypt is the country which is now acting as the exchange point for this deal.
Bloomberg's Henry Mayer reporting there. Meantime, President Biden may be hoping this 4-day truce marks a turning point, but Terry Haynes over at Pangea Policy says the president's influence on Israel's war aims is limited.
This is a two-edged sword for the president. They certainly want to celebrate the idea that they've gotten some of the hostages out, and to the extent they can deflect Israel's war aims, that allows people within the administration to try to again to prosecute their vision of what Middle East peace should look like.
And Haynes there on Bloomberg surveillance. In Ireland, dozens arrested after a night of violence and looting, protesters clashing with police after children and a woman were stabbed near a school. Bloomberg's Dublin Bureau Chief Jennifer Duggan says details, though, are still murky on this.
It's understood that there were rumours circulating that the person who had carried out the attack yesterday, the stabbing incident, was a foreign national. There's still not a lot of details around that, but it's understood to be somebody who'd lived in Ireland for 20 years, is what has been reported in media here.
Bloomberg's Dublin Bureau Chief Jennifer Duggan there. Global News 24 hours a day. I'm Denise Pellegrini, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg, and we are looking at a mixed market right now for the U.S. stock market. Early close, 1 o'clock Wall Street time when stock market trading ends today. We've got the S&P little change, not doing a whole lot of anything, down now by just about 1 point. The Dow Jones Industrial Average up 82 points. We are off session highs now. The Dow is up by about 0.2%. The NASDAQ Composite Index trading lower by 28 points. For NASDAQ, that is a drop now of just about 0.2%. 10-year yield, 4.48%, with a 2-year, 4.95%. Spot gold up $6 the ounce to $19.99. Higher now by about 0.4%. West Texas Intermediate crude oil in the red. WTI trading lower now by 31 cents a barrel, 76.79. Black Friday retail stocks very much in focus today, and very much a mixed picture. Macy's shares, they're down 0.9%. Target shares lower by 0.2%. Best Buy up 1.5%. Kohl's stores down now by 1.4%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
It is indeed. All right, Charlie, thank you so much. You are listening and watching Bloomberg Markets live on radio, YouTube, and of course on Bloomberg Originals. Carol Masser in for Matt Miller, along with Paul Sweeney. And Paul, we talk so much about people continuing to spend on experiences rather than buy stuff. And I feel like our next guest has a great window into all of that. Sodexo Live, it's the hospitality partner to global venues. They've had a lot going on this year, everything from hosting the Formula One Miami Grand Prix at Hard Rock Stadium, the 2023 MLB All-Star Game at Seattle's T-Mobile Park, to events at convention centers, cultural attractions, and an airport lounge business, which if you've been to an airport lounge, they are packed.
Yep, they are.
All right, so let's get to it. With us is Belinda Oakley, CEO at Sodexo Live, joining us on Zoom on this Friday. Great to have you here, Belinda. Your first year on the job, what's that been like?
Oh, hi, everyone. Hi, Carol. Hi, Paul. And happy Thanksgiving. The first year has been a whirlwind, but what a great time to be in the live events business. I think, as you mentioned, the focus on experience continues to lead people back to those packed environments, those environments where you can do something a little different than how we used to spend our time. And to be in a bird's eye seat for that is a true gift and an honor.
So, Belinda, I'm completely ignorant of your company, and you're part of the hospitality business. And when I walk into a stadium, I don't know.
Just get your beer and take it for granted?
I just get my beer, and I just assume they're employees of the team or of the, I don't know what's. You guys have 400,000 employees at 50 sites all over the world. Just amazing. Can you tell us about kind of coming out of the pandemic? What are you seeing in your business? Because, again, it seems like everybody just wants to get out, and they've been getting out over the past couple of years and going to big events and maybe, ticking off bucket list items. What have you seen in your business?
Yeah, look, you said a few things there that I'll jump on. I think first and foremost, if you're going to a game and you're getting your beer and your hot dog and back to your seat, then that's what's supposed to happen. Yeah, I think you shouldn't spend too much time thinking about the magic behind the scenes that makes it all happen. But as you mentioned, we are fortunate. We have about 20,000 associates just in the sports and leisure division across about 150 venues just here in the US and Canada. And it takes a lot to make that magic happen. And in a way that as a fan, you get to focus on what you're there to experience, and that food and beverage just is an augmentation to a great service experience. But I think first and foremost, as you mentioned, the hospitality industry has changed greatly, obviously through the pandemic. We see a real shift in who is working in hospitality, obviously with the unemployment rate getting back to a lower level. The labor market is still tight, and finding those folks who have a love of being a part of live events is a different challenge than what we were facing before COVID. I think in terms of what we're seeing from consumers, it's fascinating, whether it's the pitch clock changes in MLB, whether it's the introduction of autonomous experiences where you can get your beer and your hot dog and sometimes not even speak to an individual, we are seeing that consumers still want to be back in those big live environments. They want to actually spend more when they're there. They want to get out of their seat more often because they trust that they can get back to their seat and not miss a moment of the game. So certainly I think we've seen all the trends of pre-pandemic in terms of consumers wanting things faster, wanting to elevate their experience. We're just seeing it all moving at a more rapid pace.
Belinda, I'm curious about the labor component side of it, because you say it's still tight, although we're starting to see some signs of maybe a little bit of softening, but I agree, it's still a tight labor market. I increasingly, on the retail side, if I'm shopping, I'm more and more often checking myself out, even taking off security tabs. What are you guys doing? Are you increasingly more pressured to automate things in your industry because you can't find those workers?
Look, it's funny. I think there was a lot of fear, certainly a few years ago, that automizing the retail experience or the consumer experience was going to take hospitality jobs away. But what's interesting is we are seeing we've got the same number of individuals employed. If you take somewhere like the Mariners T-Mobile Stadium in Seattle, we have 4 autonomous retail environments by Amazon Just Walk Out. We have the same number of employees because what people are doing has shifted. I think while you're checking yourself out, the expectations of the level of service and hospitality in greeting, in going that little bit above and beyond to make sure you've had a great day, I think that need has elevated. So we're seeing the type of labor need change. I think the days of going through the checkout and not having any kind of interaction are well and truly over. That's what autonomous is for. But the spirit of service and hospitality, that is still high demand and highly sought after in an employee base.
Hey, Belinda, it just seems, I'm not sure if it's just in the U.S., but certainly in the U.S., it seems to be an arms race for these stadiums. They're bigger and more luxurious and have more services. And it's not just the beer and a hot dog anymore. You can get all kinds of stuff there. How do
Champagne
you guys,
and caviar, it
exactly.
feels like.
How do you keep up? Who kind of drives that? Is that you guys driving it, or is that the owner of a franchise saying, I need more, I need better?
Well, I think every owner of every franchise is saying, I need more, I need better, because we're all fighting for the same share of mind, I think. Now, that's a really healthy level of, I think it's a healthy paranoia to make sure that you are always trying to elevate and stay on top. We're very fortunate. We have talented teams of chefs and operators in our venues. We also get the benefit, especially doing some of these really high-end clubs and restaurants, which, of course, as the experience has elevated from hot dogs and burgers to, as you mentioned, champagne and caviar and all the rest of the local favorites. We do work with a lot of restaurateur partners. So I think ultimately, who drives that constant pushing of the envelope is the fan. You look at whether it's the Food Network, today's consumer is just they have such a higher expectation of what wows. So you have to be constantly going a little bit outside of the norm, whether that is, again, you're still going to get your traditional favorites, but whether it's sweet tea fried chicken in Indianapolis or jambalaya in New Orleans, you have to bring that local flavor in. But the one thing I would say is what we have to be careful about as we continue to elevate and expand the experience is the heart of consumers coming to these events is not based on elevation. It is the experience we all remember growing up. So having those game day favorites, having them affordable for everyone to keep bringing their kids and their grandkids to these experiences, it just means we have more tiers, I would say, of what you can experience. If you want a high-end experience, you got it. If you want to come for a beer and a hot dog, it won't break the bank, you got that too.
Hey, 30 seconds though, you've got to feel inflationary pressures, whether it's on wages or food costs. I mean, construction costs. How difficult is that? And again, just about 30 seconds.
Yeah, absolutely. I mean, you've hit it. Concrete is still through the roof, but trucking have obviously been mitigated. Inflation, we are certainly in deflation. So I think in terms of what have we done? We have learned to be much better at working in this environment. Menu engineering. We have a $20 billion purchasing network as an organization, so we get to take advantage of that scale. But I think this inflationary environment, it's going to keep switching where the pressure is, but our job and So Live's job is to be better than the best at that, and thanks to us, we're able to.
Looking forward to experiencing some events, certainly in the new year. Belinda Oakley, CEO of Sodexo Live, thank you so much. Really appreciate it. Yeah, concrete costs. Business Week has done a story on that. Like, it's just kind of been all unbelievably expensive.
They have the big house at the University of Michigan. They manage that thing. That's
pretty cool stuff. We go to the Open, right? It's an event.
I know. It is. All right, we're going to have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, shares of iRobot are up more than 37%. Bloomberg's Alex Semenova tells us why the stock is flying so high.
This is after reports that Amazon is set to win unconditional approval from the EU for its acquisition of the company, which is, of course, the maker of household appliances like the popular Roomba vacuum. This deal was announced back in the summertime. Amazon said it would acquire the company for $1.4 billion.
Bloomberg's Alex Semenova reporting. Back in July, the European Commission warned Amazon that the acquisition could hurt competition in the robot vacuum cleaner market. Shares of Amazon right now up less than 0.25%. Americans filled up at the holiday table, but consumer data shows many people saved some room for shopping on Thanksgiving Day. More on that from Bloomberg's Laura Sandley.
Adobe released their latest data. Thus far, we've seen pretty much record spending as far as it comes to online spending on Thanksgiving. We have consumers spending $5.6 billion, which is up 5.5% year over year. And that's almost double what we were seeing in 2017.
Bloomberg's Laura Sandley reporting. Adobe says demand outweighed concerns about inflation and higher cost of living expenses. The company will release Black Friday shopping estimates this evening at 6:30 Wall Street time. And the Supreme Court will hear arguments next month over whether Purdue Pharma's bankruptcy plan violates federal law. In exchange for giving up ownership of the Stanford-based company, the Sackler family would be exempt from any civil lawsuits related to opioids. The justices must decide if it's legal for Chapter 11 protections to be extended to people who have not declared bankruptcy themselves. Those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Hi, Cower Master Paul Sweeney live here in our Bloomberg Interactive Broker Studio, looking at these markets here, unchanged on the S&P 500. Got the Dow up about 1/10%, and the Nasdaq off about 1/10%.
Maybe.
So everybody's out
Online.
shopping. Everybody's out shopping, which is good. We have volume about 30-40% below averages, so that's kind of right in line with
Everybody
what you would
counting down
expect.
to the next Fed meeting. That's my focal point.
Exactly.
Couple weeks.
Fed go. We just do Fed go.
Yeah.
10-year Treasury up 7 basis points, 4.48%. And WTI crude oil, $76.30, so it's off a little bit again today. I filled up the tank, the new BMW down Jersey Shore, $3.10 a gallon.
I got to go down the shore.
Exactly. How good was that?
It's not that cheap up here.
I know. Everybody's moving down there. All right, world and national news. New York City. Here's Denise Pellegrini.
Yeah, well, we've got some good news for those looking for the release of hostages. That could be one of the things that investors are looking at. Hamas releasing a group of 24 hostages held in Gaza after a 4-day truce agreement with Israel in exchange for 39 Palestinian prisoners held in Israel. So that's the impact so far on day one of this truce. White House hoping the pause could be a turning point. Bloomberg government's Courtney Rosen, though, says it's a delicate, tense moment right now.
Prime Minister Netanyahu has said that the war will continue after this pause is over. And President Biden's message has constantly been about watching for civilians. We know that Hamas fighters tend to mix in with civilians, and the Israeli military has to make a decision on how to act. And the president has encouraged them repeatedly to be very careful.
Bloomberg government's Courtney Rosen there in Washington, but Bloomberg reporter Henry Mayer says the hostage release may not be a big win for Netanyahu's efforts to destroy Hamas. Here's why.
Some of these people are going to be giving interviews. They're going to, the public awareness of the hostages and the kind of conditions in which they are living in Gaza is going to be accentuated. And I think that is going to be something that will weigh very heavily on the Israeli government. Probably not sufficient to get them to stop the conflict at this stage, but I think we are getting closer to that point.
And Mayor with us there on the Bloomberg Daybreak podcast, which you can download wherever you get your podcasts. And one thing we're watching for are all these strange headlines out of China about all these kids who are showing up in hospitals with these
I saw this
respiratory
this morning.
viruses, some of them fatal, and it just this incredible wave. Now, Chinese health authorities, they do say now that known pathogens, in other words, ones they already identify and can classify, are causing this huge wave. They're talking about mycoplasma pneumonia. Along with RSV, we know that one, right? And the flu, they say it's not a surprise since kids were, isolated for a long time, and now they're back. This is in China, when you think about it, the first winter, full winter where they're back. So, I don't know. Personally, I'm still watching that one, but... Yeah.
Hope it doesn't come over here. Is that basically it? No, it feels like everybody's getting sick, and it's just an explosion again.
I'm all jabbed up, so
are you?
We'll see how it goes.
I'm not jabbed yet.
All right. Denise Pellegrini, thank you so much. We appreciate that. Carol, this is a really interesting story on the Bloomberg terminal. It really goes to geopolitics, to an older story, which is Ukraine. Ukraine's struggle for arms and attention gives Putin an opening. So as the war in Gaza deepens, some of the U.S. and the EU are asking whether they can go on funding what Ukraine's top general admits is a stalemate. This is an issue.
It's a tough one, and I feel like we have been trying to cover what's going on in Ukraine and Russia because obviously the focus shifted in the last 6 weeks to Israel and Hamas, understandably so. But at the same time, what happens with this war getting ready to enter its third year? And while publicly a lot of the world still supports Ukraine, it does feel like, according to this reporting on Bloomberg, on the Bloomberg terminal, that behind the scenes, people are not so committed to maybe continuing to fund this war and fund the Ukrainians.
Yeah, we spoke to Admiral James Stavridis last week, his former NATO commander, and he just came back from Korea, a trip there, and he said he thinks it might have to end up something like Korea, which involved a land for peace agreement. And that is probably something that the Ukrainians do not want to entertain at this point.
You just wonder about the repercussions of that. Would be the second land grab, though. That would be a success for Mr. Putin. So certainly something that's going to carry into 2024.
We'll continue to have all this reporting on the Bloomberg terminal. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Meghan Crane, morning editor for U.S. government with Bloomberg News. She's going to join us to discuss Israel's response to the Israel-Hamas war, Biden's role in the conflict, and the outlook for the administration's approach here. Charles Gillespie, CEO of Gambling.com. That's a publicly traded company. He's going to join us to discuss his company's earnings and the outlook for sports gambling, which has just become so prevalent across seemingly all sports, every level, just extraordinary.
Gamble on everything, can't you?
It's unbelievable.
I'm not a gambler. Are you a gambler?
No. I'll go to Vegas and throw some craps, but that's about it. But these people are going nuts on this stuff. So Tom McGee also is going to join us. He's the CEO of ICSC. Discuss Black Friday and holiday spending, off to a pretty good start, it seems like. But first, let's kick this hour off with our good friend, Charlie Pellet.
Much, Paul Sweeney. The Dow, the S&P, NASDAQ trading mixed right now, thin trading. S&P 500 index just like it has been for much of the morning, little changed, swinging between gains and losses. Right now we are looking at a loss for the S&P of just about half a point. Dow Industrials, they're up 76 right now, off session highs, still holding on to a gain of 0.2%. The NASDAQ Composite Index down 24, down 0.2%. Russell 2000, though, rallying 0.5%. Bottom line here, thin trading, lots of traders staying home. S&P on track for its fourth straight week of gains. Stocks will wrap up trading at 1 o'clock Wall Street time, and the recommended close for the Treasury cash market is 2 p.m. Wall Street time. Right now, the 10-year 4.48%, with the 2-year that's yielding 4.95% on that 2-year. Spot gold up $7.50 the ounce, right around the $2,000 level. It is at $2,000.13 right now on the precious metal, up by about 0.4%. Bitcoin up 1.3%, 37,748 on Bitcoin, and West Texas Intermediate crude down 1%, 76.38 a barrel. Black Friday, lots of people hitting stores and malls today, and Bloomberg caught up with Macy's CEO Jeff Gannett at the retailer's flagship store at Herald Square in Manhattan.
You think about kind of Black Friday deals really started it right after Halloween is when they started. But this is still a pilgrimage. You've got, America is traveling and they are in homes and they're coming into stores just like this one today. They're online. They've been online all the way through. So it's very, very important. So when we look at kind of Black Friday through Cyber Week, then we go into a lull. It's like 10 days where people kind of reset. And then those last 10 days become increasingly important. So it's one of the 3 stages right now that we are of the kind of the Christmas shopping is the one we're in right now, the first.
And you can hear more of that conversation on the Bloomberg Surveillance podcast. You can download it wherever you get your podcasts. Macy's shares are lower, down now by 1.1%. Among some of the other retailers we're following this Black Friday, Kohl's down 1.9%, Target shares up 0.3%, and Best Buy higher by 1.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master along with Paul Sweeney. I'm in for Matt on this Friday, live on radio, YouTube, and of course on Bloomberg Originals. This is Bloomberg Markets. And certainly top of this hour in terms of world and national news, we've been focusing on the release of hostages. Hamas releasing a group of 24 hostages held in Gaza after a 4-day truce agreement with Israel. We've gotten confirmation from that from the Red Cross. And for those of you who've been watching on YouTube or Bloomberg Originals, we've certainly been showing some of the footage of that release. Let's get to the latest and the role of the United States, specifically President Biden and his team. With us is Meghan Crane, morning editor for U.S. government with Bloomberg News, joining us on Zoom. Meghan, this has been in the works for several weeks. Lots of players involved, including the United States. What is the latest from the White House on this?
Right. So the White House this morning has been pretty quiet on this release. They're really waiting for details about who is coming out of Gaza. They did say that they do not expect any Americans to be released today. They are hopeful that some will be released in this group of 50 that is expected to be coming, over the next couple days.
So, Megan, what is the White House's, I guess, most recent talking points in terms of how they expect this to play out, and just in terms of the overall conflict in Israel? How do they expect it to play out? Do they have a preferred timetable, preferred outcome? What's their messaging been recently?
Sure. Well, I can't speak for what they're hoping for, but their messaging is that, we want the hostages out. They're focused on the Americans, but really all the hostages, primarily getting them out safely as quickly as possible. President Biden was very personally involved in this negotiation over the course of the last several weeks. So they are, playing it very close to the vest, being very quiet this morning as far as, not doing any sort of victory dance as these people are released very slowly.
It's about the release of hostages, very, very important, but it's also about getting some humanitarian assistance across to those Palestinians in the Gaza Strip who need it. And there's always been, or it feels like that there's certainly been pushback from Israel, concerns it was going to go to Hamas, any kind of aid. Where are we on that? Because the president has talked specifically that this entire deal, everything has to be implemented.
Right. It's a very, very delicate situation that they're going through, enduring right now. Biden has also been focused on getting humanitarian aid to Gaza. As you said, the people there have, are struggling to meet basic needs. And, aid started to trickle in a few weeks ago, and then maybe in sort of larger amounts. But part of this, release is obviously the pausing in conflict and in bombing so that they can get more aid and more support for the Palestinians. That's important, I think, morally, but also politically for the president. So it's something that they've been focused on. It's a very delicate dance.
So, Megan, give us a sense of just in general, what kind of role is Washington, is the White House trying to play here as this conflict continues to unfold here? How aggressive is it being? Is it pressuring both sides? Kind of, what's their playbook right here?
I'm not sure how much influence the White House really has over Hamas, right? So they're working through the Qataris to facilitate, discussion and not necessarily a ceasefire, but sort of a, like you said, humanitarian aid in and getting the hostages out. It's politically very, very difficult for the White House, for the United States in general, to sort of walk a fine line between calling for an end to conflict, but also supporting Israel's right to defend itself.
Megan, I'm curious, as we kicked off this conversation, Paul and I, with you, you said no Americans in this first round, although they're hoping, I guess in subsequent days, that we will see some Americans. I'm just curious what you're hearing on the optics or the political optics in terms of who's coming out, when, and how many, and I can only imagine the conversations that are going on.
Right. Well, I think, a lot of Americans were hopeful that the girl Abigail, who turns 4 years old today, would have been released. The optics of that would have been great for the United States. I think the president is just really focused on getting hostages out, and primarily the Americans. They're not putting too much pressure on anyone publicly to make that happen in the short term. We believe, I guess, there are 10 Americans, Abigail, the young girl, and 2 women, and then, a few men. So I don't know that they're expecting that those men, for example, would be released anytime soon.
All right, Megan, any sense, just real quick, next steps here? Is it just more hostages? Because we're seeing video of this initial group of 24 coming out now.
Right. So I think that it's, I'm sorry, the Qataris had reported that some Palestinians had been released in exchange for this today already. I don't know that we have that confirmed, but we did report that Qatar said that. So that, I think, is sort of, part of this very delicate process, the aid coming in, the Palestinians being released, and hopefully, another group of hostages are released again tomorrow, and we kind of keep this process going as long as possible.
Hey, one last question. President Biden and his team, is everybody kind of on the same page when it comes to the way forward? Or I wonder if there's a lot of debate going on. Paul and I were talking about a younger generation in terms of Palestine, or the Palestinians versus Israel. There's some different thinking among a younger generation about I don't know whether it's right to say who may be in the right here, but it's not so black and white, let's put it that way, among a younger generation. I'm just curious what you're hearing from within the White House.
Right. Well, I think it's just exactly as you said. People have, a different opinion on how things should be approached on this very long and complicated conflict. And that was sort of what I was alluding to when I said that the president is facing, political challenges as well as moral challenges for getting aid to the Palestinians in Gaza, for getting, sort of end the conflict there, but also supporting Israel. It's just a really, really difficult balancing act for the president, and that would stand within his administration as well.
Yeah, it's a tricky one, no doubt about it. We're going to continue, though, to track the headlines as we continue to see footage of the hostages making their way out and back, hopefully, to their loved ones. All right, Megan Crane, morning editor for U.S. Government with Bloomberg News, joining us on Zoom on this Friday.
All right, let's switch gears here a little bit, Carol. We get into it's another huge sports weekend here. We've got college football, NFL, professional basketball.
Just a little bit.
Everything's coming together. And one of the biggest areas of sports in this country over the last several years has been sports gambling. And the amount of money that is now being wagered is just extraordinary. It seems like all of the leagues, after decades and decades of trying to keep sports betting out of their business, are now opening arms and welcoming them in. And one of the players there is Charles Gillespie. He's the CEO of gambling.com. Unfortunately, he's also a graduate of the University of North Carolina. So that's a check mark against him.
Tough crowd.
Exactly. Hey, Charles, talk to us about just how your business has evolved over the last 3 or 4 years. It's just almost night and day.
It really is. As many of the listeners will know, the Supreme Court decision in 2018 really upended the world of sports betting in the United States. We've been running this business for going on 20 years, but mainly in Europe, in the UK, Ireland, and a number of other European markets. And we had to turn the whole ship around and point it at the United States in 2018. 2019, we had just a couple of $1 million in revenue in North America. And this year, we'll have our guidance is to exceed $100 million in revenue for the whole group. And we expect an absolute majority of that to come from North America. So, it's completely transformed our business, and the U.S. is now the center of gravity for the global online gambling industry.
We talked earlier about people want to experience things, but people do also want to gamble increasingly. Hey, tell us about your business, because from what I understand, I just want to understand exactly what the business model is. I mean, you guys are a provider of digital marketing services for the online gambling industry. What exactly does that mean? Lay it out for us all.
So we do the same thing for online sports betting and online casinos that essentially like hotels.com does for an online hotel. If you're going to travel to Paris, you're not going to go to 10 different Parisian hotel websites to find a hotel. You're going to go to a website that has all that information in one place. So, for example, if you want to bet on sports in New York, there's a variety of different options. They have different strengths, they have different bonus offers, they have different levels of customer support, et cetera, et cetera. So you come to a website like gambling.com, but we run over 50 websites. We've also got bookies.com, casinos.com, and a number of others. And there we will show you all the information that would be relevant to you as a sports bettor or online casino customer and help you make the best decision for you in terms of where to play. So then people would leave one of our websites, they'll go to the online gambling operator's website, and they are our clients, and they pay us on a performance basis for the number of new depositing customers that we can send to them from our portfolio of websites.
I never thought I'd see this, Charles, but Mickey Mouse is now in the sports betting business. ESPN Bet just launched here. What does that mean for the industry, and what does it mean for you guys?
Up until they launched, I think it was a lot of wait and see and speculation about whether or not this was going to be as big of a deal as everyone's making it out to be. And since they have launched and they are a client of ours, we are helping them acquire customers. The initial numbers have been spectacular, unlike anything we've ever seen before. So what's clear to us at this point is that ESPN Bet will no doubt be able to acquire customers. And the next question is, will they be able to retain those customers? Will they stick around? Will they like the product? Will they get the right sort of CRM engagement to make sure that they're not just there to kick the tires once, but that they actually become long-term customers? And if they do that, they will be a major force to be reckoned with in the United States.
I'm thinking if I was a gambling AI chatbot, I would want to be linked into you because you probably have a lot of data and information on gambling trends. Give me an idea, first of all, of like, what is it that people really, really want to bet on? Where's the most activity seemingly happening, or at least the inquiries based on what you guys are seeing?